Hello, good evening, friends. I hope all of you are doing good. Today we are going to start with SFM March 2023 MTP. We are going to solve all the numerical questions. Step by step, I am going to solve. You can also solve along with me. You can find this question paper link on the description box below. You can click on the description box. You can click on the description box and you will get the link on our website from where you can download the MTP March 2023 question paper, and I am going to discuss the answer step by step. The answer is also there on the institute website. You can take the answer from institute website also. I believe that this revision will be very useful to you. It contains different varieties of questions from different topics, and therefore you must practice all these questions. All these questions are likely questions for the exam purpose also. Some of these questions have been repeated in the past study material, RTP, MTP or the past exams. So don't worry, we are going to solve all of them. I want that you should keep the model test paper, question paper in front of you, or maybe on your screen, and you can understand it better. So unless you have the question paper in front of you, you may not be able to understand what is happening. So here we begin. First we'll come to MTP March 2023 SFM question number 1. This question you must have studied several times in your regular classes. The question is, ZX Limited has made purchases worth USD 80,000 on 1st May 2020. So this is a question from Forex topic. $80,000 you have purchased, so you will have to make payment, on which it has to make a payment on 1st November 2020. So you are an importer in this problem, and the risk is that the dollar rate may go up when you go to make the payment. The present exchange rate is 75 rupees per dollar. The company can purchase forward dollar at INR per USD 74. One option is you can go for forward cover. Take a forward cover at 74 and lock the rate. The company will have to make an upfront premium at 1% of the forward amount purchased. This is the cost of entering into forward contract. The forex dealer will charge you some cost for giving you this option. Okay, very good. One student Yamini, forex exposure problem. The cost of funds to ZX is 10% per annum. Similar question have been asked in the past. So there will be three costs: forward rate plus the premium that you are going to pay, and plus the interest on premium, because premium will be paid today and that payment will be made on 1st November. So there is an interest element involved also. The company can hedge its position with the falling expected rate of USD in the foreign exchange market on 1st May 2020. The other option is you can wait and calculate what is the expected rate, and you can take the decision either based on expected rate or based on forward cost, whichever is going to be lower for you. Is it right? Although this may result into a risk because this is expected rate, and like a CS student, expected rate may or may not be realized. Okay, so very good Yamini, I am happy you are replying. You are required to advise the company on a suitable cover for the risk. So I will have to do two calculations. One is my rupee outflow if I take a forward contract, including whatever interest and premium, my rupee outflow using expected rate, and then because I have to make a payment, I will choose a rate which is lower of the two. So very easy question. This is for 8 marks. Oh my god. 8 marks bonus. So first write down. I am going to solve step by step. I will request you to keep the notebook in front of you and start writing. Keep the calculator also. If you will also reply, if you will also participate, then I'll feel very happy about it. Okay. So write option 1, hedge using forward market. Hedge using forward market. Right hand side, amount in rupees. Option 1, hedge using forward market. Now in this problem, it is not just the forward rate I have to consider. I also have to consider the cost of entering into a forward contract, which will include the premium and the interest also. We have solved in regular classes, sir. Very good. You are right. So write down. Little fast you can write down. Don't worry about the handwriting part because the institute answer is there on their website. So first write down amount payable under forward contract. Amount payable under forward contract, student will take $80,000 into 74 rupees forward rate. Take your calculator, multiply 80,000 into 74. 80,000 into 74 is 59,20,000. But in this problem specifically given, there is a cost involved. So write down hedging cost. Hedging cost will be the forward contract amount into 1%. So please write 1% of 59,20,000, which comes to 59,200. This amount is paid today, but this amount will be paid after 6 months. So there is an opportunity cost on 59,200 for 6 months at 10% per annum. So write down point number C. Please write down interest. Interest on 59,200 at 10% for 6 months. So that comes to 2960. Check 2960. 2960. And therefore the total outflow will be how much? 5982160. Very good. 5982160. So this is the answer under option 1, hedging using forward market. Hedging using forward market. Option 2, do not hedge. Option 2, do not hedge. If you do not take forward, then you will have to rely on the expected rate. Student will write down step 1 under this. Option 2, first write do not take forward contract. Then write step 1, expected exchange rate. Expected exchange rate after 6 months. Expected exchange rate after 6 months will be, you are given 4 rates and their probability. So expected rate will be various rates given multiplied by probability. So write down expected rate after 6 months. Write nicely. This is how you will present in the exam also. Presentation will give you full marks. 77 into 0.15 plus 71 into 0.25 plus 79 into 0.20 and plus 74 into 0.40. Please answer, what is the expected exchange rate after 6 months? Expected exchange rate after 6 months is 74.70 per dollar. Very good. Those who are replying, very good. Step 2, expected amount payable. If you do not hedge, this is your expected rate. So the expected amount payable will be 80,000 into 74.70. Come on, reply. How much it comes to? It is 59,76,000. 59,76,000. Is it right? So now compare the two answers and check whichever is lower. So this answer is lower by some thousand rupees, few thousand rupees. Anyway, We are students, so whichever is the lower figure, that I will take. So write down the advice and conclude the answer. ZX Limited should not take forward cover. ZX Limited should not take forward cover as cash outflow is lower under unhedged position. Cash outflow is lower under unhedged position. Cash outflow is lower. Just write one note which institute has not mentioned, but this note should be written. Expected rate may or may not be realized, because it is based on expected values, not guaranteed values. Expected rate may or may not be realized. Just write a note, expected rate may or may not be realized. So this was my answer of part 1A for 8 marks. Now second question from bond valuation chapter. Write down very important. Question number 2, bond valuation. An investor has recently purchased substantial number of 7-year 6.75% 1000 bond with 5% premium payable on maturity at a required YTM of 9%. So lot of details are given here. The maturity period is 7 year. Coupon rate is 6.75%. Face value is 1000, but the redemption will be at 1050. The redemption will be at 1050. Okay, pay attention. At maturity, the YTM is also given 9%. So using this data, you can find out the intrinsic value of the bond today. However, due to a financial crunch, he is looking to sell this bond and has got a proposal from another investor who is willing to purchase these bonds by shelling out a maximum amount of 897 per bond. Now he wants to sell this bond. Another investor says, I can purchase this bond only by paying 897. Investors follow intrinsic value method for valuation of bond. Okay. Investors follow intrinsic value method for valuation of bond. So we will find out the intrinsic value first using the information given in the first 3 or 4 lines. You are required to determine, very basic question, the market price, duration, volatility of the bond, which means modified duration of the bond, and second, the YTM of the new investor. The YTM of the new investor will be based on the price that he is going to take, that is 897, and the market price you will calculate using the YTM of 9%. So first answer will be based on the original data, but the second answer will be based on taking the price as 897. Okay. What is the relationship between the price of the bond and the YTM? This you can answer now also. What is the relationship between price of the bond and YTM? So I will give you two choices. You have to answer which is right. Direct relationship or inverse relationship. Direct or inverse? Anybody? Direct or inverse? Direct or inverse? So the answer is inverse relationship. As the YTM will go up, the bond prices will fall. That is what is happening right now in the global economy, that many bonds value have gone down because the central banks of many government or many countries have increased the rate of interest. Okay, so let us write down the answer now. In the first step, we will get two answers, price and duration. So write down, the student will write down market price and duration of the bond. Market price and duration of the bond. So when you have to calculate duration also, we will draw 5 columns. We will draw 5 columns. It will give you the price also, and it will also help us to calculate the duration also. Is it right? So first write down year, second cash flow, third PV factor, because PV factors are given in the problem. I am going to use the same. Then write down year into PV and PV into year. This last column will be required for duration. Right? I hope you are able to understand. This is how we solve question on duration. So first you write down year 1, 2, 3, 4, 5, 6, 7. Year 1, 2, 3, 7-year problem. So write down year 1, 2, 3, 4, 5, 6, 7. Cash flow will be the coupon rate into face value. Coupon rate is 6.75%. So you can take 6.75% into 1000. This is the working of 67.50. Okay. And then you repeat it for 6 years. In the last year, it will be 67.50 and plus redemption value 1050. 50 rupees the premium. So this total will come to, come on student, please reply. 67.50 plus 1050. How much is that? 1117.50. Okay. Now PV factor don't calculate. Take it from the question. Take it from the question. When institute is giving you factor, take it from the institute question. Respect the institute. Then they will respect you. Okay. Now my job is done. You will have to multiply cash flow into PV factor and take the total in the PV column. Start. And since you are going to add them, use memory plus function also. So what you do, 67.50 plus into 0.917 equal to memory plus 61.898. Again 67.50 into 0.842 equal to memory plus 56.835. Come on, next 52.110. Next one, yes, 47.790. Next one, 43.875. Next, 40.230. And next one, 611.273. 611.273. Tell me the total. Let us see who will give me the total first. Give me the total first. Who will answer the total first? The one who will answer total first will get a chocolate. Anybody for the total? The total is 914.011. So this is your market price. Your first answer, this is your market price. Now what you do, to calculate duration, year into PV, column 1 into column 4. First you erase everything from your calculator's memory. 1 into 61.898 equal to memory plus. Write down here 61.898. 2 into 56.835 equal to memory plus 113.67. 3 into 52.110 equal to memory plus 156.33. This way you will multiply, use memory plus function, and you will get a total of 5262.724. Check the answer. Yes, 5262.724 is right. Okay. Now, for calculating duration, sum of year into PV will be divided by sum of PV, and that will give you duration. So write down below the table. Therefore, duration is equal to summation of PV into year divided by summation of PV. So those who have joined late, we are solving MTP of March 2023 SFM. Okay, line by line, question by question, all numerical question we are solving. So this will give you a good revision also. So the total of the numerator will be 5262.724 divided by 914.011. So that is equal to 5.7578 years. 5.7578 years. Now we'll calculate step number 2, volatility of the bond. Volatility of the bond means modified duration. So we have to now compute what is called modified duration. Modified duration formula all of you have studied is duration upon 1 plus YTM. Duration upon 1 plus YTM. Come on student, duration is how much? 5.7578 and YTM was how much? 9% divided by 1.09. So you will get 5.28. You will get 5.28. This is called volatility of the bond or modified duration. What it indicates, if YTM changes by 1%, the price of the bond will fluctuate by approximately 5.28%. So 1% change in YTM leads to approximately 5.28% change in the price of the bond. Now the next interesting question is, what is the YTM of the new investor? What is the YTM of the new investor? So go back to your question. The new investor is going to purchase the bond for rupees 897. The new investor is going to purchase the bond for rupees 897. So therefore, I will have to take this as a base for calculating the YTM. This is a coupon bond. In a coupon bond, there are two ways we can solve. Either we can solve by applying formula, or we can apply the IRR formula, interpolation formula. So whichever one you want to use, you can use it. So I am going to solve by formula method because it's a coupon bond. So write down, since it is a coupon bond, we can solve by formula method. Come on student. Formula for YTM is C. C stands for coupon plus RV minus CP. RV means redemption value and CP is the amount the new investor is going to pay. CP is the amount new investor will pay, because we have to look at the return from the point of view of new investor. We have to look at the return from the point of view of new investor. So we'll take that 897 rupees upon RV plus CP by 2. Any other notation you can write in the exam. After writing the formula, you must write the full form of these notations. Some examiner, they deduct marks for this purpose also. So now I am going to give you the numbers and the student will give me the answer. Student will have to give me the answer. 67.50 plus in bracket 1050 minus 897 divide by 7 upon 1050 plus 897 divided by 2. Please solve this. Let us see who will give me the answer first. Come on, everybody. Who will reply the answer first? I'll wait. Who will give me the answer first? So the answer is 9.18% approximately. Write down the word approximately because we are using formula method. Institute in its suggested answer they have solved by YTM method, that is interpolation method. That is also right. You can do like that also. Write a note. Alternatively, YTM can be calculated by IRR method. Alternatively, YTM can be calculated by IRR method. Just write a note. In case if you want to solve by this method, you can do that also. Any of the two methods can be used for coupon bond. Okay. Whichever method you are comfortable. There was one more question. What is the relationship between price of the bond and YTM? So write down step 4. Step 4, write down. Come on, please reply. What is the relationship between price of the bond and YTM? Relationship between the price of the bond and YTM. The answer is there is inverse relationship between the price of the bond and YTM. There is inverse relationship between price of the bond and YTM. There is inverse relationship between price of the bond and YTM. So as the YTM will increase, the bond price will decrease. This is called inverse relationship. Now we are going to solve one question number 2a. It is based on economic value added. And please, those who are watching this video, listen to me carefully. This answer given in the institute suggested answer, to my understanding, is wrong. Okay. So we'll have to write the correct answer. Everybody listen to me. This answer of the institute is not appropriate. What is the mistake? I will tell you. So are you ready? Yes. Question number 2a for 6 marks. Just 6 marks. This was also asked in one earlier exam. Herbal Box is a small but profitable producer of beauty cosmetics. Wow, using the plant aloe vera. Use aloe vera and become beautiful. Though it is not a high-tech business, yet Herbal's earnings have averaged around 18.5 lakh after tax. Underline after tax. So PAT is given. PAT is equal to 18.5 lakhs. Mainly on the strength of its patented beauty cream to remove the pimples. Very good. The patent has, again underline, 9 years to run. Patent has 9 years to run. So the life of the patent is 9 years. And Herbal Box has been offered rupees 50 lakh for the patent right. The value of this patent right is 50 lakh. So we'll have to see what has to be done with this 50 lakh rupees, which is important. Institute have not considered the amortization of patent in the calculation of no PAT. So this point keep in mind. Herbal's assets include 50 lakh of PPE and 25 lakh of working capital. So 50 lakh plus 25 is already recorded in the books, and patent of 50 lakh is also there. So the total capital employed in the business we have to find is 125. the assets which are there and the assets which are not recorded. However, patent is not shown in the books of Herbal Limited. Assuming Herbal's cost of capital is 14%, so one good thing is that cost of capital is already calculated for you. Compute the economic value added. So this question is important. The reason being there is some mistake in the answer and student may just copy the answer as it is in the exam and they can lose marks. Okay. So write down step number 1. Adjusted NOPAT. NOPAT means net operating profit after tax. Net operating profit after tax. Now in this question, they have not given the tax rate, but they have used the word profit after tax. So we can assume a tax rate of 30% if we want. Otherwise, you can write a no, taxation is ignored. Both way it is okay. So PAT is given 18.5 lakh. Question in front of you. Question is from SFM MTP 1 March 2023. Question number 2A. You can download the question from our website vino.in. www.vino.in. You will go to free resource section and you can download this question from there. Answer I am discussing right now. So PAT write down 18.5 lakh. Will convert into PBT. Will convert into PBT. We are assuming tax rate is 30%. Otherwise, you have to ignore this line. If you ignore taxation, then don't do anything. PBT will be 18.50 divided by 70%. Because we are assuming 30% is tax rate. Tax assumption 30%. So therefore PBT would have been 26.43. Why we have done it? We have done it because this company has a patent which is not recorded in the books. Now we are going to record it, or not for the purpose of NOPAT calculation. Even if we don't record it, we have to also take into consideration the amortization of that patent. If I have a patent, then I need to consider the amortization of the patent also. So less amortization of patent. Less amortization of patent will be 50 divided by 9. 50 divided by 9, 5.56. Now note here, institute answer does not consider this calculation. ICI has not considered this, but this is a mistake. You have to consider it. Now write down adjusted PBT. Adjusted PBT will be 20.87. C minus D. C minus D. Then write down adjusted NOPAT. Adjusted NOPAT will be PBT into 70%. PBT into 70% because 30% is tax. So it will come to 14.61. It will come to 14.61. So I hope all of you have noted our answer will not match with the institute answer because we have considered amortization of patent, because we have considered tax rate 30%. Assumption write down, otherwise institute paper checker will not understand. Assumption write down tax rate is 30%. Assumption write down tax rate is 30%. Now write down capital employed. Now write down capital employed. So under capital employed, based on the information given, I will add three things: PPE, working capital and patent rights. Otherwise, if they would have given the balance sheet, I will take share capital, reserve, long-term borrowing, preference share capital. subject to any adjustment. So PP is 50 given, working capital given, patents given 50. Some student can ask why we have taken patent 50, why we are not amortizing. The amortization will be for subsequent period. Okay, amortization will not be for now, it will be for subsequent period. So therefore we'll take capital employed A plus B plus C 125. A plus B plus C 125. Now that was capital employed. Step number 3, write down. Please write down step number 3. EVA, economic value added. EVA, write down economic value added. Under that write down, first notepad write down 14.61. Understand the presentation. Some of you just write this into this minus this and the institute will deduct marks. Listen to me. To write properly. First point A, notepad, net operating profit after tax. 14.61. Step 1. Capital employed. Step 2. 125. Step 3. C. WACC, weighted average cost, given 14%. Point D. Capital charge, multiply B into C. Multiply 125 into 14% and that is 17.5. 17.5. So therefore economic value added. Economic value added will be how much? I am waiting for the answer to be given by the student. What will be economic value added in this example? Please reply. Economic value added. Yes, students. Come on. Come on, come on. Yes, reply. What is economic value added? Come on, anybody. Economic value added will be what the company has earned versus what minimum cost of capital it should earn. The difference between the two is economic value added. So that answer is 2.89 negative. So this company is generating a negative answer, negative EVA. So it's a wealth destruction. Student will write a note and conclude. Those who are following my method will write a note. Those who are following institute method, no need to write the note. So write a note. ICI answer has not considered amortization of patent. ICI answer has not considered amortization of patent. ICI has also ignored taxation. ICI has also ignored taxation. ICI has also ignored taxation. So this was answer of question number 2A for 6 marks. Question number 2B. This question is wrong because this question, the way they have asked, has become outdated. This question is on automatic cancellation. There was some change in the FEDI rule, but the institute has copy pasted the old version of this question. Because they have not given the data on the 4th February, that is 1st February plus 3 days, we are not in a position to solve question number 2B. Okay, so this question is wrong. Write down in your question book only. Okay, we have taken the correct question. It is there on our YouTube channel in some other video. Automatic cancellation, you will find it. Follow that question. Now we'll come to question number 3A. Question number 3, same question was asked in January 2021 exam for 8 marks. 3A is also for 8 marks. And this question is very different from normal question because it asks you something different. Usually this question is not asked in the syllabus, but because it was asked in January exam, because it is asked in MTP, it can be a potential question for your next exam also. Say yes or no? Yes. So should we solve? Yes. Not very difficult. With the use of some common sense, we will be able to solve it. But for the first timer, the person who is solving this question for the first time, it will be really difficult for him. Okay, because it's a very different question. So let us start. Balance sheet of Messrs. Sundry Limited on 31st March 2020 is as follows. So before that, I am going to tell you something, that we at AS Foundation, we are going to conduct a test series on FR and SFM. We have 4 test papers. You will find most of the questions in RTP and MTP are repeat questions. But the question which I have set for your exam, for your model test exam, they are different questions. You will not find those questions in the past exam, RTP or MTP. More than 90% question will be of new type. So therefore, I will suggest you that you go to our website and join our test series for FR and SFM. I am going to check the paper myself and I am going to give the feedback also. So do not delay. If you are prepared for FR SFM, you want to check your level of preparation, your feedback, you can opt for our test series. For that, go to our website vino.in. You will find on the home page only test series. You can opt for either 1 test or 2 or 3, or you can opt for all the 4 tests. Okay. So let us come to balance sheet, share capital, reserve, long-term loan, short-term loan, payables and provision. Then we have fixed asset, inventory, receivable, cash. Total sales for the year was 600 lakh. Sales for the year was 600 lakhs. The sales are expected to grow by 20% during the year. So sales will grow by 20%. So 600 plus 20%. Sales will become 600 plus 20%. The profit margin and dividend payout ratio are expected to be 4% and 50% respectively. So profit will be just 4%, and out of that you are going to pay dividend of 50%. So retention will be 50%, dividend payment will be 50% of the profit. The company further desires that during the current year, sales to short-term loan and payable, sales to short-term loan, payable and provision should be in the ratio of 4:3. Sales you have already found here. Using this ratio, you can find out how much should be short-term loan and payable and provision. It should be in the ratio of 5:3. Then they are saying ratio of fixed asset to long-term loan should be 1.5. Fixed asset to long-term loan should be 1.5. So you have to find out what will be the value of fixed asset and what will be the value of long-term loan. So this will give you long-term loan requirement. This will give you short-term loan and payable requirement. Then they are giving you debt equity ratio should not exceed 1.5. So the company also wants to ensure that their debt equity ratio does not cross 1.5. And here you will get how much will be the retained earning from this paragraph. So you will get retained earning, you will get fixed asset, long-term loan, short-term loan and provision. You are required to determine the amount of external fund requirement. So this is a question which requires that you should find out how much more funds we should raise. Out of that external fund requirement, how much will be the loan from short-term loan, how much will be the loan from long-term sources, and how much will be the equity to be raised. Very good question, new question. First, 2 minutes, try yourself. First you try yourself. Okay. Check how much you are prepared. Because it's a past exam question, they can repeat again in the exam. Anybody, what is the short-term requirement, long-term requirement and equity to be used? Now in such question we have to make one important assumption. In such question we have to make one important assumption. And that is where the student get confused, because student have asked this question to me in the past, that why they are increasing the fixed asset and the current asset also by 20%. So that is my assumption, that if sale is increasing by 20%, then fixed asset, current asset and current liabilities, payable and provision will also increase at the same rate. If you don't know this, you will not be able to solve this problem. So write down one note at the beginning of the answer. Write down this note at the beginning of the answer. It is assumed that fixed asset, current asset, payable and provision, fixed asset, current asset, payable and provision will increase at the same rate, as that of the sale. Fixed asset, current asset, because your sales cannot increase on its own, it has to be supported by increase in fixed asset, current asset also. Now write step 1. Existing fixed asset, current assets and payable and provision. Existing fixed asset, current assets and payable and provision. Existing fixed asset, current assets and payable and provision. Then right hand side rupees in lakhs. If you look at the asset side, we have fixed asset plus current asset. So total asset 1400. Total asset is 1400 less payable and provision. Less payable and provision is 200. You can see on the liability side, last line, payable and provision. Those who have joined late, we are discussing March 2023 SFM MTP. You can download from our website vino.in. This question paper, the link is given in the description box. Keep that ready. Very important question, don't ignore. So what is your existing net asset? Your existing net asset is 1200. Your existing net asset is 1200. So if sales increases by 20%, then we will assume that the requirement of your net asset will also increase by 20%. Okay. So write down step number 2, total external funds required. Total external funds required. Total external funds required. Keep answering. Let us see how much additional funds we will require. So write expected sale. External fund means other than retained earning. Other than retained earning. That means loan and issue of equity share. That is called external fund. So I need to check how much funds I require. Out of the funds required, how much will be financed by retained earning? Balance will be financed by external sources. So write down. First I need to check how much is retained earning. Profit is given, dividend payout is given, I can compute retained earning. Start. Expected sale 600 plus 20%. 600 plus 20%. Come on. 720. Because problem says sales will grow by 20%. Profit margin is given 4%. So how much will be the profit? 4% of 720. 28.80. Dividend payout ratio. Come on, dividend payout ratio. 50%. 14.4. So student will reply now. Come on, reply. What is retained earning? Yes, retained earning will be 14.4. Additional fund required will be your net assets 1200. This we have computed in step 1. 20% additional funds will be required. Even the net asset requirement will go up by 20%. So how much is the additional funds required? Check calculation. 20% of 1200, 240. We need 240 to support an increase in sale by 20%. This much will come from retained earning. This much will come from retained earning. So therefore, external funds required will be 240 total fund required minus retained earning. So from the market I have to raise 225.60. From the market I have to raise 225.60. This is total external fund required. Now we have to find out how much additional short-term loan, long-term loan and equity I have to consider. They have given you certain ratios. We have to ensure that we follow those ratios. That can be the policy of the firm. So let us first write down amount to be raised from short-term fund. Amount to be raised from short-term fund, right hand side rupees in lakhs. The question in the fourth line, third line says below the balance sheet, company desires that during the current year sale to short-term loan and payable and provision should be in the ratio of 4:3. Underline that 4:3. So write down first point is sales to short-term loan, payable and provision 4:3. Sale is given 720. Sale is given 720. I am asking the students now, can you tell me the short-term loan, payable and provision? If sale is 720, yes, how much? Short-term loan, payable and provision will be 540. 3 by 4 of 720. 3 by 4 of 720, 540. Out of that, I will deduct the payable and provision. I will deduct payable and provision. Payable and provision will be, right now in the balance sheet is 200. It will also grow by 20%. That note we have written in the beginning. So payable and provision will become 200 into 120%, 240. So therefore short-term loan required 300. Short-term loan required will be 540 minus 240, 300. Total requirement out of 540, 240 is payable, 300 is short-term loan. Look at the balance sheet given in the question book. In the question book, balance sheet short-term loan liability side, fourth line. That is 300 only. Oh my God. We desire 300. We have 300. I will not raise funds from short term because it's exactly 300 right now. So therefore amount to be raised from short term loan will be 0. As per the desired ratio of 4:3, short-term loan should be 300. Already we have 300. So therefore we don't have scope of raising funds from short-term loan. Now the next is how much long-term fund we can use. For that, there is another ratio given. Ratio of fixed asset to long-term loan should be 1.5. So write down amount to be raised from long-term fund. First point, ratio of fixed asset to long-term loan. Ratio of fixed asset to long-term loan 1.5. This way you have to present nicely in the exam. Point number B. Fixed asset will be 600 plus 120 into 120%. 20% more. Fixed asset will go up by 20%. So the student sometime asks this query, why it is 720? You have written a note at the beginning. Fixed asset will also increase by 20%. So therefore long-term loan required will be 720 divided by 1.5, 480. 720 divided by 1.5, 480. Now write down less existing long-term loan. Less existing long-term loan. Look at the balance sheet, liability side, third line. You will find 400 there. Therefore, amount to be raised from long-term loan. Amount to be raised from long-term loan is 8080. So long-term loan we have got. We have computed total external fund requirement. We have computed how much we will require from short-term and long-term. So the balance amount has to come from equity. So let us write down step number 5. Amount to be raised from equity fund. So how the steps are interrelated you can see. First we computed external fund required. Then we have computed short-term loan required to be raised, long-term loan required to be raised. So the balancing figure would be now equity fund. So point number A would be total amount to be raised from external source. Total amount to be raised from external source is 225.60 less amount to be raised from short-term loan 0. Less amount to be raised from short-term loan is 0. Less amount to be raised from long-term loan. Amount to be raised from long-term loan is 80. The previous step. In the exam you can keep mentioning step number also. Easy for the paper checker. You make his life easy, he will make your life easier. You make his life difficult, he will make your life difficult. So now the student can answer easily. I want the answer from you all. Amount to be raised from equity funds. Come on, amount to be raised from equity funds. Yes, amount to be raised from equity funds. It will be A minus B minus C. 145.60. 145.60. But there is one condition given in the problem last line. Debt equity ratio should not exceed 1.5. Debt equity ratio should not exceed 1.5. So if I am going to raise equity and loan, what will be my debt equity ratio? As long as it does not exceed 1.5, we have no problem. So student will write now verification of debt equity ratio. Verification of debt equity ratio. We are solving one very important question of March 2023 MTP question number 3A. So the formula for debt equity ratio is long-term debt upon equity. The long-term debt will be 400 plus 80. 400 in the balance sheet, 80 we are going to raise. 480. Equity will be share capital 300, reserve 200, retained earning In earlier working note we have computed retained earning, and in the previous working note we have raised fresh equity. So now let me check who will give me the correct answer of debt equity ratio and whether it is below 1.5. Please reply. Yes, come on. What is debt equity ratio? What is debt equity ratio? 480 divided by 660. 480 divided by 660, 0.73. So is it less than 1.5? Yes. So write down the debt equity ratio has not exceeded 1.5. The debt equity ratio has not exceeded 1.5. Okay. So that was my question number 3A for 8 marks. Now we'll go to question number 3B. This question they have asked several times in the exam. Most repeated question on mutual fund chapter and in your SFM syllabus also. But we will practice it again. In case if you don't want to write, you can just listen to me carefully. Mr. K has invested in 3 mutual fund schemes as given below. Date of investment, amount of investment, NAV, dividend received, and NAV on 31st March. As usual, you are required to calculate the effective yield on per annum basis. So this is my question. Effective yield on per annum basis. So what is the yield they have generated per annum in respect of the 3 scheme to Mr. K up to 31st March 19. Now these investments were made on different dates. So the student will have to calculate the number of days up to 31st March 19 and then you have to convert into annualized rate. Provide a brief comment on the course of action he should take for the future period. Very good question. That means after computing the yield, check whether he should continue to remain invested in the 3 scheme or he should sell some mutual fund and invest in some other mutual fund. So follow me, this is a good question. They have repeated in the past, they will repeat in future also. Heading, write down calculation of effective yield per annum. Calculation of effective yield per annum. Few more good questions are there, we are going to solve them. Right hand side, write down mutual fund A, mutual fund B, mutual fund C. First point A, write down investment made. Investment made is 5 lakh. Question in front of you, 10 lakh. Again 5 lakh. If you have question in front of you, it will be easy. You can download the question from our website vinod.in. The link is given in the description box. Opening NAV 10.50, 10 and 10. So can you calculate number of units that he got when he made the investment? A by B, number of units A by B. You will solve, I will check. Yes, first one A, 5 lakh divided by 10.50. 47,619.048. Very good. Next, 1 lakh and 50,000. Then you write down closing NAV. Closing NAV on 31st March 19. Given in the table, last line. 10.40, 10.10, 9.80. So can we calculate the total NAV or total investment value on 31st March? Yes. So that will give me closing investment value. This is opening investment value. This line E will give you closing investment value. Multiply and write yourself. Yes, student, multiply. First you will get 495,238.099, second 10 lakh 10,000, third one 4 lakh 90,000. One more return you have got in the form of dividend. So write down dividend received. Write down dividend received, which is given in the question, second last line of the table, 9500, 15,000 and 5,000. Now the student will have to perform one task for me. Investment was made on 1st of December 2018. 1st December 18, first investment, to 31st March 19. Number of days. Count the number of days and give me the answer. How many days he was invested in mutual fund A? You can answer in months or days, but institute has given the answer in days in most of the suggested answers, and this MTP also. So I will also take the answer in days. Count. Please reply. Yes. First is 121 days, then 90 days, and then 31 days. Okay. Now write down effective yield per annum. Effective yield per annum will be your dividend plus closing investment E minus opening investment A and divide by opening investment A into 365 divided by G, that is number of days, into 100. So this is a very easy calculation. Take on your calculator 9500 plus 495,238.099 minus 5 lakh divide by 5 lakh into 365 divide by 121 into 100. Calculate. You will get 2.859% per annum. 2.859% per annum. Now next one, in the same way you will get 10.139%, but the last one is negative, minus 11.774%. Now if you compare the three, this is a negative return generating mutual fund. This is a positive return generating mutual fund, but compared to B, it is very, very low. So after seeing the performance, what is your advice? Will you remain invested in all the three mutual fund, or do you want to change the course of action? Do you want to change the course of action? Come on, reply. Would you continue to remain invested, or would you like to redeem unit C and A and invest in B? So the answer is, now this type of question cannot have any fixed answer, because the time that we have considered is very small period of around 3 months, 4 months, 1 month. But we are a student, so we'll have to give some reply. So you will say C has negative yield. C has negative yield, but that was only for 1 month period. Now this kind of question cannot have any definite answer. A has a very low yield. A has a very low yield. Therefore Mr. K should redeem investment in scheme A and scheme C. Redeem investment in A and C and invest in scheme B. So based on the limited data, this is the answer. Otherwise, it can vary from person to person. They have also not mentioned about what is the type of the scheme. Are they exactly similar scheme or different schemes? Anyway, this is the answer, because I don't have enough information about these three mutual fund types. What is the view of the investor? Now we are going to solve one really good question. You write down very good question. For exam purpose, such questions should be asked so that the student's intelligence and preparation level can be tested. Okay. Question number 4A. A proposed foreign investment involves creation of a plant with an annual output of 1 million units. So first you underline output 1 million. The entire production will be exported at a selling price of USD 10 per unit. So the price is USD 10 per unit. Add the current rate of exchange. Underline current rate of exchange, double underline. Dollar cost of local production equals USD 6. So selling price is $10 at current exchange rate. At current exchange rate it is $6 per unit. Dollar is expected to decline by 10% or 15%. So dollar is expected to decline by 10% or 15%. Very good. If dollar will decline, your cost will reduce. If dollar will decline, your cost will reduce. The change in the local cost of production and profitability from the expected current level will be as follows. And probability from the expected current level will be as follows. So whether dollar will decline or not, it depends on probability. So there is a 0% chance that dollar will decline. So if dollar will decline by 0%, 0.4 probability. So if dollar does not decline, your cost will remain 6. If dollar declines by 10%, your local cost of production will decline by 0.30. So from 6 it will become $5.70. $5.70. And if the dollar declines by 15%, there will be additional reduction of 0.15. So it will be 6 minus 0.45. So cost per unit will become 5.55. So there are three possibilities. Dollar may decline by 0%, 0.4 probability. Dollar may decline by 10%, 0.4 probability. Dollar may decline by 15%, 0.2 probability. Accordingly, your cost per unit will change. The plant at the, underline again, current exchange rate will be have a depreciation of USD 1 million. At current exchange rate, the depreciation will be 1 USD million. Assume local tax rate is 10%, which means depreciation figure will also change. Depreciation figure will also change if dollar is expected to decline. If dollar is expected to decline by 10%, the depreciation will also change from 1 million minus 10%. If dollar is expected to decline by 15%, depreciation will be 1 million minus 15%. Okay, very important question. Student can miss this adjustment because the dollar can fluctuate and the depreciation they have calculated is based on current rate. So if current rate will change, the depreciation amount will also change. You are required to calculate annual CFAT under all the different scenarios of exchange rate. What is the meaning of this question? The meaning of this question is that scenario 1, scenario 2, scenario 3. Your cost will change, your depreciation will change accordingly, and therefore you will have different CFAT under different exchange rate. So three answers you will have to calculate here. If dollar declines by 0%, dollar declines by 10%, dollar declines by 15%, what will be your CFAT? An expected value of CFAT. Expected value of CFAT will be CFAT computed above into respective probability. Each CFAT will have a probability, and then viability of the investment proposal means you have to find NPV assuming an initial investment of 25 million USD in plant and working capital. So this is your initial investment, this is your required return 11%, and on the basis of CFAT arrived at under option 2. So for calculating NPV, this CFAT of second step you will take. The CFAT will grow at 3% per annum in perpetuity. Very important. This project has infinite life. So CFAT will continue to grow at the rate of 3% per annum. So you have to apply the formula of perpetuity growing at a constant rate for computing the PV of cash inflow. Okay, so very good question. I am starting now. Keep notebook, calculator, pen, pencil ready. Must practice now. Okay, don't watch. Be a participant. So write down. Otherwise, institute answer you may not understand certain points, how they have calculated. So step 1. Calculation of annual CFAT under 3 scenarios. So first you tell me, are you writing or not? Say yes or no. In your comment box, write yes, we are writing. If you are not writing, then I can explain fast. This is going to be the very important question from this MTP for next exam. Trust me. So write down 3 columns. Write down 3 columns. First write down scenario 1 whose probability is 0.4. Scenario 2 whose probability is again 0.4. And scenario 3 whose probability is 0.2. So those who are writing will say yes, we are writing. First point A, write down. Suraj is writing. Very good, Suraj. Write down annual sales in unit. Annual sales in unit. This question you should revise a day before the exam when you go for your exam. So quantity sold is 1 million. We can write 10 lakh. We can write 10 lakh. Point B, selling price per unit. Now this question does not state about selling price. It only talks about cost and depreciation which are going to change as a result of change in exchange rate. So we are also going to keep selling price constant $10. Question does not talk about change in selling price. Hash is also writing. Very good. I am happy. Anybody else who can confirm is writing. Then I will explain in detail and I will go a little slow also. Now cost per unit will change. Cost per unit will change. Look at the question. If dollar does not decline, 0% decline, cost will remain $6. But if dollar declines by 10%, cost per unit will reduce by 0.3. So 6 minus 0.3. In bracket write 6 minus 0.3. Sometimes the institute does not give calculation and the student is wondering how did I got 5.7. Similarly, in the last column, you write 6 minus 0.3 minus 0.15. 6 minus 0.3 minus 0.15. So that comes to 5.55. Profit per unit. Profit per unit in dollar B minus C. See the presentation, you will understand everything. 10 minus 6, 4. 10 minus 5.7, 4.30. 10 minus 5.55, 4.45. So now write down total profit, or you can write total contribution. Whatever you want to write does not affect your answer. Total profit or contribution is quantity sold into profit per unit. Quantity sold into profit per unit. Without calculator today you will try. Yes, Suraj, what is the answer for scenario 1? 10 lakh into 4. 10 lakh into 4. 40 lakh. Yes, Mr. Hash. Second scenario, what is total profit? Second scenario, total profit. 10 lakh into 4.3. 43 lakh. You don't require calculator. Last one, 10 lakh into 4.45. Yes. 10 lakh into 4.45. 44 lakh 50,000. But I need to deduct depreciation also. I need to deduct depreciation also. Depreciation, if there is no change in exchange rate, will be 10 lakh, 1 million. But if exchange rate changes, if exchange rate declines by 10%, depreciation will also change. Suraj is right. Very good. 9 lakh. Bracket write down 10 lakh minus 10%. In the institute answer they have not given this kind of calculation, and then student get confused. How did he get? Next column, yes. Next column, 8 lakh 50,000. 8 lakh 50,000. 10 lakh minus 15% because dollar will decline by 15%. Okay. Now we will compute PBT. How do you get PBT? PBT will be your total profit before depreciation minus depreciation. Minus depreciation. Without calculator try. 40 minus 10, 30 lakh. 43 minus 9, 34 lakh. 44.50 minus 8.50, 36 lakh. Now write down less tax at the rate of 30%. It's given in the problem. Tax rate is 30%. 9 lakh. Second column 10 lakh 20,000. Third column 10 lakh 80,000. Yes, Suraj, reply fast. You will reply, then only I will write CFAT. CFAT will be PBT minus tax, add back depreciation. PBT minus tax plus depreciation, G minus H plus F, G minus H plus F. So who would like to reply? First column 31 lakh. Second column, very good. Bujade, very good. Come on, next. Second column, 32 lakh 80,000. Come on, third column. Please reply. Third column, 33 lakh 70,000. 33,70,000. Very good. One person has replied 35.2. 35.2 is not right. Please check again. 35.2 is not right. Please check again. Now we'll go to next part of this question. What is expected value of CFAT? Just you have to multiply the previous three answers with their probabilities. Okay, so write down step 2, expected value of CFAT. Expected value of CFAT. Expected value of CFAT. CFAT probability expected value in dollar. So first you write down the previous three answers: 31 lakh, 32 lakh 80,000, 33 lakh 70,000. Probability given in the question book 0.4, 0.4, 0.2. Multiply, add. Give me the total of the last column. Give me the total of the last column. 12 lakh 40,000. Second, 13 lakh 12,000. Third, 6 lakh 74,000. Yes, give me the total. Come on, come on. Total of the last column. Total of the last column. The answer comes to $32 lakh 26,000. $32 lakh 26,000 is your CFAT. Okay. Now the next is finding NPV. If NPV is positive, you will accept the proposal. The problem says that CFAT will grow at the rate of 3% every year. CFAT will grow at the rate of 3% every year. So one Mr. Hash has given the reply 32.36, but I think it is 32.26. Please check again. So last step will be NPV calculation. Present value of future CFAT will be calculated by applying the perpetuity formula A upon R minus G. Okay, that you have studied in CPT or foundation maths course also. For an annuity growing at a constant rate, the formula is A upon R minus G. So write down step number 3, calculation of NPV. Calculation of NPV. First we will find out PV of CFAT. PV of CFAT is equal to, the question says this cash flow will grow at the rate of 3% per annum forever. So I will take 32,26,000 into 1.03 divided by the discount rate is 11% and the growth rate is 3%. So in the denominator we will write 11% minus 3%. Please solve, otherwise you will say that I only give the answer. I am giving you a chance to reply. Reply, please reply. What is the answer of this? So the answer is, check the answer, 4 crore 15 lakh 34,750. And point B, write down less initial investment. Initial investment is 2 crore 50 lakh. Initial investment is 2 crore 50 lakh. Go check the NPV now. A minus B. NPV A minus B. NPV A minus B. $25 million is 2.5 crore. So NPV A minus B is how much? Yes, come on, come on. 1 crore 65 lakh 34,750. Is it positive or negative? Positive. If it is positive, what will you say? Should the project be accepted or rejected? So just write a note below. As NPV is positive, they have not asked you to comment. If you want to comment, you can comment. NPV is positive, project is acceptable. NPV is positive, project is acceptable. Another question which is highly repeated again, it was repeated earlier also. It is based on dividend equalization concept. Based on dividend equalization concept. That is, if a unit holder joins the mutual fund in between the year, mutual fund has already generated some income. So this new investor should not get the benefit of the income that is already generated by the mutual fund. Similarly, if a unit holder redeems the units, he should be entitled to the income already generated by the mutual fund. So based on that concept, this question of dividend equalization was asked. It was earlier asked in the exam also in year 2015. Let us read and try to solve. Those who have not done this question earlier, for him it is very important. On 1st January 2020, an open-ended scheme of mutual fund had outstanding unit of 300 lakh with a NAV of 20.25. So this is my opening NAV. Very important for solving this. And plus we have opening outstanding unit 300 lakh. At the end of January 2020, it had issued 5 lakh units on an opening NAV plus a load of 2%. Load is charged to the investor when he joins a mutual fund, when he acquires units from a mutual fund. So 2% of 20.25 will also be recovered from him, adjusted for dividend equalization. So whatever income per unit the mutual fund has earned till January 2020, that will also be recovered from him. At the end of February 2020, that means after 1 month, it has repurchased 2.5 lakh units at an opening NAV. Opening NAV is 20.25 minus 2% exit load and adjusted for dividend equalization. So the person who is redeeming his unit, he will also be entitled for income earned by the mutual fund till the date he is redeeming. So this fellow will get opening NAV minus 2% plus dividend equalization per unit, which we have to compute. Now they are saying at the end of March 2020, it had distributed 70% of the available income. So whatever income it has generated in the 3 months period, 70% was paid in the form of dividend. In respect of January to March quarter, for this 3 months period, following additional information is available. The portfolio value appreciated by 460 lakh. This you will add for closing NAV calculation. Plus you will also add income generated during the 3 months period minus dividend paid during this 3 months period. So that will help you to compute the closing NAV on 31st March. Calculate income available for distribution. So we'll prepare one small income chart. Then issue price at the end of January, already explained to you, opening NAV plus load plus dividend equalization per unit. repurchase price at the end of February, opening NAV minus exit load plus dividend equalization per unit, and then you have to find closing NAV per unit on 31st March. A very good question. Write down again. Those who will prepare before going to the exam this question, then you can easily answer. But if you are not prepared, then you will struggle in the exam. Trust me. Okay. So I will ask you to give it a 5-star rating, because such question requires last minute revision also, so that you don't miss out any concept. Write down calculation of income available for distribution. This is your first answer. Calculation of income available for distribution. Draw 3 columns on the right side. Unit in lakhs, per unit, total amount rupees in lakhs. Presentation is also important. Please share this video with your friends also. They will also be benefited. This is a good paper for revising SFM. Point A, write down income from January. Go to your question book. Go to your question. Income in January you will see is 24 lakh, and you had 300 units at this point before new units were issued. So you will take 24, divide by 300, you will get 0.08 as income per unit. Very important, the presentation aspect of this. Now, since the mutual fund has earned 0.08 per unit, they will recover this from the new investor, so that the new investor does not benefit from the income already earned by the mutual fund before he became the unit holder. So 0.08 will also be recovered from the new investor. So write down, add dividend equalization collected on issue. Add dividend equalization collected on issue. Add dividend equalization collected on issue. So they have issued 5 lakh unit. They will collect 0.08 per unit. So total dividend equalization collected is 5 into 0.08, 0.40. That is the logic. So new investor does not benefit from income already earned. Point C, we'll take a total first. If you have the answer book, you can check there also. 305.08, 24.40. Please do not add per unit. Some students are asking why you are not adding 0.08 plus 0.0. This is a balancing figure. This is rate per unit. Now write down February. In February, they have earned 36 lakh. Can you see 36 lakh? Question. Divide by 305 now. Divide by 305. So now you have per unit income 0.1180. Per unit income 0.1180. So total will be 305 units. And total income is 60.40 here. 60.40 divided by 305. We will get 0.1980, or you can just add 0.08 plus 0.1180. Both are okay. Now write down less dividend equalization paid on repurchase in February 2020. So some unit holders have redeemed their units in February. Now they were holding the mutual fund till February. So they are entitled to the income already earned. They are entitled to income already earned till February. So company will have to give their share of income. So it will do justice to both the one who joins and the one who redeems, they get their share in income till the date of his redemption, and the one who joins in January, he will have to pay his share of income the company has already earned. So how many units were redeemed? 2.50 lakh. Per unit dividend equalization 0.1980. So total dividend equalization paid on redemption multiply, you get 0.495. Again take the total of these two. 305 units minus 2.50 redeemed. Balance 302.50. Rate will be same and the total will be now 59.905. Now write down March income. In March they have earned 47 lakh. You can see in the question, divide by 302.50. 47 divided by 302.50, your per unit income is 0.1554. Again take the total of G plus H, 302.50, 0.3534, and you will get 106.905. So you can take this first, divide by unit, you will get per unit. One more adjustment happened in this period. They have paid dividend. They have paid dividend which is 70% of the income. 70% of 106.905. So total dividend paid, calculate 70% of 106.905 is 74.8335. Divide by 302.50 units, 0.2474. So now your balance income left 302.50 minus this 0.3434 minus 2474, 1060. Last column 32.0715. So this is the balance income which they are still holding after paying the dividend. Is it right? Now the three small questions. First, below that write down step 2, issue price at the end of January. The one who bought the units, at what rate units were issued to him. So he will be charged three things: opening NAV 20.250, add entry load 2%, 0.405, add dividend equalization collected on issue price. Step 1. Dividend equalization you will see in your point number B, previous table point number B. How much is that? Previous table point number B per unit 0.08. You will see in the center, point B, middle column. So therefore the issue price for January end is A plus B plus C. How much is that? 20 point, add this three number, 735, 20.735. In the similar way, you have to compute the repurchase price at the end of February. Right, repurchase price at the end of February. They have said take opening NAV of January. Read the problem, clearly mentioned. At the end of February, it had repurchased 2.5 lakh unit at an opening NAV 20.25 minus exit load. When the mutual fund redeems the unit, they don't pay NAV, they pay less than that. When they sell units to the investor, they add entry load. So that is 0.405 exit load. But the unit holder should be compensated their share of income till February. So dividend equalization will be paid to them Go to step 1.5 middle column, step 1.5. Previous step 0.5 you will see 0.1980, 0.198. Therefore, repurchase price, total of these three, one is negative in the center, so that comes to 20.043. Check the answer, 20.043. 20.043. Is it right? Now the question is closing NAV on 31st March. So we will take opening asset, we will add appreciation in the portfolio, we will add income generated for 3 months, we will deduct dividend paid, we will add fresh unit issued, and we will deduct amount paid on redemption. So this will give me closing value of net asset. Divide by number of units at the end. That will give me closing NAV. Okay. So we have to just put these numbers, already calculated everything, and you will get the answer. Very good question for NAV. Right. Step number 4. NAV at March end. NAV at March end. Please write down point number A. Opening net asset. Opening net asset. Opening net asset is 300 lakhs units into 20.25 rupees NAV. Please check the answer, 6075. 6075. Everybody should participate. Is it right? Add portfolio value appreciation. Portfolio value appreciation will increase the NAV. 460. Add issue of fresh unit. Fresh unit will bring cash. 5 lakh into 20.735. This we have computed in step 2. Issue price of 5 lakh unit was 20.735. So this is 103.675. Then income earned in 3 months, 24 lakh, 36 lakh, 47 lakh. So total income earned over 3 months period, 107. Less units repurchased. Less unit repurchased. 2.5 lakh unit into 20.043. This 20.043 is the repurchase price we computed in step 3. So that will reduce my net asset. There will be cash outflow. There will be cash outflow. And we have also distributed income. Go to step 1 point J. Step 1 point J. How much dividend was distributed? Last column. Point J, last column. 74.8335. Right. Now please, at least now please tell me how much is the net asset. Take total of point number A to F. A, B, C, D, E, F. Yes. Reply please. Suraj, Harsh. Total of the last column. That will give you closing net asset value. Closing net asset. You have to add A, B, C, D, E, F. A to F. Yes, yes, yes. Reply fast. $6620.734. Very good. Closing number of units. Closing number of units. 302.5. Opening was 300. Add 5. And redemption 2.5. So at the end of 31st March, there are 302.5 lakh unit outstanding. So who will give me the closing NAV per unit? Fast. Closing NAV per unit. Closing NAV on 31st March. You will take G divided by H in rupees. Other figures are in lakhs. Other figures are in lakhs. 21.8867. 21.8867. Very good. 21.8867. So this way of presentation will help you to get full marks. With all calculations written, nothing is done directly on calculator. Okay. You have to understand the concept also, you have to present it also, and you have to ensure that you are doing it on right time also. That helps you to get very good marks. Now we'll come to a very easy question of portfolio management 5A. There is some mistake in the question, that also we'll discuss. This was asked in earlier exam also. This is an old exam question, they have repeated again with the same mistake which was there in the original question also. So just copy paste exercise. A company has a choice of investment between several different equity oriented mutual funds. The company wants to invest rupees 100 lakh. Details of mutual fund A, B, C, D, E and beta. These are their respective betas. So what is the first option or plan 1? Company invests 20% of investment in the first two mutual funds. 0.20, 0.20. So how much is the balance? 0.60. And the balance in equal amount in CDNE, 0.60 divided by 3, 0.20. So they could have directly written the company would invest 20% in each. This is such a gross wastage of human time and talent. Question is, what is the beta of the portfolio? I don't think there can be an easier question than this in your entire study material. You have to just compute weighted average beta. Weight is 0.2, 0.2, 0.2, 0.2, 0.2. And then what about plan 2? Same thing. The company invests 15% of its fund in C, 15% in A, 10% in E, and the balance in equal amount in other two mutual funds. So already we have exhausted 0.40. So remaining is 0.60 divided by 2, which means the investment in B and D would be 0.3 each. What is the beta of the portfolio? Multiply, add, beta of portfolio is weighted average beta. If the expected return of the market portfolio is 12% RM, beta of the market portfolio is 1. Everybody knows that. Even if it is not given, it doesn't matter. What will be expected return on the portfolio in both the above plans? So what is the mistake? RF is missing. RF is missing. Oh my God. RF is missing and still they are asking you to compute the expected return of the portfolio. So that was the mistake, and we will solve by assuming RF. We will also solve by ignoring RF. The last answer I will solve 2 times. One by assuming RF, one by ignoring RF. First answer first. Step number 1. Portfolio beta under plan 1. Portfolio beta under plan 1. So here we have decided that the weight will be 0.2 in each of them. Draw 4 columns as usual. Mutual fund, proportion, beta and weight into beta. Proportion means weight. Proportion means weight. So first I will give you the name of mutual fund ABCD, then I will give you weights 0.2 each. Beta you copy from the question. Beta copy from the question. And now the students will give me the total of last column. I just don't show the answer. This is style of presentation, style of teaching. Because we have limited time, we use our technology and try to solve maximum question in less time. Anybody for the total of last column? So you will multiply and keep on taking total also in memory plus. The total of the last column will be 1.20. This I will require in the last answer also. 1.20. Now write down portfolio beta under plan 2. Same way you will solve. Weights will change. Draw 4 columns. Draw 4 columns. Mutual fund, proportion, beta, weight into beta. Mutual fund ABCDE, proportion will be 0.15, 0.30, 0.15, 0.30, 0.10. And beta is given in the question. Multiply, take the total. Check, you are getting 1.315. So the answer for the second plan will be 1.315. Now I will give you a note. If you dare write this in the exam, there is an error in the question. There is an error in the question. And what is the error? The risk-free rate is missing. The risk-free rate is missing. Let us assume RF equal to 6%. And expected return is equal to required return, because CAPM formula calculates required return. CAPM formula calculates required return. The question has asked us to compute expected return. So we will assume that expected return is equal to required return as per CAPM. So you can apply the CAPM formula. Write down one small table with 2 columns. Plan and expected return of the portfolio. Expected return of the portfolio formula is RF plus beta into RM minus RF. RF plus beta into RM minus RF. Okay. I will solve plan 1 where beta was 1.20. Calculate and reply 6 plus 1.20 into 12 minus 6. I hope you can do it. 13.2%. For plan 2, the beta is 1.315. 6 plus 1.315 into 12 minus 6. 13.89%. 13.89%. Now this answer institute may give it as a wrong also, because we have assumed RF. Suppose RF is 0, then what will be the answer? So I am going to give you one more set of answer which we will call ICI answer. There are 3 types of answer: right answer, wrong answer, ICI answer. So in the exam you can write ICI answer also. So write down ICI answer, plan expected return. As per ICI formula, they have taken RF as 0, so your answer becomes market return into portfolio beta. Market return into portfolio beta. So for plan 1, 12 into 1.2, 14.4%. And for plan 2, 12 into 1.315, 15.78%. Now the student is asking what we should do. This much will not take extra time. It will not take more than 45 seconds. So I will strongly recommend, if this question is asked in this format, write both the answers in the exam. Okay, write both the answers in the exam. Play safe. Otherwise they might deduct marks. One more important question for 8 marks. Question number 5B. You must have solved similar questions in regular classes. It was repeated in the past exam also. So they have taken many questions, I think almost all questions, almost all, not all, but almost all questions from past exams. We are going to conduct a test series. You can join anytime, you can appear anytime. Go to our website vinod.in and take admission for SFM and FR mock test paper. There are 4 test series. You can take any of them anytime. You will write the answer, send us the scanned copy, or you can take photo and send us to us. We will check it, write the comment and return the copies back to you. Okay, so come to question number 5B. IB is an Indian firm. It has a subsidiary in Japan. And Jackie, a Japanese firm, has its subsidiary in India and pays the following interest rates. Floating rate in India, if IB borrows, it is BPLR plus 0.50%. Okay, bank prime lending rate plus 0.50. But if Japanese company borrows, it will have to pay BPLR plus 2.5. So who has a better position here? IB, strong. So we'll call IB is strong in floating rate. Japanese yen fixed rate to IB is 2%, to Jackie is 2.25. So even on fixed rate, IB is strong. So IB is a strong company relative to Jackie. So what is the requirement? Jackie wishes to borrow rupee loan at floating rate and IB wishes to borrow JPY at fixed rate. So the requirement is, for IB it is fixed, for Jackie it is floating. So independently if they borrow, IB will have to pay 2% and Jackie will have to pay BPLR plus 2.50. So if they have to swap, first IB will borrow at floating, Jackie will borrow at fixed. Then they will enter into swap arrangement. The amount of loan raised by the two firms are equal at the same exchange rate. So amount is equal. A financial institution may arrange a swap and requires 25 basis point as commission. So whatever is the benefit of swap, 25 basis point means 0.25% will be commission of the financial institution who is going to arrange the deal. Gain, if any, will be shared by the two firms equally. Underline equally. Find out whether a swap can be arranged which will be beneficial to both the firms. So here, which is the strong company? IB. IB will have to first borrow in floating rate. Jackie will borrow at fixed rate and then they will swap. So the benefit in floating will be 2%, but loss in fixed will be 0.25. Still they will be able to save as a group 1.75%. Okay. So can a swap be arranged which will be beneficial to both the parties? The answer is yes, because together they will save 1.75%. Out of that 0.25 they will give to the commission agent. Still they will save 1.5, which they are going to share equally as 0.75 and 0.75. What rate of interest will the firm end up paying? So both party will save 0.75 compared to what they would have paid had they gone on their own in the market. Had they gone on their own in the market, IB would have paid 2%, but now it will save 0.75. So it will be 2 minus 0.75. Jackie would have paid BPLR plus 2.50. It will save 0.75. So Jackie will pay BPLR plus 2.50 minus 0.75. So that will be the effective interest rate the two firms will end up paying. Okay. So we are going to solve this very easy question by first writing a note for your future understanding. So I will recommend that you should write this note for understanding purpose. Otherwise, if you don't want to write, you can skip it. IB is the strong company. IB is the strong company because it has advantage in both markets. Because it has advantage in both markets. IB wants to borrow in JPY fixed interest rate, and Jackie wants to borrow in INR floating rate. Jackie wants to borrow in the INR floating rate. The swap will be possible. The swap will be possible only if the difference in floating rate is more than the difference in fixed rate. This is very important line, difference in floating rate, because the strong company will first borrow in floating rate, so that benefit should be more than the loss in fixed rate. Then only swap is possible. Many times the student asks this question, how do we know whether swap is possible or not? So if the strong company is borrowing at floating rate, and if the difference in floating rate is more than the difference in fixed rate, then the swap will be possible. Now write down step 1. I will write the answer in very simple way compared to the institute's answer. So step 1 will be calculation of net difference. Right hand side 3 columns, IB, Jackie, difference. Floating rate. Point A, floating rate. If IB borrows BPLR plus 0.5%, if Jackie borrows BPLR plus 2.5%, so the difference is 2%. Fixed rate. If IB borrows 2%, Jackie borrows instead of IB, then they will have to pay 2.5. So on floating rate you can see the gain is 2%, but on fixed rate the loss is 2.5%. Still there is a net gain of 1.75%. Still there is a net gain of 1.75%. So now step 2 will be calculation of net saving, because out of that 0.25 you have to share with the commission agent. So write down calculation of net saving. Point A, net difference 1.75% as per step 1. Commission rate 0.25%. Therefore net saving A minus B, net saving 1.5%. 5%. Now the question says this net saving will be shared equally by the two parties. So step number 3, in a very simple manner, write sharing of gain. Sharing of gain. Presentation in simple form, easy for everybody to understand. Company IB gain, half of the gain will be enjoyed by each company. So 50% of 1.5, 0.75, Jackie will also get 0.75. So this is sharing of gain by two parties. What they were paying directly to the market, they will pay 0.75 less. So my last step will be step 4, effective interest rate applicable to each party. Effective interest rate applicable to each party. Under that two columns, IB and effective rate. So IB would have paid 2% on its own. It saves 0.75. So therefore effective rate is 1.25. Jackie would have paid BPLR plus 2.5. It saves 0.75. So the effective rate is BPLR plus 1.75. Okay. This was the answer of this very good question. Another very good question which must be practiced before the exam. Otherwise, you may find it difficult in the exam. This question has some new adjustment. Write down very good question. Question is Long Limited is planning to acquire Tall Limited. Wow. With the following data available for both the companies. Long and Tall. Expected EPS, expected DPS. Underline the word expected. It means it is D1. Number of share, current market price. If I multiply these two, this will give me market capitalization of the two companies. As per an estimate, Tall Limited is expected to have a steady growth of earning and dividend to the tune of 6% per annum. So Tall Limited is growing on its own at 6%. However, under the new management, the growth rate is likely to be enhanced to 8% per annum without additional investment. But if it merges with Long, the growth rate will be 8% without additional investment. So it means the price of the share will rise because of high growth rate. Calculate the net cost of acquisition of Long Limited. Net cost of acquisition, if 60 rupees is paid for each share of Tall Limited. So net cost of acquisition means consideration paid minus value of Tall Limited. Consideration paid will be 60 rupees into number of share, that is your consideration paid, and the value of this company would be 50 rupees into number of share. So the difference is the net cost of acquisition, what you paid versus what you got. Second, if the agreed exchange ratio is 1 share of Long for every 3 shares of Tall, in lieu of cash acquisition. So this is cash acquisition. This we will call stock acquisition. And here the ratio is 1:3. In lieu of cash consideration, what will be the net cost of acquisition? Same problem. What will be the net cost of acquisition? So consideration paid minus value of Tall Limited will be the net cost of acquisition. So we'll have to find out consideration paid in both cases and what is the gain from acquisition. what is the gain from acquisition. So what is the total value after acquisition minus total value before acquisition, that is the gain of acquisition. So Susan has said 180 lakh. What is that 180 lakh? I have not understood. The net cost of acquisition is 180 lakh. Okay, so you are right. Very good, Susan Matthew. So let us solve one by one. Question is lengthy but easy. You require practice. Okay, Susan, write down properly. Case 1, cash deal. Net cost of acquisition. Net cost of acquisition will be consideration paid minus the value of Toll Limited. Right hand side you can write rupees in lakhs if you want. Consideration paid is, there are 18 lakh shares in the books of Toll Limited and we have decided to pay 60 rupees in cash per share. So that is equal to 1080 minus value of Toll Limited. There are 18 lakh shares and the market price is 50. So you are acquiring a company of 900 lakhs by paying a consideration of 1080 lakh. So that is called net cost of acquisition. Net cost of acquisition would be 180 lakh in cash deal. 180 lakh. Now write down case 2, stock deal. Case 2, write down stock deal. Under that we will have to find out what will be the market price per share of Toll Limited after it merges with Long Limited. To calculate the market price, we will require D1, which is given, cost of equity and growth rate. Now cost of equity of Toll Limited is right now not given. So using the dividend, the price and the current growth rate, first we will find out the cost of equity of Toll Limited. First we'll find out the cost of equity of Toll Limited, because this I will require to find out what will be the market price when the growth rate is 8% under the new management. So step number 1 will be calculation of cost of equity of Toll Limited. Calculation of cost of equity of Toll Limited. K is equal to D1 upon P0 plus G. All figures are directly available in the question. 3 by 50 plus 0.06. So the answer is 12%. Just check. Using this 12%, I will find out what will be the revised share price of Toll Limited. Write down, write down, growth rate of Toll Limited after merger will be 8%. Growth rate will be 8% after merger. So therefore, write down step 2, market price of Toll Limited after merger. Market price of Toll Limited after merger. Market price of Toll Limited after merger. P0 equal to D1 upon K minus G. D1 upon K minus G. D1 upon K minus G. Yes, please reply. What will be the answer now? D1 will be 3. Cost of capital computed earlier 12%. New growth rate will be 8%. So yes, anybody? The answer is 75. So their share price now will become 75 rupees. Share price will be 75. So total market capitalization will also change. Total market capitalization of TOL Limited after merger. So what will be the worth of this company after merger? Write down step 3. Value of TOL Limited after merger. Value of TOL Limited after merger. 75 rupees into 18 lakh shares. 75 rupees per share into 18 lakh share, because the value per share you have calculated for TOL Limited. So multiplied by TOL Limited number of shares. You can ask, can we multiply by 6 lakh share? No. So this is 1350 lakhs. 1350 lakhs. Now write down calculation of post-merger market price. Calculation of post-merger market price. Calculation of post-merger market price. Why do we require this? Because this is a share deal. So I need to calculate what is the value of the shares we have given to TOL Limited and compare that with the existing market value of TOL. The difference will be net cost of acquisition. So for that I will require post-merger market price per share. Post-merger market price per share. Right hand side rupees in lakhs. Right hand side rupees in lakhs. So post-merger market value would be the total market capitalization of Long Limited plus the total market capitalization of TOL Limited. And the market capitalization of TOL Limited I will take based on the revised calculation which we have done just now. So please write down total market capitalization of Long Limited 30 lakh share into 180. 30 lakh share into 180, 5400. Nothing is given about Long, so we'll assume that Long Limited's market capitalization will be the same. Market capitalization of TOL Limited after merger. Go to previous step 3. You will find 1350 there. So now if the two companies merge, the combined market capitalization of the two companies would be A plus B, 6750. The combined market cap will be 6750. And the total number of share after merger will be, already this company Long has 30 lakh shares. You can see in the first column, third line. And they are going to issue shares to TOL, which will be in the ratio of 1:3. So 1/3 of 18 lakh, they are going to issue 6 lakh shares. The total number of share after merger will become 30 lakh plus 6 lakh. So write down 30 lakh plus 1/3 into 18 lakh, which is how much? 36 lakh. So value per share, you will take C divided by D. In rupees write down, in rupees, value per share in rupees, 187.50. 187.50. Now understand, we are going to issue 6 lakh share and this will be the market value of the company after merger. So the consideration paid in the form of shares will be 187.50 multiplied by 6. Compare that with the current market capitalization of TOL. The difference will be the net cost of acquisition under the share deal. So write down below step number 5, calculation of net cost of acquisition. Calculation of net cost of acquisition. Right hand side rupees in lakh. First point A, gross cost of acquisition. 6 lakh share into 187.50. This is what you are paying to the target company, 1125. Compare that with the existing value of TOL Limited, existing value of Toll Limited on standalone basis. 18 lakh share into 5900. So a company which is worth 900, you are paying 1125 to acquire this. A company whose market value is 900 is acquired for 1125 lakh. So the net cost of acquisition will be, yes, reply please, A minus B. Net cost of acquisition will be 225. Very good. One last answer is, what is the gain from acquisition? Gain from acquisition will be total market capitalization. Total market capitalization before merger versus total market capitalization after merger. The difference will be the gain from merger. Okay. So write down step 6. Is it 6 or 5? 6. Calculation of gain from acquisition. We are going to compare market capitalization of both companies after merger and before merger. That is the gain from merger. First A, total market capitalization after merger. Go to step number 4, previous step 4. In the step number 4, point number C, you will find this number 6750. So I am not calculating again. Point B, value of the two companies separately on a standalone basis. Long Limited is 5400, already calculated. Toll is 900, already calculated. An earlier working note 6300. So gain from acquisition is 6750 versus 6300. So after they merge, the total market capitalization will increase by 450 lakh. Less net cost of acquisition. Suppose institute has not asked this. This is extra I am dictating. What was the net cost of acquisition to Long Limited? 225. So if you really ask how much is the net benefit to Long Limited, the net benefit to Long Limited would be only 225, because out of 450, 225 additional amount they have paid to Toll Limited. So this is the answer of this question. Now we'll solve one last question, 6b. This is based on future contract, and you have to learn how the initial margin, maintenance margin and margin call is calculated. Highly repeat question again. Only you should know the basics and then you will be able to solve. Okay. So the question is, the price of March Nifty future contract on a particular day was 9170. So you can enter into a future contract at 9170. The lot size is 50 unit. So 9170 into 50 is the value of one lot. Initial margin is 8%. So when you enter into a future contract, you have to pay an initial margin which is 8% in this example, and maintenance margin is 6%. That means the value of your margin account should not fall below 6%. If it goes below 6%, you will have to bring margin money and make it again equal to initial margin money, and again make it equal to initial margin money. Initial margin is suppose 100, maintenance margin is 60. If it goes below and becomes 50, you have to again bring 50 and make it 100. So 50 plus 50, it will become 100. As long as it is more than 60, you don't have to bring more margin money. That is the concept of maintenance margin. Now they have given you index closed at the following level on the next 5 days. Calculate mark to market cash flow. That means daily, how much will be daily gain or loss. and daily closing balance in that margin account for an investor who has a long position and a short position, and what is the net profit or loss. So very easy question, you might have done in the classes, regular classes. This is taught in every batch. So I will again revise this for you if you want. Contract size, write down 9170 into 50. So one contract is 4,58,500. In order to enter into future contract, you will have to pay initial margin money. Then only you can enter into future contract, which is 8% in this example. 8% of 458,500, which is 36,680. Maintenance margin means below this the margin balance should not fall. If it falls, you have to again bring it back to 36,680. The maintenance margin is 27,510, 6%. Now write down calculation of mark to market cash flow and daily closing balance. Calculation of mark to market cash flow and daily closing balance. Under that, write down first point A for long position holder. For long position holder, draw this table: day, change in future value, margin account balance, call in case if it goes below maintenance margin, call. So on day 0, we started with initial margin 36,680. Now next day what happened? The future contract closed at 9380 and we have entered at 9170. We are a long position holder. It has gone above the contract rate, so we will gain multiplied by 50 units. So 10,500 will be the gain on this date. That is called mark to market. So my margin account balance will go up by 10,500. It will become 47,180. Call is not required because it is above maintenance margin. Next day it has gone up again. Very good. 9520 minus 9380 into 50. So the gain is 7,000. My margin balance will be 54,180. Oh my God, next day it has gone down, so there will be loss. 9100 minus 9520. This you have to take every day. Every day the difference is settled into 50, 21,000 minus 21,000. It should be minus 21,000. So your balance is 33,180. Margin call is not required because it is still above maintenance margin. This is still above maintenance margin, so we don't need to call any call money. Next day, oh my God, again fall. So this has become minus 7,000 loss. Just take on your calculator 33,180 minus 7,000. So that is 26,180. Oh, and your margin, maintenance margin is 27,510. So it has gone below maintenance margin. It has become 26,180. It has gone below maintenance margin. So what I will have to do? I will have to bring it to 36,680 again. To bring it to 36,680 again, how much amount you have to bring as call money? The difference between the two, which is 10,500. So what I'll do? I'll bring 10,500, 33,180 minus 7,000 plus 10,500. So my balance will again be restored to 36,680, which is the same amount here. So the day you go below maintenance margin of 27,510, that is fourth day, you will have to bring call money. This is the concept. Now last day it has gone up, no problem. We are going to gain 9,000. Our balance will become 45,680. If I take the total of this column, I'm getting minus 1500. This minus 1500 indicates the cumulative loss or final loss which the future long position holder will suffer. So that was my answer. So write down 1500 calculation again, and your margin account will have this balance. Sorry, this is the total. Now write down for short position holder. For short position holder, same format, same 4 columns. Here day 0 same amount. I am not showing the calculation here. If it is gain for long position, it will be loss for short position. So the signs will change now. Okay. So to save your time, look at the long position holder. He was making a profit of 10,500. The short position will have a loss of 10,500. So 36,680 minus 10,500 if you do, 36,680 minus 10,500, it is 26,180, and the maintenance margin is 27,510. So on the first day only it has gone below maintenance margin. I have to bring it back to 36,680. So the funds to be brought in, cash to be brought in will be again 10,500. So I will have to bring 10,500 so that my balance is restored to 36,680. Now the question is easy. Next day again there is a loss of 7,000, 29,680, but it is still above maintenance margin. This is above maintenance margin. Third day there was a profit to the short position holder. So the balance will go up 50,680. Fourth day again there was a profit to the short position holder. Balance is 57,680. Fifth day there was a loss of 9,000. So balance is 48,680. Take the total of this change in future value. You will find 1500, which is the gain to the short position holder. This is the gain to the short position holder. Okay. If you want to write gain or loss separately, you can write like this. Net loss to long position holder. He had entered into contract at 9170, but after 5 days, the future is lower than contracted rate by 30 rupees. So 30 into 50, loss 1500. Net gain to short position holder. He has entered at 9170, he exited at 9140, 30 rupees gain, 1500 rupees gain total. This completes our discussion of SFM model test paper part 3. Thank you very much for watching this. We are going to come out with RTP May 2023 also, MTP of April also, or the second MTP of May 2023 exam coming soon. So please subscribe to YouTube channel. You'll get notification of RTP May 23 and second MTP for May 23 exam. Thank you very much. Wish you all the best for your exam and good luck. Good evening, friends. Welcome to CA Final SFM April 2023 MTP. We are going to solve the entire MTP. Every practical question we are going to solve. The first thing you have to do is to download the question paper from the website vino.in. In our website vino.in, there is a free resource section where there are a lot of articles for your benefit, and you will find there this April 23 MTP SFM question answer, both are there, so you can get it from there. Okay, so the first thing we need to do is to take this MTP in front of you. I have already recorded March 2023 MTP, so that video lecture is available on our website, on our YouTube channel. So MTP March 23, RTP May 2023 is already uploaded on the YouTube channel, and now we are going to take April 2023 MTP. So friends, my name is Vinod Kumar Agarwal, CA, and I have also done CPA from USA, and I have also got second rank in CA Foundation, 4th rank in CA Intermediate, 24th rank in CA Final. So let us start this April 2023 MTP. In case if you have not subscribed to our YouTube channel, the first thing that you do, subscribe to the YouTube channel AS Foundation. Please like the video and also share with your friend and tell them that May 2023 RTP, March 2023 MTP and April 2023 MTP SFM is available on YouTube channel. So let us come to question number 1. Very tricky question. Very tricky question for 8 marks. This question was asked in some earlier exam also. Okay. You have the following codes from Bank X and Bank Y. This is Bank X. This is Bank Y. And the spot rate is given USD per CHF. Buying rate, selling rate, Bank Y, USD per CHF 1.0753 and 60. This G is not there. Then 3-month forward swap points are given 5 and 10. 6-month forward swap points are given 8 and 16. Then GBP per USD is given. GB per USD for both the banks are given to you. Then these are the 3 months forward swap points. If you look at it carefully, the swap points are in descending order. Swap points are in descending order, so discount. Forward is at discount. Forward is at discount for GBP per USD. And if you look at these two, they are in ascending order. So forward is at a premium. Forward is at a premium. So be careful. They will ask you to calculate the forward rate, and then if it is in ascending order, add. If it is in descending order, deduct from the spot rate. That basic thing you have to know. Okay. Now the question is calculate how much minimum CHF amount. Please double underline this word minimum. Minimum CHF amount you have to pay for 1 million GBP spot. How much CHF amount you have to pay for 1 million GBP spot? You need 1 million GBP, and there are two banks, Bank X and Bank Y. They have given the codes. So how will you enter into deal with these two banks so that you pay minimum amount for buying 1 million GBP? Okay, very good question. This question we have covered in class also. Considering the codes from Bank X only, Now the second question, only this data you will use. For the second part, considering the quotes from bank X only, for GBP per CHF, underline, for GBP per CHF, what are the implied swap points? You have to find out the implied swap points, both bid and offer spot rate over 5 months. They have given you for 3 months and 6 months, and you have to find out the swap points for 5 months. So for that we have to first find out the rate after 3 months, then we have to find out the rate after 6 months, and between that we have to find out the rate after 5 months. Then we will be able to find out how much is the swap points for GBP per CHF. This question can have two answers. Now that is the trickier part. This question can have two answers. Look at the rate carefully. At least this you will understand. GBP per USD. Student will pay attention. It is a confusing question. Two students can get two different answers according to your interpretation. GBP per USD. GBP, 1 GBP is equal to, 1 USD equal to 1.1945 GBP buying rate, 1.1960 GBP sale rate or offer rate or ask rate. Now the confusion is, the students are aware that USD, 1 USD cannot buy more than 1 GBP, because if you look around you right now, 1 USD is equal to approximately 83 rupees per dollar, and 1 GBP is approximately, from your general knowledge, around 95 rupees per dollar or 100 rupees per dollar, which means GBP is expensive than USD. GBP is expensive than USD. So what they are trying to say, probably, that this rate is not GBP per USD, but this rate is actually USD per GBP. So now the student will have an obvious query: how will I know? How will I know whether it is GBP per USD or USD per GBP? So whatever you do, you write the assumption and solve. And similarly, if you look at this carefully, from the drafting of the question, it is USD per CHF. 1 CHF will give you 1.0750 USD. From your general knowledge, probably you are knowing that USD is expensive than CHF, not the other way. So therefore it should have been actually CHF per USD, but they have written USD per CHF. You are a student, you are in the exam, and not everybody knows whether CHF is expensive than USD or USD is expensive than CHF. Similarly, you also don't know whether GBP is more expensive than USD or USD is more expensive than GBP. So this is a dangerous question. Institute should not ask such question, or if they ask, they should write it properly. So there is a confusion. So I am going to solve it twice. One, by literal interpretation. By literal interpretation, I mean whatever they have written in the question, I will take as it is. I will treat this as USD per CHF, and I will treat this as GBP per USD, and accordingly I will solve. Is it right? So first you see my answer, and then I will also give you the institute answer. So write down our answer. Our answer, in case in the exam you are having any doubt, you write the assumption. Otherwise, ideally, if this question is asked as it is, then better for getting marks in the exam, you will follow institute answer. Okay, but institute in other questions have not done in the same way. They have taken the literal interpretation of the rate given in the problem. So institute will confuse you as they have been doing in the past. Write down, please write down. If you want to write my answer, which will be different from the institute answer, please write down. We have assumed that the rates are USD per CHF and GBP per USD. So we will interpret as it is given in the problem. And now we'll start solving the question. Write down. First we need to find out the exchange rate between GBP and CHF, so that I can calculate how much CHF would be required for buying 1 million GBP. Question should be in front of you, otherwise you will not be able to understand. Please quickly download the question paper from our website vino.in. Quickly download and keep it with you. Otherwise you will not be able to understand. You will not be able to see question paper again and again. So first write down step 1, determination of exchange rate based on cross currency codes. Write a note. What is my objective? To pay minimum CHF. So I can either buy from bank X USD, or I can buy from bank USD, I can buy from bank GBP, or I can buy from the bank Y GBP. Whichever is cheaper for me, I'll do that. And how to identify whichever is cheaper? Let us write a note. I'll explain it to you one by one. Since the requirement is for minimum CHF, the cheapest available quote among bank X and bank Y has been chosen. The cheapest quote available among bank X and bank Y have been chosen. Now let us look at the rates carefully, and then I am going to ask you a question and you will participate. If you are good student of SFM, you will participate in answering. Okay, for buying GBP using CHF, we want to buy, but the bank or the forex dealer would want to sell. So the relevant rate would be ask rate. The relevant rate is ask rate for GBP. In CHF. Okay, the relevant rate is ask rate for GBP in CHF. So I need to find out CHF per GBP. Ask rate. Now let us apply cross rate rule. I have written also here. Let us apply cross rate rule. So I need to find CHF per GBP. I will first take CHF per USD ask rate into USD per GBP ask rate. This is called cross rate rule. Okay. Now remember, I need to find ask rate. The student will go to the question. This is the question. Now these are the rates for USD per CHF. You have to tell me. Let us see who will give the correct answer. And I need ask rate. CHF per USD. I need CHF per USD ask rate. So now you have to tell me CHF per USD ask rate is cheaper where? Whether it is cheaper in bank X or whether it is cheaper in bank Y. So in that case the student will say, for understand bank X CHF per USD will be 1 divided by 1.0755 and 1 divided by 1.0750, and in bank Y 1 divided by 1.0760, 1 divided by 1.0753. This is cross rate rule. Reciprocal of buying rate is selling rate, reciprocal of selling rate becomes buying rate. So we have to basically make a choice between these two. I am going to highlight it. Which is lower number? Which is lower? 1 by 1.0750 is lower, or 1 divided by 1.0753 is lower? Please reply. If the base is heavier, if the denominator is bigger, the answer will be smaller, which means I will take USD from bank Y. I will purchase USD from bank Y because their USD is cheaper. Their USD is cheaper. Okay. And now my next question is, I need USD per GBP. I need USD per GBP ask rate. I need USD per GBP ask rate. Let us look at these rates. So my USD per GBP with bank X will be, it will become reciprocal, 1 divided by 1.1960, 1 divided by 1.1945, and with bank Y 1 by 1.1950, 1 by 1.1940. Because I am changing the base, I have to take reciprocal. Because I am changing the base, I have to take the reciprocal. Now these are the two ask rate. Which is cheaper? The one with higher denominator is cheaper, lower, because when you solve it, 1 by 1.1945 will be a lower figure. So I will buy GBP from bank X. So what is our final conclusion? That we will first convert CHF into USD and then we'll convert USD into GBP. So we will buy USD from bank Y and will buy GBP from bank X. Is it right? So that will give me the rate between CHF per GBP. So write down please. I have tried to explain. This is actually, you should know something already. Up to this we have written. So CHF per USD I will take 1 by 1.0753. This is bank Y, and USD per GBP I will take 1 divided by 1.49. This is cheaper in bank X. This is cheaper in bank X. So therefore my answer is 0.7785 CHF per GBP. Okay. The question is, if you want 1 million GBP, if you want 1 million GBP, then how much CHF would be required? 1 GBP you need 0.7785 CHF. 1 GBP is equal to 0.7785 CHF. 1 million GBP is equal to how many CHF? Come on, please reply. So you simply multiply, arithmetic, 10 lakh into 0.7785. So my first answer is 778500 CHF. This answer is right if you interpret the rate as it is. Now we'll come to next question. What is the implied swap point based on Bank A quotes for 5 months? Very important question we are doing. This is a question from SFM MTP April 2023, question 1A. Those who have joined late. So write down calculation of implied swap points. Right hand side 2 columns. Bid rate, ask rate. Bid rate, ask rate. First we'll write down spot rate. Question in front of you. Question can be downloaded from our website vino.in. Spot rate in the first line USD per CHF is buying rate 1.0750, ask rate 1.0755. Spot rate below in the question book GBP per USD 1.1945, 1.1960. So can I find out the spot as per the question? We have to find out the rate GBP per CHF. If you look at the question second part, you have to find the rate GBP per CHF. So GBP per CHF applying cross rate GBP by USD into USD by CHF. USD cancelled. This is GBP per USD and this is USD per CHF. So just multiply the two figures, A into B. Just multiply the two figures. You will get 1.2841. Check the answer, 1.2841, and you multiply ask rates also. You will get 1.2863. Ask rate should be greater than bid rate. Overall check. Point number D. Now they have given you swap points. Swap points for USD per CHF. Swap points for USD per CHF for 3 months 5 and 10, for 6 months 8 and 16. So what will be swap points for 5 months? Since you are intelligent student, please reply. Swap points for 5 months. So for 3 months it is 5, for 6 months it is 8. So 5, 8. Somewhere between these two numbers, you will have a swap points between 5 and 8. So 5. What is the change here? 3 months. And how much change do we want? Only 2 months. So the proportionate swap points for 5 months will be 5 plus 2 by 3. 5 plus 2 by 3 into the gap. 5 plus proportionate 2 by 3 into what is the change for 3 months. For 3 months it has changed from 5 to 8. So for 2 months it should have changed by 2 points only. So I will write like this. Please write down 5 plus, this is 5. This is the gap, 8 minus 5. This is the proportion, 2 by 3. So it comes to 7. Now try the next month, it will increase your confidence. This is a very important question for exam. If they ask this question as it is, and if you have not practiced before going to the exam, probably you can make mistake or you will take more time. You may do it, it's easy, but you may take more time. So here it comes the next answer, 10 plus 16 minus 10 into 2 by 3. This is 10, this is the gap, this is the proportion. So now write down 5-month forward rate for USD per CHF. 5-month forward rate for USD per CHF. How do you get forward rate? You will take spot rate. You will take spot rate and you will add the premium. You will take forward spot rate plus premium. So you will get 1.0750 plus premium 0.0007, 1.0757. Try the next month. Try the next column. Try the next column ask rate. Take 1.0755 plus 0.0014. So that will give you 1.0769. 1.0769. 1.0769. It should be 0.0014. I'll just correct it. Okay, now let us try for GBP per USD. Swap point for GBP per USD. 3 months, come on, 3 months given in the question. 25, 20, 6 months, 37, 26. So 5 months will be this 25 plus the difference 37 minus 25 into 2 by 3 proportionate. So this comes to 33. Check. Try this one. Try next column yourself. Try next column yourself. 20 plus 26 minus 20 into 2 by 3. That is 24. Now wait. This is GBP per USD spot rate. Look at this 33 and 24. It means GBP per USD is at discount because it is in decreasing order. So what you will do, take spot rate minus discount. Take spot rate minus discount. That will give you 5-month forward GBP per USD. 5-month forward GBP per USD. So you will please take 1.1945 minus 0.0033. So that will give you 1.1912. Similarly, take 1.1960 minus 0.0024. That will give you 1.1936. 1.1936. Now, interesting thing. You have got USD per CHF. You have got GBP per USD. But what they want? They want GBP per CHF. So again you will apply this rule, cross rate rule, and you will be able to find out 5-month forward GBP per CHF. Yes or no? So what you do? Multiply point number E and point number G. What will you get? You will get 5-month forward GBP per CHF. 5-month forward GBP per CHF. So just multiply point number E into G. So that will give you 1.2814. Come on, next 1.2854. Now this is the forward rate and point number C spot rate. Difference between forward minus spot will give you the premium or discount. Will give you the premium or discount. So let us see. The forward is lower than the spot. Can you see forward? Point last is 14 and it is 41. Forward is less than spot. So please reply fast, those who are on YouTube directly watching. Is GBP per CHF at discount or premium? Because forward rate is below spot rate, it is at discount. So write down 5 months swap points discount. Take the difference between 1.2814 minus 1.2841, H minus C, but don't write negative sign. 0.0027. Next column you will try an answer. Next column you will try an answer. Come on student. So 0.00 9. This is your answer after so much of hard work. Okay. So my forward discount is 27 points and 9 points. My forward discount is 27 point and 9 point. So one student Sagar has replied it will be at discount. You are right. Very good. This is our answer, which you can write in the exam by writing the assumption at the beginning that the given rate is USD for 1 CHF and GBP for 1 USD. Now I will also explain the institute answer, because that will be your query. In case if you have attempted this MTP, you will be interested in knowing this first answer. So ICI answer. What ICI has assumed, very extraordinary, very difficult for the student to understand it. ICI has assumed that, write down, ICI has assumed that the rate given is 1 USD is equal to CHF and 1 GBP is equal to USD. So what you do, in your question book, it is written USD per CHF 1.0750, 1.0755. So you just cut this and you make it CHF per USD. You make it CHF per USD, and below it is given GBP per USD 1.1945. I am only writing for bank A. You can do the same thing for bank Y also, 1.1960. So you cut this and you write it USD, write in both bank X column also and bank Y. Okay. And somewhere in the second question below, last line, they have written GBP per CHF. In the second question, last second line, you cut it and you make it CHF per GBP. So everywhere the institute has a reverse interpretation. I can't help it. If you are interested in knowing, you have to change the question by cutting USD per CHF, make it CHF per USD, GBP per USD you cut, make it USD per GBP, and in the last question GBP per CHF you will cut and you will make it CHF per GBP. Is it right? This is what your dear institute has done. Next line write down. Next line write down, since the requirement is for minimum CHF. Since the requirement is for minimum CHF, let us see, this is the quote of bank X and the quote of bank Y is 1.0753, 1.0760. So where we will get USD cheaper if these are the rates? So USD is cheaper at which bank? This one. USD you will buy from bank X because you need ask rate. This is cheaper, 1.0755 tick mark, 1.0755 tick mark. Okay. Now this is the rate for GBP given by bank X, and the rate for GBP given by bank Y is 1.1940, 1.1960, sorry, 1.1950. So which is cheaper? This is cheaper. 1.1950 is cheaper. So I will purchase USD from bank X and I will purchase GBP from bank Y. I will purchase USD from bank X because you can see bank X has a lower ask rate for USD and bank Y has a lower ask rate for GBP. So my strategy would be buy first dollar from bank X, and using that dollar you can buy GBP from bank Y. So write down below, first buy USD against CHF from bank X, because you can see 1.0755 is lower than 1.0760, and second buy GBP against USD from bank Y, 1.1950 is lower than 1.1960. So this was a little difficult part, otherwise the question is easy. Now write down the cross rate formula. CHF per GBP is equal to, I need CHF per GBP, CHF per USD into USD per GBP. We have already decided for CHF per USD I will take 1.0755, the lower of the two rate, and for USD per GBP I will take 1.1950, the lower of the two rates. I hope you are understanding. Our objective is to find how much minimum CHF I have to pay. So I will buy USD from bank X, I will buy GBP from bank Y. So my rate is 1.2852 CHF per USD. Is it right? So what is the total amount payable for 1 million? There is a small mistake here. It should be CHF per GBP. So what is the amount payable for 1 million GBP? 1 GBP 1.2852 CHF. So 10 lakh GBP is equal to 10 lakh into 1.2852, 1285 200. This is your first answer. This is ICI answer. I have already given my answer, which was very low compared to this. Okay, everybody please participate. This is a little lengthy question and I have already solved it twice. Okay, please subscribe to YouTube channel, like, share. Okay, comment if you have something to offer. Calculation of implied swap point based on bank A. अपने दोस्तों को भी बोलना है for subscribing to the channel. Calculation of implied swap point based on bank A quotes. Students, please follow me. Bid rate, ask rate. So spot rate we will write CHF per USD. We have decided to interpret like this. It is not USD per CHF. It is actually CHF per USD, because USD is expensive than CHF, but your institute has written reverse. Can't help it. USD per GBP spot rate 1.1945, 1.1960. So I have to now calculate CHF per GBP. CHF per GBP will be CHF divided by CHF per USD into USD upon GBP. So this is CHF per USD, this is USD per GBP. So directly multiply A into B, A into B, A into B, 1.2841, 1.2863. Now we'll solve in the same way. Swap points for CHF per USD. Swap points given in the question. Same thing copied. 3 months 5, 10, 6 months 8 and 16. So 5 months will be like the previous calculation. Take 5 plus 8 minus 5 into 2 by 3, 7. And next column will be 10 plus 16 minus 10 into 2 by 3, 14. So 5-month forward rate, CHF per USD, this is first line is CHF per USD. You will add the swap point here because it is in ascending order. So A plus D, 1.0757, 1.0769. Now we'll do it for USD per GBP. Swap points USD per GBP, 3 months, 6 months. Find out for 5 months. Same calculation, 25 plus 37 minus 25 into 2 by 3. We are solving a very important question. Number 1A, from April MTP 33 and 24, 5 months forward USD per GBP, 5 month forward USD per GBP. Now what you will do, you will take this point number B minus, because it is in descending order, minus, you will get B minus F because the swap points are in descending order. So discount 1.1912, 1.1936. Now you have got this highlighted line is CHF per USD. This is USD per GBP. What will you get if you multiply the two? You will get CHF per GBP. Solve. 1.2814, 1.2854. Now what is the swap points? 5 months swap points for CHF per GBP. 5 months swap points for CHF per GBP. So this is spot CHF per GBP. This is 5 month forward rate. Compare these two. The difference is premium or discount point. Because the forward rate is lower than the spot rate, it is at a discount. So take the difference, 0.0027, 0.0009, and the answer is last line. 5 month swap points are at a discount of 27 and 9. 27 is for buying rate, 9 is for ask rate. Did you like this answer? This is institute answer. Institute has interpreted in a different way. Now we'll come to another past exam question for 8 marks. This is also past exam question. Most of the question in this MTP were from past exams. Okay. Shiva has a fund of rupees 5 lakh. In the original question it was Indra. They have made Indra to Shiva. Institute has got so much power, it can convert Indra into Shiva. Okay, amazing. Which he wants to invest in share market with rebalancing target after every 15 days to start with, or a period of 1 month from now. So he wants to rebalance his portfolio after every 15 days for a period of 1 month. The present Nifty today, spot Nifty, is 17025. The minimum Nifty within a 1 month can be at the most 1532.50. So Nifty can decline by how much? Nifty according to expectation can decline by these points, and if you want to convert into percentage, 17025 minus 15322.5 divided by 17025, and that will give you 10% approximately. So you are expecting that Nifty in 1 month at the most can decline by 10%. So you may lose 10% of your investment if you invest in Nifty. He wants to know as to how he should rebalance his portfolio under the following situation according to the theory of constant proportion portfolio insurance. This is CPPI. Same question was asked in the exam long back. Now they have repeated using 2 as a multiplier. So in CPPI, the amount to be invested in equity is equal to multiplier into asset value minus floor value. So asset value today is 5 lakh. Multiplier they have given 2. Floor value you have to decide. Based on the information given, floor value you have to decide. So he will say that my asset is 5 lakh and at the most I can afford to lose 10%. So we will take floor value F is equal to 4,50,000. That was the missing figure. Based on the information given, we can assume that floor value is 4,50,000. Shabash Dongre, keep answering. Okay. Now the question is, what will be his portfolio to start with? How you will rebalance his portfolio after 15 days? How you will rebalance your portfolio after 15 days if Nifty falls to 1632.1.89 and after further 15 days, how will you rebalance your portfolio if Nifty touches 17512.14? Okay. Assume that the value of his equity component will change in tandem with that of Nifty. So if the Nifty goes up or goes down, the equity value will also go down. If Nifty goes up, equity value will also go up proportionately. So let us write down. First we'll find out what is maximum decline in 1 month. Maximum decline in 1 month is the difference between spot Nifty and how much Nifty can decline to after 1 month divided by 17025. So that gives me 10%. Keep replying. Yes, come on. So it is assumed that investor will select floor value. It is assumed that investor will select floor value equal to 5 lakh minus 10%. 5 lakh minus 10%. This is the 10%. And 5 lakh is the asset he has in the beginning. 4,50,000. Now we'll calculate how much amount is going to invest in equity and how much amount is going to invest in bond. First we'll calculate equity. Bond is the balancing figure. So write down case 1 immediately to start with. Under that write down investment in equity. Formula is multiplier into asset value minus floor value. Anybody wants to reply? Multiplier is 2. Total amount available is 5 lakh minus floor value 4,50,000. Anybody wants to reply? Day 1 investment in equity will be 1 lakh. And how much assets does he have? 5 lakh. Therefore, Investment in bond will be 5 lakh minus 1 lakh, 4 lakh. Now understand, after 15 days, your investment in equity will change as the market will change. In the problem, interest rate is not given. If interest rate is not given, we will not consider change in investment in bond, and we will not consider change in floor value. Otherwise, we assume that floor value and investment value will also change according to the interest given. Very good, Sagar. Come on, next, after 15 days, now show your intelligence. After 15 days, value of equity will be proportionate. 1 lakh he had invested. Now the Nifty is 1631.89 divided by 17025. What will be the value of equity now? What will be the value of equity now? It will fall. It will fall to 95870. Come on, next. Value of bond will be same. Nothing is given about interest. 4 lakh. So my asset value A plus B, asset value A plus B, 495870. So I have to rebalance now. After every 15 days, we have to rebalance. So this is my asset value. Multiplier is 2. Floor value is 4,50,000. So I am asking our student one question. What will be the investment in equity now after 15 days, after rebalancing? So you will write 2 into, this is my asset value, this is floor value, so this comes to 91,740. This is my total asset value. Now I am going to invest only 91740. So what is the amount to be invested in bond after 15 days? So investment in bond will be C minus D. Come on, very good, Meera. C minus D, 4,04,130. Please reply. 4,04,130. So what is the action you will do? You have to reduce the equity. You have to reduce the equity means sell equity, and you have to increase the bond. So sell equity and buy bond. Yadav, this time you are wrong. Check your calculation again. You will sell equity of 4130 and buy bonds of 4130. This is a very important question. Please mark important. Question number 1B from MTP April 23. Question is available on our website vino.in. So please keep replying. The first part is clear now. So now we have, this is the investment in equity, this is investment in bond. So I will require these two numbers in the next calculation now. Write down case 3. After another 15 days. Question in front of you. Question should be in front of you. So I will write value of equity 91740 was the value of investment in equity in the previous calculation. This is the Nifty now, and this was the Nifty 15 days ago. So my value of equity will increase proportionately. Meera is right. Come on. Now the value of equity will be 98430. Value of bond, previous answer as computed in case 2. as computed in case 2. So my asset value will be 5,02,560. 5,02,560. Investment in equity. This time you will reply. Investment in equity will be how much? Give me the answer here. Give me the answer. 2 into 5,02,560 minus 4,50,000. So 1,05,120. Very good, Yadav. Investment in bond will be total asset value minus equity. Total asset value minus equity. Come on, reply. So this time my investment in bond will be 397,440. Now first understand, this is your equity value right now before rebalancing. This is the value of equity you want after rebalancing. So what action on equity you are going to take? What action on equity you are going to take? Are you going to buy equity or sell equity? Are you going to buy equity or sell equity? So you will say buy equity and sell bond. Sell bond and buy equity of. So what is the value of equity you will buy? Take the difference. 1,05,120 minus 98,430. Yes, come on. 6690. 6690. 6690. Check the answer. Is it 6690? Six six nine zero is right. So this was the answer of this wonderful question. Now we'll come to question number 2A. Theory question you will do yourself. You will get the answer on the institute MTP. So theory question will not take much time. We'll take directly practical question. This is another interesting question. Let us solve. On the basis of the given information, Mr. XLY wants to create a portfolio equally as risky as the market. Underline. This contains hint. यहाँ पर हिंट छुपा हुआ है. The portfolio risk should be as risky as the market. So portfolio beta should be same as market beta, and all of you know market beta is 1. Market beta is 1. Is it right? So therefore the portfolio beta should be also equal to 1. Now they have given you investment in A and B. Beta of A and B. Stock C, you have to find out what is the investment to be made in stock C and what is the investment to be made in debenture D. Beta of C is 1.60, beta of debenture is 0. How do you recommend and interpret the risk scenario and investment in all the securities? So very good. So now write down one note. Very easy question actually. All of you know that beta of this market portfolio is 1. So we have to solve an equation where weighted average beta of the portfolio will also be equal to 1. Total funds available for investment, write down 20 lakh. I have simplified the answer. Institute answer is little lengthy. Total funds available for investment is equal to 20 lakh. Then write down amount invested in stock A and stock B. Amount invested in stock A and stock B already given in the problem. 4 lakh plus 5 lakh is 9 lakh. 9 lakh is already exhausted. So write down remaining amount. The remaining amount is 20 lakh minus 9 lakh. So the remaining amount is equal to 11 lakh. So out of this 11 lakh, I have to find out how much will be invested in the stock C and debenture D, right? Let investment in stock C and debenture D be X and 11 lakh minus X respectively. X and 11 lakh minus X respectively. Come on, keep replying. Then write down one note. Portfolio beta is equal to market portfolio beta. Portfolio beta is equal to market portfolio beta. And all of you know market portfolio beta is equal to 1. Portfolio beta is weighted average beta. So I'll multiply. First amount is 4 lakh into beta 0.7 plus second amount is 5 lakh into 1.1. Third amount we have assumed X into 1.60. Fourth amount we have assumed 11 lakh minus X into 0 and divide by the total amount 20 lakh. Divide by the total amount 20 lakh. Otherwise first you can compute their weights and then solve. So now you will solve this equation. 20 lakh into 1 is 20 lakh and the numerator is simplified now. 4 lakh into 0.7, 5 lakh into 1.1 and this is 1.6x. So can you solve and give me the value of x? Come on Meera, Sagar, Jain. So the answer would be x is equal to 7,31,250. So our first answer is investment in stock C will be 731,250. Now reply investment in debenture D. Investment in debenture D will be 11 lakh minus 731,250. Come on, the answer is, please reply. How much? 368,750. 368,750. So this is your answer for this simple question. The portfolio will have same risk as that of the market because its beta is 1. Because its beta is 1. And to achieve that, the investment in C and D should be these amounts. Okay. So now we'll come to our next question, number 2B. Very different question. Asked long back, old exam question. All question in this paper was from past exams. Some question were 10-year-old, some were 12-year-old, but they have been asked in the past. So that is why in our SFM batch what we have done, our SFM video lecture, those who have purchased our SFM video lecture, we have covered all study material question, we have covered RTP question, MTP question, and most importantly we have covered all past exam question of approximately 25 to 30 years which are relevant in today's syllabus also. And therefore I will urge you, I will highly recommend that you can purchase our SFM video lecture from our website vino.in. These lectures are available in 2 languages, English and Hindi. According to your comfort you can purchase. अगर आपको हिंदी ठीक लगती है तो हिंदी में purchase कीजिए. If you want English you can buy in English. And even revision lectures are available in English and Hindi. So you can buy from our website vino.in. And please also recommend to your friends, because many students may not be aware that we are covering the entire syllabus in detail, and we are also telling you how to present the answer in the exam, and wherever applicable I am giving you alternative answers also. So maybe if you have time in the exam, you can write alternative answers also. So let us go to question number 2b. Question number 2b. Please take the printout of the MTP, keep it in front of you. This question is more like an accounts question, less like a financial management question. Following is the balance sheet of PK. Oh, my favorite movie, PK. On 31st March 2015. Rupees in lakhs. Equity and liability shareholder fund equity share capital of 10 rupees each. 900 lakhs. 10% preference share capital of 100 rupees each. 300 lakh. Reserve is negative. So this company has a huge negative reserve, losses in the balance sheet. Under non-current liability you have term loan, current liabilities you have trade payable, and then total asset side non-current asset, inventory, receivable, cash. Messrs. PK did not perform well, so sad, and has suffered sizable loss, again so sad, during the last few years. However, it is now felt that the company can be nursed back to the health by proper financial restructuring. So this is a question on corporate restructuring, and consequently the following scheme of reconstruction have been designed. Now you will find that this question is like your intermediate question. Okay, you have studied in intermediate one chapter called internal reconstruction. Same problem. Equity share will be reduced to rupees 2 per share fully paid. Right now it is 10 rupees. It will be reduced to 2 rupees. So there are 90 lakh shares, and the sacrifice made by the equity shareholder is 8 rupees. So 720 is the reduction in equity share capital. You must have done it in the accounts. Preference shares are to be reduced by rupees 50 per share. So preference share capital is right now 3 lakh. From 100 it will become 50. So preference share capital will be reduced by 150 lakh. And the dividend on preference share is reduced by 2%. So right now dividend is 10%, it will become 8%. Trade payables have agreed to forgo 40% of their existing claim. Very good. So even trade payable will sacrifice 40% of 400, that is 160. So they will say we will forgo 40%, and for the balance, means 60% is the balance, 50% they have agreed to convert their claim into equity share of rupees 2 each. So they will have to be issued equity share 50% of 400, that is 200, divided by equity share 2. So they will have to be issued 100 lakhs equity share of 2 rupees each. So this is 40%, this is 50. Remaining 10% will still appear in the balance sheet. Remaining 10% will still appear in the balance sheet. So in the balance sheet, trade payable will appear 10% of 400, 40 lakh. Then in order to make payment of term loan, there is a term loan of 400 in the balance sheet. Company will issue 200 lakh equity share of 2 rupees. So in the balance sheet, equity share capital will increase here by 200 lakh share, 100 lakh share because of trade payable, and 90 lakh existing shares are there. So total number of equity share will become 200 plus 100 plus 90. each at par, entire sum is required to be paid on application. Non-current asset will be revalued at 500 lakh. There is 1000 rupees non-current asset. It will be reduced by 500. So now the balance in non-current asset will be 500. You are required to show the impact of financial restructuring. So that is how your share capital, reserve, preference share, loan will get affected because of the financial restructuring. And then an accounting question, prepare balance sheet after restructuring. So let us see first what will be the net gain or loss due to financial restructuring. What will be net gain or loss due to financial restructuring? Write down. I will show you how much is the net gain or loss due to financial restructuring. A company which is undergoing losses will have to reduce the value of the asset if it is overvalued. Most importantly, the share capital have to reduce so that the losses can be wiped out from the balance sheet. So write down net gain or loss. Who are going to contribute in this scheme of restructuring? Equity shareholder, preference shareholder, trade payable. So that is a gain to the company. First gain, write down reduction in equity share capital. Reduction in equity share capital. 90 lakh share into 8 rupees. Share of 10 has become share of 2. 8 rupees is the gain, and that is 720 is the reduction in equity share capital. Then write down reduction in preference capital. So there we have 3 lakh preference share, and preference share will be reduced by 50 rupees. So that is 150. Then write down trade payable, 40% of 400, 160. So total sacrifice made by shareholder and creditor is 1030. And there is a loss also. You have to write off the non-current asset. So less reduction in non-current asset by 500 rupees. So what is the net gain on restructuring? 530. Net gain on restructuring is 530. So the question is, what will you do with this 530? If you look at the balance sheet, there is already a negative reserve of 500. So out of 530, 500 negative P&L account will be wiped off. Remaining 30 will be transferred to capital reserve. Oh, now you remember your happy days of intermediate. Write down the net gain of rupees 530 lakh. The net gain of rupees 530 lakh will be used to write off negative balance of reserve and surplus of rupees 500 lakh. Negative balance of reserve and surplus of rupees 500 lakh and remaining rupees 30 lakh will be transferred to capital reserve. Remaining rupees 30 lakh will be transferred to capital reserve. So this will be one effect of financial restructuring. Now let us see what will be the effect on equity share capital. So write down step number 2, equity share capital balance. Equity share capital balance. In the institute answer, this step 2 is not there, but I feel it should be written. It will show the movement in equity share capital. If you write it, it will be good. Right hand side rupees in lakh. Point number A, equity share capital after reduction. Equity share capital after reduction, 900 minus 720. 180. Then second point B, write down equity shares issued to trade payable. Equity share issued to trade payable. 400 into 50%. 400 into 50%. Out of 400, 50% was settled by issue of equity share amount 200, and then fresh equity share issued. Fresh equity share issued is 200 into 2, 400. So total equity share capital in the balance sheet. Total equity share capital in the balance sheet would be 780. In bracket write down 390 lakh equity share of rupees 2 each. 390 lakh equity share of rupees 2 each. Any query, ask me, I'll wait. Any query, please ask, I'll wait. No query. Now write down next step 3, revised preference share capital. Revised preference share capital. Preference share capital will be now, number will be same 3 lakh. Dividend rate will become 8%, 10 minus 2. So write down 3 lakh 8% preference share of rupees 50 each. 3 lakh 8% preference share of rupees 50 each is 150 lakh. Is 150 lakh. So this will be the change in the share capital. Now write down step 4, revised trade payable. Revised trade payable. So what happens to trade payable? Balance as per balance sheet is 400. Balance as per balance sheet is 400. Then the creditors have waived off 40% of 400. So 400 of 40% of 400, 160, and plus trade payable of 200 lakhs were converted into share capital. So less converted into equity share capital will be 200. So what is the balance in the balance sheet now? 40. I will show 40 in the balance sheet. Understood? So I have prepared all working note. What about term loan? Term loan will become 0 because it has been repaid. So this is my balance sheet. Write down step 5. Keep the notebook in front of you and write. Balance sheet after reconstruction, rupees in lakh. Rupees in lakh. First we'll follow the same format which is given in the question. Your query can be, can I follow the format of Ind AS? You can follow, no harm in that, but don't unnecessarily complicate the matter. Preferably in SFM paper, follow the format given in the question. Of course, you can change the format as per Ind AS also, where asset will be written first and equity and liabilities will be written later. Not a serious matter, right? Shareholder fund, equity share capital, 390 lakh equity share of rupees 2 each, 780, 8% preference share capital, 8% preference share capital, 3 lakh preference share of 50 each, 150. Then write down below that reserve and surplus. Under reserve and surplus, please write capital reserve, already calculated 30. Non-current liability term loan, it was 400, repaid 400, so balance is 0. Current liabilities trade payable. Current liabilities trade payable, working note, we have prepared working on that, 40. Take the total of the asset side. Come on, reply. I need to check whether you are listening to me or not. What is the total of balance sheet liability side? Please reply. Yes, the total is 1000. Write down asset side. non-current asset will reduce by 500. So 1000 minus 500 is 500. Current asset, right, same figure, no change in inventory, no change in trade receivable, no change in cash and bank balance. Take the asset side total 1000. So balance sheet tallied, at least this much you can do. Now our institute in the answer of this MTP has not given this note on impact of financial restructuring, which I am dictating to you. So please note down. Institute answer does not have this note. You will write, I will dictate, write down, or you can take a screenshot of this note, whatever comforts you. जो ठीक लगे करो, either screenshot ले लो या फिर लिख लो. तो फर्स्ट पॉइंट लिखना है, इक्विटी शेयर कैपिटल एंड प्रेफरेंस शेयर कैपिटल हैज बीन रिड्यूस्ड. इक्विटी शेयर कैपिटल एंड प्रेफरेंस शेयर कैपिटल हैज बीन रिड्यूस्ड. सेकेंड नोट लिखना है, द लॉन्ग टर्म डेट इज रिड्यूस्ड. द लॉन्ग टर्म डेट इज रिड्यूस्ड ड्यू टू रीपेमेंट ऑफ टर्म लोन. ड्यू टू रीपेमेंट ऑफ टर्म लोन. So the company has become a debt-free company. The company has become a debt-free company. Third note, write down, non-current assets have been brought to their fair values. Non-current assets have been brought to their fair values. Non-current assets have been brought to their fair values. Note number 4. The negative reserves have been eliminated. The negative reserves have been eliminated. The negative reserves have been eliminated. And the fifth note, right, being debt free and more realistic value of assets comma, in future earnings would improve. In future earnings would improve. So this is the note you should write for this question. Mark this question also as important, because this question was asked long back and now after many years they are repeating. Question number 3A. This question was there in one RTP 2 years ago. This question was as it is there in the RTP. Now they have asked in MTP. Write down important. This you may not have done in your regular class. One student has a query in this previous question, interesting query. How cash balance is same? Because we have issued equity share of 400 lakh issued, which was used to pay term loan. There is no other cash transaction. Equity share of 400 lakh was raised to repay the term loan of 400 lakh. So 400 inflow minus 400 outflow. The existing cash balance appearing in the balance sheet will remain same. So that was a very good question and that is the answer. Cash balance will not change because the inflow and outflow was same. Okay, so now I was telling you about question number 3A. This question is on short selling. Very good question. Write down important for exam. Mr. A is holding 1000 share of the face value of 100 rupees each. So one Mr. A is holding 1000 share of 100 each of Messrs. ABC Limited. He wants to hold these shares for long term and has no intention to sell. On 1st January 2020, Messrs. XYZ, there is another entity XYZ, has made short sale. Short sale means selling now and buying later. Sell now, buy later. But how will you sell now? By borrowing shares. By borrowing shares. By borrowing the shares. And has approached Mr. A to lend his shares under stock lending scheme. So now what will happen? Mr. A will lend the shares to XYZ under the stock lending scheme with the following terms. Shares to be borrowed for 3 months from 1/1/2020 to 31st March 2020. So it's a 3 months period. So this transaction will be over on 31st March 2020. What about lending charges? Mr. A will earn lending charges and the company XYZ will pay lending charges to Mr. A, which is 1% to be paid every month on the closing price of the stock quoted in the stock exchange. So this is stock lending charges, 1% of closing price. Okay, and multiplied by 1000 because there are 1000 shares. Now next is bank guarantee will be provided as collateral for the value as on 1/1/2020. Who will provide bank guarantee? Bank guarantee will be provided by XYZ. So therefore XYZ will have to pay to the bank the guarantee fees also. Bank guarantee fees also. Cost of bank guarantee is 8% per annum. Who will pay this 8% per annum? XYZ will pay to the bank for providing guarantee. Since it is a 3 months problem, while calculating the bank guarantee fees, multiply by 3/12. Multiply by 3/12. Otherwise you can make mistake. On 29th March 2020, Messrs. XYZ declared dividend of 20%. So 20% of what? So 20% of face value 100 rupees. So dividend per share will be 25% into 100, 25 rupees. Dividend will be compensated by XYZ to Mr. A. Dividend will be compensated by XYZ to Mr. A, 25 rupees per share. The short seller will compensate for any dividend paid during this period to the stock lender. Now next is closing price of Messrs. ABC was quoted on the stock exchange on various dates as follows. So these are the prices. Now they have given you two questions. Assume that scenario 1 is bullish and assume that scenario 2 is also bullish. Is it bullish written in the problem? Yes, both scenario they have written bullish, but actually this is a mistake in the question. It should be bearish because you see below the prices are falling. Prices यहाँ पे कम हो रही है, so they should have mentioned the heading bearish, but the institute have written bullish. Anyway, based on number we have to answer. These prices will be required for calculating stock lending charges. Prices will be required for calculating stock lending charges. And secondly, these closing prices will be used for calculating gain or loss on short selling. Will be used for calculating gain or loss on short selling. Okay. So the question number 1 is find out earnings of Mr. A through stock lending scheme in both scenario. Very easy. Total earning of Mr. A in both the scenario. Again very easy, just multiply by 1000. Previous answer multiply by 1000. What is the profit or loss to Messrs XYZ? Now you have to also look at the question from XYZ point of view by shorting the shares using stock lending scheme in both the scenarios. So this is a good question. So first we'll solve for Mr. A. Please write down the answer. How will you present the answer? This question you may not have done earlier. So I will ask you to take your notebook and write it down along with me. This will give you confidence that you can answer such question in the exam. Write down step 1. Earning of Mr. A through stock lending scheme. Earning of Mr. A through stock lending scheme, right hand side 2 columns. Right hand side 2 columns, scenario 1 and scenario 2. So Mr. A will get lending fees. Mr. A will also get dividend. So that will be his income from the stock. So first write lending fees. On 31st March 2020, in scenario 1, the price is 1020. First we'll do calculation for 1 share, then multiply by 1000 later. So in scenario 1 he will get 10.20. In scenario 2 he'll get 980 into 1%. 28th February 2020. Question in front of you. The price is 1040 in scenario 1, 1040 into 1% and 960 into 1%. 10.40, 9.60. 31st March 2020, 1050 into 1% in scenario 1, 10.50, 940 into 1%, 9.40. Very easy. So that total from stock lending, write down total earning from lending. You will add the previous 3 figures, 31.10, 28.8. Then write down total earning from 1000 shares. Total earning from 1000 shares, that will be 31,100 and 28,800 and 28,800. Now write down dividend per share. The short seller will compensate the lender for any dividend paid during these 3 months. So dividend per share is 100 into 25%. Total dividend write down on 1000 share, 25,000. So total earnings will be lending income plus dividend income, B plus D, will be 56,100 in the first scenario and 53,800 in the second scenario. So this is your first answer and second answer. You will get approximately 4 to 5 marks for this much effort. Now you write down calculation of profit or loss to Messrs XYZ by shorting the shares, through the stock lending scheme, by shorting the shares through the stock lending scheme, by shorting the shares through the stock lending scheme. Again 2 columns, scenario 1 and scenario 2. This company has to first calculate gain or loss due to shorting the share. This company had done short selling at 1000 rupees. Question in front of you, 1000 rupees, and now at the end of 3 months the market price is 1050. Price has gone up. All of you know, if price goes up, short seller will lose. Short seller will lose. If the price goes up, the short seller will lose. This question has a small mistake. They have not mentioned at what price short selling was done. If you read the problem carefully, there appears to be a mistake. You have to mention in the question that the short selling was done at 1000 rupees. Somewhere in the question you have to add, somewhere in the question, short selling was done by XYZ at rupees 1000. This they have not mentioned clearly. And in the second scenario, the price has gone down. The price goes down, short seller will gain. So 60 rupees gain. Lending fees paid, already calculated. Lending fees paid per share. Go to previous step 1. Step 1. And the step 1, lending fees you will find 28.80. Then write down bank guarantee charges 1000 rupee into 8% for 3 months. 1000 into 8% for 3 months. So the bank guarantee charges are 20. So gain or loss per share, take the total of these three numbers carefully. Negative, negative, negative. So 101.10 loss in scenario 1. Positive, negative, negative. So net gain 11.20 per share. Total gain or loss on 1000 share. Total gain or loss on 1000 share. First column is total gain or loss. Sagar is right. 1,01,100. Second column 11,200 gain. This is gain. This is loss. But this is the institute answer. There is one small mistake in this answer. What is the mistake? Can you guess the mistake? Spot the mistake in the answer. The mistake is this short seller XYZ has to pay dividend, compensate the loss of dividend to the lender. So you will write one more thing which institute has not written. Less dividend to be compensated to stock lender. Dividend to be compensated to stock lender, 25 rupees into 1000, 25,000. 25,000. So net loss in the first scenario will be, already there is a loss of 1,01,100 and plus 25,000, so 1,26,100 will be the loss if you consider dividend also, which the short seller has to compensate to the stock lender. And in the second scenario, the net loss would be 13,800. In the second scenario, the net loss will be 13,800. Now write down question number 3b. Question 3b, same question was asked in November 2020 exam for 8 marks. Okay, they are just copying and pasting from earlier exams, which means the student has to solve all past exam question very nicely. Okay, in our class note we have covered all past exam question, RTP, MTP question. That is why it is little bulky, and sometimes the size of video lecture is also high. But then now the student will understand the benefit that when you solve all questions in the class, you are more confident in the exam. Following are the three mutual funds: growth fund, balance fund, regular fund, and this is market detail. Market detail will be required for some calculations. This is their average return. This is variance, means sigma square, standard deviation square. Coefficient of determination means R square. Correlation square. If you don't know this, you won't be able to solve and you will lose 8 marks. The yield on 182 days treasury bill is 9% per annum. So RF is 9%. Rank the funds as per Sharpe ratio. Average return minus risk-free return upon sigma. Trainer ratio R minus RF upon beta, and you have to rank. Compare the performance with the market. Compare the performance with the market. So for market also will compute Sharpe and trainer. I need sigma. Variance is given. I'll take square root. I need beta. So I have to apply the formula for beta R into sigma E upon sigma M. This will give me beta. So first what I should do, first we should find out the standard deviation and beta from the given information, and then we can compute Sharpe and trainer ratio. So write down step 1. Very easy question, only use of formula. Very easy. Start. Calculation of standard deviation and beta. Calculation of standard deviation and beta. Right hand side 4 columns. Please write down growth fund, balance fund, regular fund and market. Presentation is equally important. This you will learn when you solve with me. Given variance in the question 92.16, 54.76, 40.96 and 57.76. Standard deviation, write down sigma, that is variance. Square root of variance. Square root of variance. Type on your calculator 92.16, press the square root function. Tell me the answer. Yes, come on. What is the answer? 9.60. Very good. Next one. Come on, answer. 7.40. Next one. Answer please. 6.40. Market also. 7.60. Now write down coefficient of determination, R square. Everybody should participate. R square is given 0.3025, 0.6561, 0.9604. Very good. So now you tell me coefficient of correlation, which is under root R square. Under root R square. Again take your calculator. Mr. Dongre. 0.55 is right. Amazing. Next one. 0.81. Come on, next one. 0.98. Now we will compute beta. The formula for beta in this example, R into sigma S upon sigma M. Where is R? This is R. Where is sigma S? This is sigma S. And this is sigma M. 0.55 into 9.6 divide by 7.60. So that comes to 0.695. Very good. Next one. Come on, keep replying. Keep replying. Next one. 0.81 into 7.40 divided by 7.60. 0.789, and in the same way you'll get the third answer, 0.825. You can write in 3 digits or 4 digits. One student is saying 6947. This is also right. You can write in 3 or 4 digits. Now we'll compute Sharpe ratio and trainer ratio and give the ranking also as per Sharpe and trainer. So next heading is calculation of Sharpe ratio and trainer ratio. Calculation of Sharpe ratio and trainer ratio. Please reply. Draw the format first. Fund, Sharpe ratio, trainer ratio, ranking. Under ranking, draw 2 columns, Sharpe, trainer. First write down growth fund. Growth fund, R minus RF. Look at the question, return is 7, risk-free return is 9. 7 minus 9 divided by standard deviation, 9.60. 0.208. Trainer ratio 7 minus 9 divided by 0.695 beta. First we'll complete these 2 columns, then we'll give ranking. For balance fund, 6 minus 9 divided by 7.40 minus 0.405 and 6 minus 9 divided by 0.789 minus 3.802. Come on, regular fund, try yourself. Yes, reply. Regular fund Sharpe ratio minus 0.625 minus 4.84 minus 4.84. Now let us rank them. All are negative. Lower negative is better than higher negative. So rank will be 1 for growth fund under Sharpe. Then this is between the two, second, and this is worst, third rank. Same thing for trainer. This is first rank because it is the lowest negative. This is the highest negative. So 1, 2, 3. So all are negative, but we have to give rank because the question wants us to rank them. So this is my second answer. Now we have to also find out the Sharpe ratio and trainer ratio for the market and compare. So student will write step 3. Step 3. Calculation of Sharpe ratio and trainer ratio of the market. Calculation of Sharpe ratio and trainer ratio of the market. Student can ask any doubt if they have. Tomorrow we are going to take financial reporting April 23 MTP analysis. FR MTP April 23 analysis will also be taken on the YouTube live at 5 o'clock. So you can watch it live tomorrow at 5 o'clock, or later on you can watch it on the YouTube. You can inform your friends also. FR MTP April 23 live tomorrow at 5 p.m. Sharp ratio for market will be 9 minus 9 divided by standard deviation. This comes to 0. And trainer ratio 9 minus 9. What is 1? Beta of market. In some earlier problem also, we have taken beta of market as 1, so 0. So at least market is 0, but all mutual funds are negative. So who has performed better? Mutual fund is negative. Market is 0. Please reply. Who has performed better? Who has performed better? Mutual fund or the market? Negative return is not good. At least 0 is okay. 0 is better than negative. So write a small note and complete the answer. Note: the performance of the fund is very poor. Performance of the fund is very poor. Yes, Mr. Sagar, you are right. Market is better. Funds have performed very poorly. The performance of the fund is very poor since all values are negative compared to market performance. So we have completed 3 answers in detail out of 6 answers. So I'll just repeat. I have prepared FR and SFM video lecture in English and Hindi, and I have also prepared the revision lectures of FR and SFM, which are also available in English and Hindi. They are going to cover, revision lecture are going to cover all the theory and important questions. Regular lectures will cover almost all questions from study material RTP, MTP. So you can subscribe or purchase from our website pino.in. Please also request your friends, suggest your friends to buy, and also subscribe to YouTube channel AS Foundation, because I am going to come out with more classes on MTP, RTP, etc., and also advise your intermediate friends also that they should go to the correct faculty who can teach them conceptually, teach them the presentation. They can ask the doubt whenever they have, either directly online or by mail or WhatsApp. If you have any query, you can mail me at this address. Please note down: vinod_ca@yahoo.com, and our WhatsApp number is 976692180. So you can WhatsApp on this number. When you are sending the query, please write the query in detail. Query should be written in sufficient detail for me to understand, and if possible, send the photo of the question and answer on which you have doubt. This will help me to answer your query quickly and in a better manner. Remaining 3 questions we will take subsequently, because it will take again another 2 hours. So I also and you also need to have a small break. We will take it after some days. It will be announced on our YouTube channel. The second part of this MTP will take it after 1 or 2 days. So thank you everyone for watching this video lecture, and I wish you all the best. Hello, good evening. Welcome to CA Final SFM April MTP. So we are going to take remaining questions of CA Final SFM April 2023 MTP. In case if you don't have this MTP, please go to our website vino.in and download the MTP from our website vino.in. You will find on the home page there is a free resource section. So you will find the question paper and the answer also. So I request all of you that first you download this paper, take the printout of this paper, keep it in front of you, because today we are going to take question number 4, 5 and 6, which are very important, and they have been asked in the exam. They will be asked in the exam in the past. So trust me, you have to really follow my instruction today. Take a notebook, take a pencil, pen and calculator and this question paper SFM April 23 MTP in front of you. Okay. So here we are going to start this amazing question number 4A, which was already asked in the past exam. So it is a past exam question repeated in the MTP, and this question is based on adjusted present value. Normally they don't ask question on this, but this was a little exception. If the student has not studied APV method, he will not be able to solve. So this is a question of adjusted present value under capital budgeting. The management of multinational company TL Limited is engaged in the construction of infrastructure. Project A proposal to construct a toll road in Nepal is under construction of the management consideration. So the project is toll road in Nepal. The following information is available. The initial investment will be in purchase of equipment costing rupees 250 lakhs. So this is my initial investment. Life of the equipment. This equipment will have a life of 10 years. For depreciation purpose, will take 10 years. The depreciation on the equipment will be charged on straight line basis. Very easy. Straight line will make your calculation very easy. EBITDA, earning before interest, depreciation, tax and amortization, will be collected from toll road is projected to be USD 33 lakh per annum. So this is your earning before interest, tax, depreciation and amortization, 33 lakh per annum, underlined for a period of 20 years. Now students, please be careful. Equipment has a life of 10 years. But the collection of toll revenue will be for 20 years. So it is a 20-year project. For depreciation purpose, take 10 years. But for cash flow purpose, take 20 years. For cash flow purpose, take 20 years. To encourage investment, Nepalese government is offering a 15-year term loan of USD 150 lakh at an interest rate of 6% per annum. So what you can do, you can take a loan for 15 years. Amount of the loan is 150 lakh and the rate of interest on the loan is 5%. The interest is to be paid annually. So every year you are going to pay 6% of 150 lakhs as interest, 9 lakhs per annum. For 15 years you have to pay interest. The loan will be repaid at the end of 15th year. In the 15th year, you will repay 150 lakh. So all these figures will be required for calculation purpose. You have to know exactly the timing of the cash flows. Depreciation will be for 10 years. Cash flow will be generated from the project for 20 years. Loan is for 15 years. So accordingly, do the calculation. The required rate of return for the project under all equity financing, underline all equity financing is 12% per annum, which means the cost of equity is 12% if there is no debt. If there is no debt, this is called cost of equity of an unlevered firm. In case of adjusted present value method, first we assume, only assume, hypothetical assumption that the project is fully financed out of equity, and therefore calculate the cash flow from equity's point of view and use the cost of equity of an unlevered firm for discounting purpose. So fortunately this 12% is given to you. And in case if you are using any debt, the tax advantage of using debt will be separately calculated and will be added to the base NPV, that will give you adjusted NPV. So for that purpose they have given you post-tax cost of debt is 5.6% per annum. Underline the word post-tax. So 5.6% is per annum. Corporate tax rate is 30%. If I ask you what is the pre-tax cost of debt, so you will say pre-tax cost of debt is 8%. The pre-tax cost of debt is 8%. This is used to calculate the present value of tax shield on interest. This will be required for calculating the present value of tax shield on interest. You are required to advise the management on the viability of the proposal by using adjusted present value method. And now you see they have given you some factor also. 12% 10-year annuity factor, 12% 20-year annuity factor, 8% 15-year annuity factor, and 8% 15-year single cash flow factor is given. So 12% will be required for PV of cash flow, 8% will be required for PV of cash flow related to debt financing. So that is why two discount rates are given. I hope you have done this question in your classes. If not done, then do it now and also mark it very important. Trust me, this question can be asked in the exam. So in adjusted present value method, what we do, we first calculate the value of the project as if it is financed by equity. I will dictate everything as if it is financed by equity. Use cost of equity of an unlevered firm as discount rate. But the firm is not using only equity, the firm is using debt also. So you will add the present value of tax shield on interest on debt. Because you are using debt, debt has an advantage, you pay interest, and on interest you get tax shield. This will remind you of one chapter done in the intermediate FM, value of an unlevered firm and value of a levered firm. You might have studied, I don't know, value of a levered firm is calculated as if it is all equity financed by using the cost of equity of an unlevered firm. And then if it is a levered firm, because the firm uses debt, it gets tax advantage. They will add the present value of tax shield on interest. To that extent, the value of a levered firm is more than the value of an unlevered firm. We have used the same logic in adjusted present value method also. So I am going to dictate line by line what is APV, how the calculations will be done. In this question, lot of things are directly given to you. Had it not been given, then we would have computed it. So what you do, first you write down one small note. This is not for exam, this is for understanding, and this is for writing a theory question in the exam. If they ask you what is adjusted present value method, so start. I'll dictate slowly. Note on adjusted present value method. Note on adjusted present value method. Note on adjusted present value method. Right. APV method is the NPV of the project. APV method is the NPV of the project if financed solely by equity. So first you assume, first you dream as if the project is financed solely by equity and calculate NPV. But if the firm is using debt, the NPV will be higher to the extent the present value of all the benefits of financing plus the present value of all the benefits of financing. So that is APV method. NPV assuming equity financing plus benefits of debt financing. Steps write down. Step number one, compute NPV. Compute NPV assuming that it is fully financed by equity. Compute NPV assuming that it is fully financed by equity. Compute NPV assuming that it is fully financed by equity. Now write down, discount the cash flow using cost of equity. Discount the cash flow using cost of equity. Discount the cash flow using cost of equity. Now how do you get cost of equity? That is important. In this question it is given. If not given, then this line will be required for your next exam. Cost of equity is based on unlevered beta. Cost of equity is based on unlevered beta. Cost of equity is based on unlevered beta. Unlevered beta means beta of a firm which does not use debt. How to calculate unlevered beta? Please refer portfolio management chapter. We have discussed there, so today we will not discuss it here. We have discussed how to get unlevered beta in portfolio chapter. This is called base case NPV. So this is called base case NPV. If the firm is using only equity, what will be the NPV? That is base case NPV. Step 2, write down, compute the issue cost or the flotation cost. Compute the issue cost or the flotation cost. This is already in today's value because issue expenses will be incurred now, so it's already present value and represents an outflow. If there is any flotation cost, that will be treated as an outflow in year 0. Very easy. In this problem, this line is not required, but suppose in your exam something like this happens, you can consider that in year 0. Because it is in year 0, discounting is not required. Step 3, write down. Step 3, write down, compute PV of tax shield. Compute PV of tax shield on interest on debt. This is the benefit of debt financing. PV of tax shield on interest on debt. Now what about the discount rate? Discount rate will be used pre-tax cost of debt as discount rate, because we just require time value of money. We will not use cost of equity here as a discount rate. Cost of equity includes risk premium. As far as interest on debt is concerned, it is predetermined. So it does not have the risk element. It does not have the uncertainty element. So I just need a discount rate which is purely time value of money, does not include the risk premium, and that is your pre-tax cost of debt. Some students are asking me why we are using pre-tax cost of debt. So I have written this line. In case if you want to write down why we are using pre-tax cost of debt. Not relevant for the answer, but for understanding. Please write little fast. The logic for pre-tax cost of debt. The logic for pre-tax cost of debt lies in the assumption that so what is the logic? Cash flow arising out of tax saving is as risky as cash flow from the debt. Cash flow arising from tax saving is as risky as cash flow from the debt. Now one more important line. If we are very sure of receiving tax shield, that means you are dead sure, 100% sure that yes, tax shield is 100% certain. There is no uncertainty. Company is bound to receive tax shield on interest. We will have sufficient taxable income in future and therefore will get tax shield. So what the company can do? If we are very sure about receiving the tax shield, we can use risk-free rate of interest. We can use risk-free rate of interest. And now write down this step number 4, adjusted NPV. So how will you get the adjusted NPV? First you calculate base case NPV using cost of equity as a discount rate, assuming only equity financing, minus any flotation cost if given, not in this problem, and plus PV of interest tax shield. Now institute in the answer has covered the entire impact of financing. So therefore there can be an alternative answer also. Write that also, because we have to appear for the exam also. So we have to be on the same page as that of the institute. Right. Note, instead of calculating PV of interest tax shield, we will solve by both the approaches. We will only consider tax shield on interest, and we will also consider PV of entire impact of financing by debt. PV of entire impact of financing by debt. Up to this you don't need to write in the exam. This was for understanding. This was for writing a note on APV. So APV method first assumes that project is fully equity financed. Compute NPV as if it is only equity finance, and if the firm is using debt also, then you will also take into account the benefits of debt financing, which is usually the tax shield on interest. For exam purpose, you will start from step number 1. Please write down calculation of CFAT. We will divide into 2 blocks for year 1 to 10 and year 11 to 20, because year 1 to 10 you will get depreciation deduction, but 11 to 20 depreciation will not be there. First point A, write down earning before interest, tax, depreciation and amortization, EBITDA, which is already given in the problem 33 and 33. Question in front of you. Less depreciation per annum. 250 is the cost of the asset. Life of the equipment is 10 years. So first 10 year depreciation will be 25. Second 0. So we'll get PBT. We'll get PBT in the first 10 year 8, 11 to 20, 33. Then we'll write tax at the rate of 30%. Tax at the rate of 30%, 2.4 and 9.9. CFAT would be, calculate and tell me. This is your cash flow before tax depreciation, and this is your tax outflow. So what you do, take A minus D, or if you want C minus D plus B, whatever suits you, whatever helps you to understand, you can write and give me the answer 30.60 and 23.10. So this is my CFAT if it is only equity finance. We have not considered here interest or repayment of loan. That will consider as a separate calculation. So when you are assuming it is only equity finance company, where is the question of considering interest and repayment of loan in the cash flow right now? We'll consider it later as a benefit of debt financing. Now write down step 2, base NPV. Base NPV means NPV of an all equity financed firm. NPV of an all equity finance firm. Come on student, write down the format. If you have any query, you can ask me right now. If you don't have query, draw the format: year, particular, cash flow, PV factor 12% is given for equity, otherwise we'll have to find it out ourselves using unlevered beta. Cost of equity, if not given, use this formula RF plus beta unlevered into RM minus RF. But in this question it is given, otherwise the student will use this formula. This question is really very important. I hope you have noted it down. Year 0, write down initial investment 250. Year 1 to 10 CFAT as per step 1. First 10 year 30.60. Factors are given in the problem. So good news is that you don't have to calculate the factor. Factors are given in the problem. So just copy from there 5.650 and multiply. You get 172.89. Year 11 to 20 CFAT. Again we have already done in the step 1 23.10. Look at your question book. Factor is given 7.469 is given. That is for 20 year, minus 5.650, that is for first 10 year. So the difference is the factor for 11 to 20 years. Multiply. Don't directly take 7.469, you will make a mistake. So 40.169. Take the total of this. This gives you base NPV. So if it is only equity finance firm, the NPV is negative. But wait, this firm is using debt also. So there are some benefits of debt financing. Step number 3, write down. Step number 3, PV of impact of financing by debt. PV of impact of financing by debt. In bracket must write down, in bracket you must write down all aspects of loan considered. All aspects of loan considered. All aspects of loan considered means we will take the loan amount, we will take the interest, we will take the tax shield on interest, we will take the repayment of the loan also. So write down this table. First column year, particular, cash flow, but be careful. Now I am going to take 8% as a discount rate. PV factor at 8%. Sir, how did you get 8%? Post-tax cost of debt is given 5.6%. Tax rate is given 3%. So pre-tax cost of debt will be 7%. Sorry, 8%. So I will use 8% discount rate. Use pre-tax cost of debt. Note is already given to you for that. We are assuming cash flows are as risky as the tax shield is as risky as the cash flow which is being generated by the loan. So loan amount is 150. Loan amount is 150. Interest will be paid every year. 6% of 150, 9. If you look at your question book, the factor is given 8.559 given. Multiply into 9, 77.031. Please reply if you have a doubt. 1-15, you will get tax shield on interest on 9 at the rate of 30%. You will get 2.70 as tax shield inflow into same 8.559. How much you are getting? 23.109. Okay. Year 15, repayment of loan. Repayment of loan is 150. Repayment of loan is 150. So 15th year factor is 0.315. This is also given in question book. This is given in the question paper. Multiply 47.250. Now the student will give me the total of last column. Only when you will give me the total, I will go add. Otherwise, I will keep sitting. Total of the last column. Yes, please. Total of the last column is how much? This is 48.828. This is the PV of impact of debt financing. If you go with debt also, this is the PV of debt financing. Now write down adjusted NPV. Now write adjusted NPV. Adjusted NPV will be base NPV minus flotation cost plus any benefit of debt financing. Right hand side rupees in lakh, sorry USD in lakh, because this question has USD. USD in lakh. Base NPV negative 35.0911. Flotation cost is not there. Debt financing is there. PV of debt financing 48.828. So now take the total. This total is called adjusted NPV. So total of A plus B is positive 13.737. If I take all cash flows into consideration, my adjusted NPV is positive. So I will write a note. Since adjusted NPV is positive, TL Limited should accept the project. TL Limited should accept the project. This is one answer. The institute has given one more answer, and we will also follow the same. Instead of taking all cash flow associated with debt financing, we will only consider the benefit of debt financing in the form of PV of tax shield on interest. Very good, Mr. Sagar. Your answer is right. Enjoy. Write down one more note. We'll solve it one more time. Lengthy question but manageable, and you'll get full 8 to 10 marks. Alternatively, instead of PV of overall impact of financing, the PV of impact of tax shield on interest is considered. PV of impact of tax shield on interest is considered. Then adjusted NPV will be. So now I will only consider the PV of tax shield on interest already computed earlier. You can check there. We can write the same figure already computed. Write down base NPV. Base NPV, write 35.0911 negative. PV of tax shield on interest already calculated in the step number 3. 23.109. Now you tell me the total. Again, please reply total. So what will be adjusted NPV? If I only consider the PV of taxation on interest, 11.9831, 11.9831. Write down advice. Since NPV is negative, project should not be accepted. Since NPV is negative, project should not be accepted. If this question comes in the exam, write both answers. Okay, write both answers. You can't trust institute. Okay, so this is right answer. Thank you very much those who are replying. Any query on this now? Now we'll come to question number 4B. Question number 4B was on mutual fund. This is also past exam question. Write down here past exam question. I think somewhere in the year 2015 this question was asked, and now they are asking in the MTP also. A very easy question. Let us solve it together. Take out your notebook, keep the calculator ready and follow me. There are two mutual funds D, K, each having closed-ended equity scheme. So it's an equity scheme. NAV on 31/12/2014. The institute have not changed the date also. The same date was appearing in this 15 exam. NAV on 31/12/14 of equity scheme of D mutual fund is 70.71. Now out of this 70.71, 99% is equity and 1% is only cash, and the balance is cash. And that of K mutual fund is 62.50 NAV, 96% is equity and balance in cash. So first we will find out how much is equity component and how much is cash component in both the mutual funds. Following is the other information. Equity scheme DK, Sharpe ratio. The formula is R minus RF upon sigma. Trainer ratio R minus RF upon beta. And then the standard deviation is given to you. Sharpe ratio, Trainer ratio, standard deviation. There is no change in portfolio during the next month. There is no change in portfolio. So portfolio remains the same. Portfolio remains the same means it comprises of the same equity share and some cash. And the annual average cost is rupees. Underline the word annual. Annual average cost is rupees 3 per unit. 3 rupees per year divided by 12 months. So that is 25 paise per month is your expense. 25 paise per month is expense. Because you incur 25 paise expense, your cash balance will reduce by 25 paise. Cash balance will reduce by 25 paise. Now the question says, if the share market goes down by 5% within a month, share market goes down by 5%. So what will happen to the equity? The share market goes down by 5%. The equity will go down by 5 into beta. The equity will go down by 5 into beta. These two mutual fund comprises of 99% equity and 96% equity. Okay. So the value of the equity portion will decline to the extent of 5 into beta, which means we need to find out beta from this information. We need to find out beta from this information. Now it says calculate expected NPV after a month for both the scheme. So you have to again find out the NAV. NAV will be equal to equity plus cash. Equity will fall to the extent equal to 5 into beta. Cash will fall to the extent 25 paise, and that will give you NAV after 1 month. So the missing figure basically is beta. Once you are able to calculate the beta of these two schemes, you will be able to apply the beta and find out what will be the revised value of equity portion, and you will be able to solve. Consider 12 months in a year and ignore number of days. So we will take 1 month for calculation, and for expense per unit I will take 3 rupees divided by 12 months. Anyway, this is not very important. So first step 1, write down. First we will check at the beginning of the month how much is the equity portion and how much is the cash portion. Right. Decomposition of funds in equity and cash component. Decomposition of funds in equity and cash component. Right hand side 2 columns, D mutual fund, K mutual fund. Question in front of you. Take the printout of your MTP April 23. Keep it in front of you. We are solving question number 4B. NAV on 31/12/14. First and second paragraph. Second paragraph you will find 70.71, 62.50 less percentage of equity. How much is equity? 99%. How much is equity in K? 96%. So can you find out equity element in NAV? So simply multiply 99% of 70.71. Yes, Mr. Dongre, please reply. What is equity element in first mutual fund? 70. Second mutual fund, yes, second mutual fund, reply please fast. 60 rupees. So can we find out the cash element? Yes, cash element in NAV A minus C. 71 paise. Very good. And second one 2.50. Very good. So this is my existing equity and cash. This will fall by 5 into beta. This will fall 5 into beta once we calculate beta, and this will fall by 25 paise because of expense incurred, and that will help me to calculate the revised NAV after 1 month. So the main task in this question is to find out beta. So write down below step number 2, calculation of beta. Calculation of beta. Come on, calculation of beta. All of you know Sharpe ratio is R minus RF upon standard deviation. So R minus RF will be equal to Sharpe ratio into sigma, and trainer ratio is R minus RF upon beta. R minus RF you will get from previous calculation. Trainer ratio is given, so we can find out missing figure beta. So first what I'll do, I'll find out what is the value of R minus RF using Sharpe ratio, and using that R minus RF and trainer ratio we can find out the beta value, right? Start. Point number A, D mutual fund. Point number A, write down D mutual fund. Under D mutual fund, Sharpe ratio, write down. Sharpe ratio 2 is equal to R minus RF upon sigma D is equal to R minus RF upon standard deviation of D mutual fund is 11.25. So cross multiply 2 into 11.25 will give you 22.5. So R minus RF, expected return minus risk-free return, is 22.5. Use this value in the next ratio and find out the beta. So trainer ratio equal to, write down the equation, question in front of you, 15 is equal to R minus RF upon beta of D. This 22.50 already calculated here. This you shift here. So cross multiply beta of debt into 15 is 22.5. So beta of debt will be 22.5 divided by 15. Come on, reply. What will be beta of debt? What will be beta of debt? 22.5 divided by 15. That comes to 1.5. Very good. Same way, please calculate and give me the beta of K mutual fund. Yes, start yourself. In the same way, student will now reply, what is the beta of K mutual fund? Kindly participate. Everybody. Beta of K. Beta of K mutual fund. Here also write down Sharpe ratio equal to 3.3 equal to R minus RF upon sigma K, this is sigma, standard deviation K, is equal to R minus RF upon 5. Cross multiply R minus RF is 16.5. Very good. Now tell me what will be beta of K mutual fund. Trainer ratio is 15 is equal to R minus RF upon beta K is equal to 16.5 upon beta K. So student will reply, what is beta of K mutual fund? Come on, come on. Yes, beta of K mutual fund. 16.5 divided by 15. 16.5 divided by 15, and that is 1.10. Very good. 1.10 is right. Now write down decrease in the value of equity. Decrease in the value of equity. So equity value will decrease to the extent of 5 into beta, because market has gone down by 5%. So the value of the equity will go down by 5 into beta. So point A, write down market goes down by 5%. Market goes down by 5%. Then write down beta 1.5, 1.1. 1.5, 1.1. Now you write down, therefore equity goes down by, therefore equity goes down by, therefore equity goes down by, multiply the two, 7.5%, 5.5%. Value of the equity element will decrease by this percentage. Okay, so this is my next step. Number 4, balance of cash after 1 month. Balance of cash after 1 month. You will get step marking. Write your answer in more and more number of steps, easy steps, D and K. First write down cash in hand. You can just write D and K. Cash in hand on 31/12/14. Cash in hand on 31/12/14 is 0.71 and 2.50. Less expense per month, 3 rupees divided by 12 months. 3 rupees divided by 12 months. 0.25. Cash balance after 1 month per unit. Cash balance after 1 month per unit, A minus B. A minus B, 0.46. And second column, come on, second column, 2.25. 2.25. Now write down last step 5. This way you have to divide the answer into small steps. So if it is a 5 mark question, you will get full 5 marks. 10 mark question, you will get full 10 marks. Okay. Just taking everything on calculator and directly putting it, for our exam purpose, it will not give you marks. 2 things are important: learning the concept also and learning the presentation part also. So student will write step 5, NAV after 1 month. NAV after 1 month, right hand side 2 columns, D and K. First write value of equity after 1 month. Value of equity after 1 month. So first you will take value of equity on 31st December 2014 minus 7.5%. This was the value of equity already calculated in some earlier working note. Minus 7.5%. Just write down minus 7.5%, if that helps you to understand. So that comes to 64.75. And similarly, this is 60 minus 5.5% will be second answer. Come on, 60 minus 5.5%. That is 56.70. Cash balance write down. Cash balance. Go to step number 4, you will find 0.46, 2.25. Very good. Very good. Those who are replying, you are really good student. Now write down NAV after 1 month. Just add these two numbers. First answer will be 65.21 and second answer will be 58.95. Check, is it 58.95? So this is my answer of question number 4B. Now we'll take a very important question. This question is from portfolio chapter, and this question is a repeat question. It was asked in the exam, but they have made some changes in the problem. Similar problem we have done in the class, but this time they have made some changes in the problem. Actually they have made it a easier problem than what it was asked in the exam. Start. Mr. A owns a portfolio with the following characteristic: security X, security Y, and risk-free security. Beta of security X 1.6, Y is 1.8, risk-free as you know is 0. Even if it was not given, suppose it is not given, you will assume to be 0 beta for risk-free security. Expected return 15%, 16%, RF is 7%. If Mr. A has rupees 2 lakh to invest, 2 lakh, we will call it own fund. Own fund is 2 lakh. Sales short rupees 1 lakh of security B. So what happens in short selling? You will sell the stock now and buy it later. And how do you sell it now? By borrowing it from somebody else. That is called stock borrowing and lending mechanism. So when you sell the stock today, you will get a cash flow of 1 lakh. So plus 1 lakh. So total amount available with you is 3 lakh. 2 lakh own fund and 1 lakh from short selling B and purchases rupees 3 lakh of security A. So what is the position on stock A? Long position 3 lakh. What is the position on stock B? Short position amount 1 lakh. Short position is negative. Long position is positive. What is the sensitivity of Mr. A's portfolio? Sensitivity of Mr. A's portfolio means, given the data, beta of portfolio is weighted average beta. Weighted average beta. These are the beta of X and Y. I have written A and B, it should be X and Y, okay? X and Y, and just multiply by the weights. So 1.16 into weight of X plus 1.80 into weight of Y is equal to portfolio beta. This will be your first answer. You get 2 to 3 marks for this much effort, but the important thing is, what is the weight of stock A and stock B? That I will tell you later. You keep thinking. Keep thinking what is the weight of X and Y. Now they have just asked the same question by adding one more variable. Listen to me. Suppose Mr. A has already got 2 lakh. Own fund 2 lakh. Now it says, if Mr. A borrows rupees 2 lakh at the risk-free rate and he borrows 2 lakh, so he has got 4 lakh. Earlier in this question, he had own fund of 2 lakh. Now before short selling B, he has total 4 lakh rupees in his pocket and invest the amount he borrows. Invest the amount he borrows along with the original amount of 2 lakh. Along with original amount of 2 lakh. So total is 4 lakh in security X and Y in the same proportion as described in part 1. In part 1, what had happened? We had 2 lakh in X. We had 2 lakh in X long position and we have 1 lakh short in Y. So basically the ratio is, if you have 2 lakh rupees, you are short selling half of that. So the ratio is, if you have 2 lakh rupees cash with you, you will short sell 1 lakh of B. Now on the left side of the screen, we have 4 lakh rupees cash with us. What will be the short selling of B? We always short sell half of what cash we are holding before that short selling. Earlier it was 2 lakh versus 1 lakh. So now it will be 4 lakh versus 2 lakh short selling of B. So once I do short selling of B, I will get 2 lakh rupees cash. So I will have 6 lakh rupees with me now. 2 lakh own fund, 2 lakh borrowed funds, 2 lakh from short selling. So I get 6 lakh. This 6 lakh rupees will be invested in stock Y. So my amounts will be as follows. 6 lakh rupees invested in X, long position. 2 lakh rupees short position in Y, and 2 lakh rupees I will borrow. So this will be my portfolio in the second situation. This will be my portfolio in the second situation. So one student has replied about weights. I will check it later. Just wait. What is the sensitivity of the portfolio? So sensitivity of the portfolio is same, weighted average beta. So you have to recalculate the weight of XY and the borrowing, multiply by the respective beta, and you will get the sensitivity of the portfolio. And the next question is, what is expected market risk premium? So you have to find RM minus RF. You are given expected return, you are given beta, you are given RF. RF plus beta into RM minus RF is expected return. So put the values and you'll get the value of RM minus RF. Either you can use security X to answer, or you can use security Y to answer this question. Is it right? So let us check the weights in first answer. Very easy question. Write down answer of question 5A. Own fund is 2 lakh. 5A part 1. First we will solve part 1. So part 1, write down own funds 2 lakh. Short sale of Y 1 lakh. Total funds available 3 lakh. Total funds available 3 lakh. This 3 lakh will be invested in stock X, long position 3 lakh, Y limited short position 1 lakh. This diagram is for understanding purpose. Okay. In the exam we don't have much time, so we can avoid this diagram and directly start with the weights. So write down step number 1, weights. Weight, write down stock calculation and weight. Stock calculation and weight. First, stock X. Total amount invested is 3 lakh. Amount invested in stock X is 3 lakh and total is 2 lakh. Sir, how the total is 2 lakh? How the total is 2 lakh? 3 lakh minus 1 lakh is 2 lakh. The total in the denominator will be 2 lakh. So weight is 1.5, and for Y the weight will be minus 1 lakh divided by 2 lakh, that is minus 0.5. So the student had given right answer. Total should be 1. Should be always 1. If it is not 1, you are making a mistake. Second thing, one trick I will tell you. One trick. Denominator should always be own funds. That is own fund. Do not include short selling amount, do not include borrowed amount. Denominator should always be own fund. Then one more thing you should know, short selling will have negative weights. So if you have done short selling, it will have negative weights. So 3 things I have dictated for understanding purpose. Total of the weight should be 1. Denominator should be own fund. Short sold item will have negative weight. Now write down step number 2. Sensitivity of Mr. A's portfolio. These are the weights. Beta is given. So I am asking you a question. What is portfolio beta? Multiply this with their respective beta. So beta of X is 1.6 given in question. Weight is 1.5. Beta of Y is 1.8. Weight is minus 0.5. Kindly solve. Yes, please solve. What is the answer for first part? Check the answer. 1.5. Is the answer 1.5? Yes. Now come to answer of part 2. Write down answer of part 2. Own fund is 2 lakh. Borrowing is 2 lakh. So the funds available is 4 lakh. Fund available is 4 lakh. Now there is a condition. Follow the same ratio which was in the previous part 1, X and Y. Previous question, part 1, 2 lakh own fund, short selling 1 lakh. Now I have got 4 lakh rupees with me. What is the short selling I will do for Y? So short selling I will do for Y is 4 lakh. 4 lakh, sorry, 2 lakh. So short selling of Y will be 2 lakh, so that we will follow the same ratio as in question number 1. Okay, 2 lakh. So the amount available now is 6 lakh rupees. 2 lakh plus 2 lakh plus 2 lakh is equal to 6 lakh. Now write down the breakup once again for presentation. This is only for understanding. Sir, we don't have time in the exam. Then don't draw this diagram. If you have time, then you will draw. If you have time, then you will draw. Okay. So we have investment in X Limited 6 lakh, long position, borrowing 2 lakh, and Y Limited short position 2 lakh. This is our portfolio. Now we have to assign weights. If you take the total of these three, the total comes to 2 lakh. So this 2 lakh I will keep in the denominator for the purpose of weights. Right? Now write down step 1. Same format. Calculation of weight. X. 6 lakh is the investment in X. Divide by total 2 lakh. 3. Very good. Y. Minus 2 lakh divided by 2 lakh. Student has already replied. Minus 1. Borrowing. Minus 2 lakh divided by 2 lakh. Minus 1. Cross check. Total should be equal to 1. Total should be equal to 1. Now, these are the weights. You have to multiply by their respective beta, which is given in the table, and take the total. That will be your sensitivity of the portfolio. So write below step 2, sensitivity of Mr. A's portfolio. Come on, reply now. I will wait for your answer. 1.6 into 3 plus 1.8 into minus 1 plus 0 into minus 1. What is the final answer? Anybody final answer? I am not dictating the answer. You are calculating, I am writing. Okay. But this way of presentation helps us to save lot of time. We have to do lot of homework before coming to the class. This kind of presentation requires lot of effort, time, but it helps us to do fast and there is no mistake. So the answer was 3. Check the answer. Is it 3? Now answer of part 3. Yes, very good. Students have said 3. So next answer is, what is the expected market risk premium? So please write down. Assume that expected return is equal to required return. Assume that expected return is equal to required return. All of you know CAPM calculates required return, not expected return. So we'll assume that whatever expected return they have written, actually they mean required return. So you can either use security X or you can use security Y. You will get the same answer. For security X as per CAPM, come on, reply. 15 is your required return, RF plus beta into RM minus RF. Now I'll put the values. 15 equal to 7 plus 1.60. RM minus RF is called risk premium. RM minus RF is called risk premium. Kindly solve. Give me the answer. Student will solve and give me the answer. So the answer is 5. Market risk premium is 5. If you use Y also, then also the answer will be, for Y also, my expected return is 16. 7 plus 1.8 RM minus RF. So using stock Y also, if you try, RM minus RF will come to 5%. Just try with stock Y. RM minus RF will come to 5. Now we'll come to question number 5B. A very similar question was asked in MTP of November 21. So they are just doing copying and pasting from different sources. That will not help you in the exam, because in exam some new question will come. So I will ask you to practice more and more variety of questions. Okay. So as you know, I am taking FRN SFM batches for CA final. The lectures are available in regular and revision mode. And the lectures are available in 2 languages also. English, Hindi, for both. So it has taken a lot of efforts to prepare regular, revision and recording in 2 languages separately. We cover all the questions from study material, past RTP, MTP and past exams. So that way there is a very comprehensive coverage of the entire syllabus. So you can purchase from our website vino.in, and if you like it, you also recommend to your friends. Okay, thank you very much for watching this video. Come to question number 5 now. Very important question. Write down. Very important. One more thing, a lot of students are saying that we should only study from the study material. That is not correct, because you see, this kind of questions are not there in the study material. You have to do a very comprehensive study. This is CA final exam, not inventory management where you will do ABC analysis. That is a wrong guidance to the student. Every question belongs to A category only. There is no B, there is no C. Your life is at stake. Your career is at stake. You can't miss anything. You have to do everything. Don't take chance. Don't take chance in the exam. Anything can be asked. So let us go to question 5B. Otherwise you will say that I am only giving long lectures. Keep the SFM MTP in front of you. A textile manufacturer has taken floating interest loan of rupees 4 crore. So there is a loan taken of 4 crore on 1st April 18. Always read the problem slowly. The rate of interest at the inception of the loan is 8.5% interest. So this is my interest on the loan is to be paid every year on 31st March, and the duration of the loan is 4 years. Payment will be made annually for 4 years. In the month of October 18, Central Bank of the country releases following projection about the interest rate likely to prevail in the future. So the central bank in our country, RBI, Reserve Bank, has predicted the falling interest rate, that is on 31st March, it will be 8.75%, then 10, 10.5, 7.75. They have taken the loan at 8.5% and the interest rates are likely to increase in most of the years. So how this borrowing can hedge the risk arising out of expected rise in the rate of interest when he wants to peg his interest cost at 8.5%. Okay, so this seems to be a floating interest rate loan. It seems to be a floating interest rate loan because as the market interest rate will go up, understand, as the market rate will go up, the applicable interest rate to this company will also go up. So they want to ensure that the interest cost does not exceed 8.5%. Assume that the premium negotiated by both the parties is 0.75% to be paid on 1st October 18. So this is a question of using the interest rate option for hedging the risk. Interest rate option, and your interest rate you want to lock at 8.5. For that you are willing to pay a premium of 0.75, and the actual rate of interest on respective due date happens as follows. So what this company will do, company will buy a cap, which means buy call option. If the interest rate is greater than 8.5%, you will get the difference. If the interest rate is less than 8.5%, option will lapse. Option will lapse. If the interest rate is less than 8.5%, option will lapse. In the first, second and third scenario, the option holder will receive the difference, and in the fourth scenario, the option would lapse because it is below 8.5%. But for getting this option, you will have to pay what is called option premium, which is 0.75% of the loan amount. So the question is, show how the settlement will be executed on the respective interest due date. You can solve on the calculator also, it is so easy. In the first case, it will be 10.2 minus 8.5% of 4 lakh. In second case, 11.5 minus 8.5% of 40 lakh. In the third case, 9.25 minus 8.50% of 40 lakh. In the last case, you will write the option would lapse because it is below the exercise price. And for this basic effort, you will get only 6 marks. 6. Okay, let us write a note first. Only directly writing the answer will not give you full 6 marks. So I will urge the student that do some writing practice along with me. This is a highly potential question for your exam. Highly potential, write down, highly potential, whichever exam you are going to appear. So first you write a note that as borrower does not want to pay, more than 8.5% per annum, borrower does not want to pay more than 8.5% per annum on this loan, where the rate of interest is likely to rise beyond this, hence he has hedged the risk, by entering into an agreement to buy interest rate cap. Cap means upper limit. You will buy interest rate cap means buying call option. Okay, buying call option, where if the market goes up above 8.5, then you will get the difference. But if the market goes below 8.5, the option will lapse. You don't have to pay the difference with the following parameters, that is interest rate cap. So what kind of agreement you will enter into? Write down. Notional principal rupees 4 crore. Is it 4 crore or 40 lakh? Whatever is written, write down. 40 lakh. Strike rate 8.5%. This figure you check and write from the question. Strike rate 8.5% means if the market rate is beyond 8.5, the call option holder will receive the difference. Then write down reference rate. The reference rate is the rate of interest applicable to this loan. That means for calculating the difference, you will take 8.5%. For calculating the difference, you will take 8.5%. Then write down calculation and settlement date. If you don't have time in the exam, then don't write so much detail. But if you have time, then write down 31st March, calculation and settlement 31st March every year, and duration of the cap till 31st March 2022. Till 31st March 2022. Means it's a 4-year problem. First point, write down the premium to be paid. Everybody please participate. Premium to be paid on 1st October 18 is 3 lakh. Sir, how did you get 3 lakh? 4 crore into 0.75%. I think in the question 40 lakh is typed. So please make it 4 crore. Please make in your question 4 crore. This is the problem of the institute. In their answer also they have made the same mistake. 4 crore into 0.75%. Type 4 crore into 0.75%, you will get 3 lakh. Now write down the payment of this premium will entitle the buyer of the cap to receive the compensation from the seller of the cap, whereas the buyer will not have obligation. All these details are given for understanding. If you don't have time in the exam, then write this line and then directly prepare the table. So next line, write down calculation of compensation received by the buyer of caps. calculation of compensation received by the buyer of caps. We'll make a table with 5 columns. First column, write down date. Second column, write actual rate of interest, which is given in the second table. The first table is not useful, that is only prediction of RBI. Second table in the question is useful. Those are the actual rate which will be required for calculating the difference. Rate of interest. Then third column, write strike rate. Strike rate. Fourth column, write down compensation in percentage. Compensation in percentage. And fifth column, write down compensation in rupees. Compensation in rupees. Very easy question. Write down on 31st March 19. Question in front of you. On 31st March 19, 10.2% is the rate of interest. Strike rate is 8.5. Strike rate is 8.5. So tell me the difference. 10.2 minus 8.5 is 1.7%. 1.7%. So you will take 4 crore into 1.7%. 4 crore into 1.7%. In the question, just make it 4 crore instead of 40 lakh. So 6,80,000. Then next, write down 31st March 2020. 11.5%, 8.5%. This time the difference is 3%. 3% of 4 crore, 12 lakh. 3% of 4 crore, 12 lakh. 31st March 2021, 9.25%, 8.5%. Very good, Sagar. 0.75%. So now you reply how much compensation will be received. Yes, reply 0.75% of 4 crore. That is 3 lakh. But the important one is the last one, where the student can make mistake. 31st March 2022, 8.25. It is a call option. Exercise price is 8.5. Market rate is 8.25. So what will you do? You will not exercise. Option will lapse. Option will lapse. And therefore you will get 0. Therefore you will get 0. Now you may forget why I have written nil here after some days. So write a note for that. Put an asterisk mark and write a note. Otherwise, after some days, you may not remember my words that this is an option, and you'll get little confused. So please write down the buyer of the caps. This is a note for this nil. Take an arrow, connect it. The buyer of the caps will not receive the compensation. The buyer of the cap will not receive the compensation, as the actual rate of interest is 8.25%, where the strike rate of the cap, whereas the strike rate of the cap is 8.5%, whereas the strike rate of the cap is 8.5%. Hence his interest liability shall not exceed, hence his interest liability shall not exceed 8.5%. Hence his interest liability shall not exceed 8.5%. So that was a good question, because if you have practiced before going to the exam, then you can easily solve in about 4 to 5 minutes and you'll get full 6 marks to 8 marks. But if you have not practiced, then deciding the format, solving may take time. If you want, you can take the total of this last column and that is also okay. You will get 21,80,000. Very good. Now we'll come to question number 6A. This question is again a repeat question based on past exams. Same question they have asked for 10 marks. Very easy, and you must solve it before going to the exam. Bonus mark, typical portfolio question asked in the exam. Must do it. It's highly repeated. Similar questions are repeated in the exam. So are you ready? Say yes, we are ready. If you say you are ready, then I will proceed further. Details about portfolio of shares of an investor is as below. Shares, number of shares, price per share, and beta. So there are three companies, their numbers are given, the price is given, and the beta is given. The investor thinks that the risk of the portfolio is very high and wants to reduce the portfolio beta to 1.125. You must have done very similar question. He is considering two below mentioned alternative strategies. So what are the two strategies? One is to dispose of a part of his existing portfolio to acquire risk-free security. So buy risk-free security and sell the shares. That will reduce the portfolio beta because risk-free security has zero beta. So this is called using risk-free asset. And second is called using future. Take appropriate position in Nifty future, which are currently traded at 5,000. 5,000 and each Nifty point is worth 500. So one lot is equivalent to 5,000 into 500. One contract is equivalent to 5,000 into 500. You are required to determine portfolio beta. Multiply these two, you will get value, convert into weight into beta. Value of risk-free securities to be acquired, number of share of each company to be disposed of, number of Nifty contracts to be bought or sold. So if you have to reduce the beta, you have to go short on Nifty future so that the loss in share will be compensated by the gain in future. And what will be the value of portfolio beta? Good question. For a 4% rise in Nifty, what will be the value of the portfolio beta for a 4% rise in Nifty, assuming that you have used Nifty future for reducing the portfolio beta? Okay, this question is very important, asked in the exam also. So I will highly recommend you to revise this a day before exam. Question number 6A, question number 5B are some important questions from this MTP. So start, please write down calculation of portfolio beta. Draw this format. Every time they ask you portfolio beta with this kind of data, use this format. Write down shares, name of the share, number of share, price, market value, weight, beta, weight into beta. Okay, question in front of you. We are solving, those who have joined late, MTP April 23 SFM you can download from our website vino.in question paper and answer. Okay. Number of shares, write down 1065 in lakhs. Question is in front of you. Price per share is given 400, 500, 600. Just multiply price and number 4000, then you will get 3000, again 3000, total 10,000. So your portfolio value right now is 10,000. This number also I will need in my answer. 4 divided by 10 will give you weight 0.4, 0.3, 0.3. Beta is given in the problem. Kindly multiply and take the total. Let us see who will give the answer first. Portfolio beta. Yes, come on. Give me portfolio beta. Final answer. Portfolio beta is 1.5. Very good. Portfolio beta is 1.5. Write down below. Existing beta is 1.5. Existing beta is 1.5. Required beta, desired beta or target beta is 1.125. So we have to find out what should be the weight of risk-free asset so that my portfolio beta is reduced to 1.125. Very good, Sagar. Come on. Now you have to write, let the weight of risk-free asset, let the weight for risk-free asset for desired beta of 1.125, for desired beta of 1.125 BW. Then write down below one equation. 1.125 is equal to 0 into W. What is 0? 0 is beta of risk-free asset into W. If weight of risk-free asset is W, weight of shares will be 1 minus W, and this is the beta of shares calculated in the previous step. So I will ask you to solve and get me the value of W. So the simplified version is now 1.50 minus 1.50 W. After you solve it, W is 0.25, means risk-free asset should have a weightage of 0.25 and shares should have a weightage of 0.75. This will be the weight of shares and risk-free asset. Now the question is, how many shares we are going to dispose for each share A, B, C. Write down next line, because that is my next question. Shares to be disposed of. How many shares you are going to dispose of for each company A, B, C to reduce portfolio beta to 1.125. So because you have to bring risk-free asset, you have to sell shares of 10,000 into 0.25. which is 2500 rupees. And how this 2500 rupees will be raised? By selling shares of all the three companies A, B, C. And in what ratio you are going to sell? In the ratio of their existing weights, so that the weights of A, B and C will continue to remain same 0.4, 0.3, 0.3. So this 2400 you will allocate in this ratio. So that will give me the value of each share to be sold. Divide by price will give you number of share to be sold. Very easy mathematics. Come on student, write down value of risk-free asset to be acquired. This is your answer of part 2. Value of risk-free asset to be acquired is equal to 2500. 2500. Now write down next line, number of shares of each company to be disposed of. Number of shares of each company to be disposed of. Number of share of each company to be disposed of. We'll prepare a table for better presentation. Share, weight, amount in rupees in lakh, market price, and last column number of shares. Number of shares to be sold. Number of shares to be sold. So this will give me third answer. Number of share to be sold in lakhs. First write down share ABC 0.4, 0.3, 0.3. Total I have to dispose shares of 2500 into 0.4 will give you 1000. 2500 into 0.3 750. 2500 into 0.3 750. Market price copy from the question book. 400, 500, 600. 1000 divide by 400. So you will have to sell shares 2.50 lakh for share A. 500, 750 divide by 500. 1.5. Last one do yourself. Last one do yourself. 750 divide by 600. 1.25. So this is answer of part 3. Now next question is number of nifty contracts to be sold. Very easy. Why I have written sold? Because my objective is to reduce risk. If the objective was to increase beta, you will say buy nifty future. The formula is, as we have discussed in the class, portfolio value into existing beta minus desired beta divided by value of one future contract. Very good. Those who are replying, I am very glad. Now you put the values. Your portfolio value in the first table was 10,000 lakhs. Existing beta is 1.5. Desired beta is 1.125. One lot of nifty future contract has a value of 5,000 into 500. So please solve and give me the answer. Solve and write the answer. How many contracts you will sell? How many contracts you will sell? So this time the answer is 150 contracts. This is my answer of part 4. Very important. And the fifth part is even more important. The fifth part says, what will be the value of portfolio beta for a 4% rise in Nifty? And you have sold 150 lots of Nifty contract. So if Nifty goes up, shares will also go up. Nifty goes up by 4%, shares will go up by 4 into beta 1.5, 6%. So the value of the share you can calculate, it will increase by 6%. If Nifty goes up and you have taken a short position, you have to pay mark to market margin. You will have to pay mark to market margin, which will be 150 contracts into 5000 into 500 into 4%. So that will reduce the asset value to that extent, and then we'll have to find out what will be the portfolio beta in that case, and I have to prove that the portfolio beta will reduce to 1.125. Okay, write down, very important, write down, very important. Students make mistake here sometime. Calculation of portfolio beta for a 4% rise in Nifty. For a 4% rise in Nifty, under that write down, rise in Nifty 4%. Therefore, rise in portfolio value 4 into 1.50. 1.50 is portfolio beta. This time I don't have risk-free security in the portfolio. I have taken Nifty short position 6%. So portfolio value will go up by 6%. It is 10,000 now plus 6%, 10,600. But then on Nifty you have loss. Short position holder will have loss. So that is 5,000 into 500 units into 150 contracts into 4%, and the amount you have to write in lakhs. Amount you have to write in lakhs. 150 loss. Therefore, value of portfolio after rise of Nifty. Value of portfolio after rise of Nifty. So you will say 10,450. 10,600 minus 150, because you will have to pay mark to market margin. Now write down percentage change in portfolio. Percentage change in portfolio. Your portfolio was 10,000 and now it is 10,450. Your portfolio value has changed from 10,000 at the beginning to 10,450. So can you tell me percentage change? 450 is the change divided by 10,000. 4.5%. 4.5%. And what is the percentage change in Nifty? 4% already given. These two are same. So now you have to find out beta. Portfolio beta after rise. 4% change in Nifty is 4.5% change in portfolio value. Change in portfolio value divided by change in Nifty value is the portfolio beta. Change in portfolio value. Very good, Sagar. 4.5% is right. So now my answer is 1.125, and you will be happy to note that this is equal to desired beta. Okay. So in the exam you have to cross check this. In your institute answer, which they have printed by mistake, they have printed I think 1.5. If those who are relying on the institute answer, please rectify. It is 1.125. That is the purpose of selling Nifty future, to reduce the beta. So Next, question number 6b. This is the last question I am going to solve. And what you do, all theory question you revise from MTP solution. Okay, theory questions are also important because 20 marks theory question you have to write in the exam. Every question has one theory question of 4 marks. So 5 into 4, whether you like it or not, you will have to solve 20 marks theory question. Question number 6b. Ram. Hey Ram. Jai Shri Ram. Radhe Shyam. Ram holding shares of Reliance Industries, Shabash Ram, which is currently selling at rupees 1000. Selling price is 1000. He is expecting that this price will further go down due to lower level of profit than expected level to be announced after 1 month. So what is the expectation? Expectation is price will fall, because only if you know the expectation you will take a correct position in the option market. As on the date, falling option contracts are available. So these are the strike prices, and these are the call options, these are the put options, and these are the premium available for different strike prices on call and put. You don't have to use the entire table, you have to only use the relevant figure. Ram is interested in selling his stock holding as he cannot afford to lose more than 5% of the value. So value of the share is 1000. He don't want to lose more than 5%. So he wants to receive in any case 950 after 1 month. In any case he wants to receive 150 after 1 month. Okay, so 5% loss he can afford. So he doesn't want to get less than 950 after 1 month when he is going to sell. Recommend a hedging strategy. Very good question. This is also past question, already asked in the past exam or past RTP. I have seen this question. It is there in our study material also. In this MTP, all questions were from past exam, RTP, MTP. That is the summary. No new question was there. Recommend a hedging strategy with option and show how his position will be protected. And show how his position will be protected means he will not have to pay more, he will not receive less than 950 when he will sell the share. So when you are expecting that the price will fall, what you can do? You can either write a call or you can buy a put. You can write a call option or you can buy a put option. So what we will do? Here's reply. What we will do? Anybody, any answer? So what we will do? We will buy a put option at exercise price of 950, because if the price falls below 950, we will be able to sell the share at 950. But at the same time, if the price goes up, we will enjoy the benefit of that. We will enjoy the benefit of that. Okay, if you write a call option and if the price falls to 930 rupees, the call will lapse, but then you will be able to get only 930. Okay. in the market. Price can go down to 900 rupees also. These are the strike price. Actual price can be anything. So writing a call option will not be a good strategy. Buying a put option at 950 exercise price will be a correct strategy. So student will write in the exam first like this. This is a test of your understanding of option chapter. Ram should cover his risk by buying a put option. The first thing, you should buy a put option. When you are holding the stock, you want to cover yourself by using option, buy put option. Ram's risk appetite is 5%. Second line, Ram's risk appetite is 5%. So the strike price shall be 950. How did you get 950? 1000 minus 5%. Now I am going to prove that with this strategy I am definitely going to receive 950 by selling the share. So next line, write down calculation of overall position. Calculation of overall position. So there are two possibilities on expiry date or after 1 month. There are two possibilities after 1 month. Either the share price can be less than 950. Either the share price can be less than 950 or the share price can be greater than or equal to 950. Or the share price can be greater than or equal to 950. Let us see what happens in these two scenarios. Either it is less than 950 or greater than or equal to 950. So the value of the stock will be equal to whatever is the market price, that is S. If share price is 500, you will get 500. Share price is 850, you will get 850. Share price is 1000, you will get 1000. But what about the put payoff? The value of the put is, you have studied in the class, higher of E minus S or 0. E minus S. What is exercise price? 950. Put will be exercised because market price is less than 950. Here the put will be exercised and you will receive 950 minus S. But if share price is equal to or more than 950, put will lapse. And since put will lapse, you will get 0. So what is my premium to be paid? Premium to be paid is 8 rupees at the beginning. So that is not dependent on what will be price on expiry. Now write down net payoff. Add these three numbers. This S minus S will be cancelled. This is 942. This is S minus 8. So you will get a minimum 942. You can get more also if the share price is more. So write down the value of Ram's holding shall never be less than. The value of the Ram's holding shall never be less than rupees 942. Value of Ram's holding shall never be less than 942. Shall never be less than 942. Put will compensate for the loss. Put will compensate for the loss below spot price of rupees 950. Put will compensate for the loss. So if your price goes below 950, put will compensate for that loss. So this column can never go down below 942. But then why there is a difference of 8 rupees? The difference of 8 rupees, the premium that you have paid. So that is the cost of hedging. However, this strategy will cost rupees 8. However, this strategy will cost rupees 8. Okay. So this strategy will ensure that you will get 950 rupees minus 8 rupees because that is the cost of hedging. You can get more also. You can get more also. For example, here if the share price happens to be 1500, you will get 1492. You will get 14. So minimum 942 you will get, but you can also get more than that with this strategy. So this is the benefit of learning option. You can hedge your risk that you are holding certain shares. Okay. So this was the answer of question number 6B. We thank you very much for watching this lecture. Please subscribe to our YouTube channel ES Foundation, and you also like the video, but most importantly you share the video with your other friends and ask them to watch. I have uploaded SFM MTP March 23, SFM April MTP which is right now going on, and SFM RTP also for May 23. Plus I have also uploaded revision lectures, about 30-40 hour SFM revision part 1, part 2, SFM theory revision part 1, part 2 is there on our channel. So that is a very good content and you can enjoy it. I repeat that please do not follow that ABC technique for SFM. Any question from any corner of the chapter can be asked. Like this MTP you have seen, it covers a wide range of questions. Shortcut will not help you. No amount of shortcut, no amount of shortcut tricks will help you to get through this SFM. Practice, practice and more practice is required for getting through the SFM exam, and you have to solve a variety of questions. So thank you very much. See you again soon. Bye. Hello friends, good evening. Welcome to SFM May 2023 RTP. This was a very good RTP. There are few good questions also. So you must practice May 23 SFM RTP before you go to the exam. So today what we'll do, we'll take step by step each question. There are some repeated questions also. There are some new questions also. So I will request you that you download the May 2023 RTP from our website vinod.in. We have uploaded this RTP with solution on our website www.vinod.in. You will go to the free resource section and you download. It will become easier and faster for you to understand. The RTP is also available on the institute's website. So to understand the chapter fully, the RTP fully, I want that you must keep the printout of RTP May 2023 SM before you. If you can do that, then you will be able to get the full benefit of this lecture. There are total 13 numerical questions which we are going to solve. And how we are going to solve, first we will discuss the question and then solve step by step. The objective is a good revision of SFM plus how to present the answer in the exam. Presentation of the answer in the exam is very important to get very good marks. If some teacher tells you that no, presentation is not important, that is not true, because some students get 5 out of 5 for the same answer and some students get 1 or 2 marks for the same answer, and the reason is that some student may not be able to present the answer properly. So trust me, a good presentation adds extra marks to your exam. Okay. So here we go. I have in front of me RTP May 2023 SFM question number 1. So please come to question number 1. This question is from money market instrument. Money market instrument on commercial paper, a very easy question. And this question is a repeat question. It was asked earlier also. Very easy question. From the following information, compute the effective rate of interest per annum. What we have to compute? Underline, double underline. Effective rate of interest per annum. This is one calculation. Effective rate of interest per annum, as well as the total cost of funds to Nirmal Limited, which is planning a commercial paper issue. So what is the information given? Issue price is 487,750. All of you know that commercial papers are issued at a discount to the face value, and the face value is 5 lakh. Maturity is 3 months. So basically, in simple words, the difference is the interest for 3 months. Difference is the interest for 3 months on 487,750. So first we'll find out how much is the interest for 3 months, and then you have to convert into effective interest rate per annum. In addition to the interest cost, when the company issues commercial paper, there are other expenses that also will have to add. Brokerage is 0.15% for 3 months. Since it is given for 3 months, I will multiply by 4 so that I will get the equivalent brokerage per annum. Rating charges is already given per annum. Stamp duty is 20% for 3 months. It is 0.20%. Please rectify, it is 0.20% for 3 months. So if it is 0.20% for 3 months, to get the answer for a year, we'll multiply by 4. So first what I'll do, step number 1 will be to find out the effective rate of interest, then add these 3 costs also. That will give you total cost per annum, and for that you'll get around 5 marks. This is an RTP question. So marks are not mentioned here, but usually they ask you such question for 5 marks. Write down important question for next exam, question number 1. And those who are writing the answer will write down step 1, nominal interest. Step 1 is nominal interest, also called bond equivalent yield. Nominal interest or bond equivalent yield. So first we'll find out the interest for this period. Multiply by 12 by n will give you annual figure. So face value minus issue price, divide by issue price, into 12 by n into 100, into 12 by n into 100. So data is given in the problem. 5 lakh minus 487,750 divide by 487,750. So this will give you interest for 3 months into 12 by 3. Make it 12 by 3 into 12 by 3 will give you interest for a year. So that comes to approximately 10.05% per annum, compounded quarterly. Write down compounded quarterly. Your institute answer does not write this. Compounded quarterly. If it is compounded quarterly, how do you compute the effective rate per annum compounded annually? In the earlier exam answer, they used to stop the interest calculation at this point, but nowadays they convert this into effective interest rate per annum compounded annually. So I will have to go one step further. So write down effective interest rate per annum. Effective interest rate per annum. Write down important. Now I have to tell you that earlier they were not doing this calculation, but now they are doing it. So you will also do in the exam. Effective interest rate per annum will be 1 plus this your nominal interest rate per quarter compounded quarterly. So divide by 4 to the power 4. Divide by 4 will give you value of 1 rupee after 3 months, and then you have to take the power 4, which gives you effective interest rate per annum compounded annually minus 1. So here the answer comes to 10.435%. 10.435%. Now write down step number 3, total cost of funds to the company. Now this is very easy. Total cost of funds to the company. First we have already computed effective interest 10.435%. Then look at your question. Brokerage is given 0.15% for 3 months. For brokerage I will simply multiply by 4. For 3 months 0.15%. So for 12 months 0.60%. Rating charges already given annual 0.55. Rating charges given per annum, and stamp duty is given 0.20% per annum per 3 months multiplied by 4. So that is 0.80. Now dear student, kindly tell me the total. Please give me the total now. All of you, please tell me the total of this. Yes, total is 12.385%. Total is 12.385%. So this is the answer of this important question for your upcoming exam. Now we'll come to question number 2. Already repeated in the exam. So you will find this question have also been asked in the exam. Question number 2. Following data are available for a bond. So this is a question on bond valuation. Face value rupees 10,000. To be redeemed at par on maturity. Coupon rate 8.5% per annum. Years to maturity 5 years. Yield to maturity 10%. You are required to calculate current price, duration, volatility. So volatility is modified duration. Then convexity of the bond. And question number 5. Expected market price if there was an underlying decrease in the YTM by 200 basis point. 200 basis point means 2%. So if YTM decreases by 2%, what will be the revised market price of the bond using Macaulay's duration based estimate and using intrinsic value method? Add one more question for my side, which is important for understanding convexity. Using convexity. Point number C, write down using convexity. I am adding this from my side because in the exam they can ask you convexity also. Discounting factor is given at 10%, which I will require for the first few answers, and then discounting factor is 8%, which I will require to calculate the bond value using intrinsic value method. So we'll do little fast. First we will draw a format in which we are going to calculate bond price, duration, and also we will try to calculate convexity in this format. Okay. So student who have not done convexity, please follow me. Write down this format. First column write year. First column write year. Second column in bracket write X. Second column write cash flow. Third column write PV of cash flow. Third column write PV of cash flow. Fourth column write X into W. PV of cash flow in bracket write W. Fourth column X into W. This will help you to calculate duration. This will help you to calculate duration. And the last column will help you to calculate convexity. The last column will help you to calculate convexity. So write down year column, cash flow column, PV of cash flow, X into W, and the last column is X into W into 1 plus X. X into W into 1 plus X. I will tell you how to do it. First write down year column. How many years are there? 5 years. So write down 5. 1, 2, 3, 4, 5. Then write down cash flow 8.5% of 10,000. How did you get 850? 8.5% into 10,000. Please note down somewhere working of 850. 4 times in the last year you will get 10,000 plus 850, that is 10,850. Now in the question discounting factor at 10% is given. So what I will ask you to do, take this number, multiply by that factor in the question 0.909, 850 into 0.909, 772.65, memory plus, so that the total can be got fast. We can get the total fast. Again 850 into 0.826, 850 into 0.751, factors are given in the book, multiply, use memory plus function. Last one 10,850 into 0.621. Now take me the total 9431.50. Right below, this is your first answer, current price of the bond. Current price of the bond. Now next task is to find out the duration. For that we'll multiply year into PV of cash flow. For column number 1, column number 3, you will multiply and use memory plus function. So follow me. 1 into 772.65, same, memory plus. 2 into 702.10, 3 into 638.35, 4 into 580.55, 5 into 6737.85. After multiplying, take the total. Any student who can give me the total of the last column, of the fourth column. So what is the total? What is the total? The total is 40103.35. 40103.35. Check the answer. Is it right approximately? Now next column is important. How to get the last column? That is for convexity. X into W. We will take this fourth column into 1 plus X. X means 1. 1 plus 1 means 2. So student will take 772.65 into 2. If it is written 1, I will take 2 into 2. That is how the formula will work. So this will come to 1545.30. Now take this number multiplied by 3. 2 plus 1 multiplied by 3. So you will get 4212.60. Very good. Take this number 1915.05 into 4. Into 4. 7660.20. Now take this number into 5 into 5, 11611.0. Last one, take this number into 6, 2,02,135.50. Give me the total of this last column, please. Yes, everybody, please give me the total of last column. The last column total comes to 227,164.60. So this I will require for convexity. This and this two number I will require for duration calculation. Okay. So now next task will be to find out the duration of the bond. Write down duration of the bond is equal to summation PV into year divided by summation PV. Summation PV into year divided by summation PV. So you will write 40103.35 divided by 9431.50. So this is duration 4.252 years. 4.252 years. See the presentation, how you have to write the answer in detail. Now next is volatility of the bond. Volatility of the bond, write down modified duration. The formula is duration upon 1 plus YTM. Duration is 4.252 divided by 1.10. Your YTM is 10% right now. 1 plus 0.10. So duration, modified duration or volatility of the bond is 3.865. What is the interpretation of this? If YTM changes by 1%, the price of the bond will change by approximately 3.865%. Approximately. So this is the meaning of volatility of the bond, that for 1% change in the YTM, how the bond price will fluctuate. Now the next is convexity. So write down convexity. Convexity in bracket write C. Convexity in bracket write C. The formula is equal to summation W into X upon 1 plus X divided by current bond value. Divided by current bond value. Divided by current bond value. So we have computed this number in the previous table, 5th column, and this is the bond price in the 3rd column. So write down the answer 24.0865. This I will use to find out the change in the price of the bond. Now I have to tell you, your institute has used a different formula, but this is also right, and I am going to prove it when we will compute the change in bond price, that this also gives me the accurate answer. Okay. So in case if you want to use institute formula, you are welcome. If you want to follow my method or this formula, you are welcome. Ultimately, we will be able to reach the same conclusion about the change in the price of the bond. Okay. So I am going to use this convexity 24.0865. Now we'll have to find out revised bond price. Write down revised bond price. Revised bond price when YTM decreases by 2%. That is your question. When YTM decreases by 2%, meaning the YTM is now 8%. YTM is now 8%. YTM is now 8%. So student will write the formula. It's a little lengthy formula, but it will serve the purpose. A good student will write using convexity. You have to solve it 3 times. Convexity, Macaulay's duration and intrinsic value. This I have added purposefully in the question to prove that this formula that we have used is correct. It will give us the right answer. Start. The formula for percentage change in bond price is equal to if the bond price, if the YTM goes down, the bond price will go up. If the YTM goes down, the bond price will go up. Hence the sign is +1. The sign will be -1 if the YTM goes up. The student knows there is an inverse relationship between the YTM and bond price. If YTM goes down, bond price goes up. If YTM goes up, the bond price will fall. Okay, right. +1 into modified duration, +1 into modified duration into yield change in percentage point, into yield change in percentage point, plus C by 200, C stands for convexity, by 200 into yield change in percentage point square, into yield change in percentage point square. Now write down the figures. +1 into modified duration 3.865 into 2, that is change in yield, plus convexity divided by 200 into 2 square. Let us see who will answer first. Let us see who will answer first. Come on, try. Who wants to try? So the answer comes to, for this portion 7.73, for this portion 0.48173. So the final total is 8.21173%. Now it means that if the YTM decreases by 2%, now the meaning of this is, if YTM decreases by 2%, bond price will increase by 8.21173%. So the new bond price will be the price that you have computed already in the step 1 and plus this 8.211%. So write down below revised bond price. Convexity concept gives you more accurate answer, because as you know, the relationship between the bond price and YTM is not a straight line, not a linear equation, but a convex. So that is why we have to give the importance to the convexity of the relationship, and hence this formula. Modified duration, which I am going to discuss after this, that assumes a straight line relationship, which is not true. Hence convexity is a better way of estimating the revised bond price. It takes into account the fact that the relationship between bond price and YTM is not a linear but a curvilinear relationship. Okay, so revised bond price will be original bond price plus 8.21173%. Check the answer, 10,205.99. You will find that this answer is more closer to intrinsic value. Step number 2, or second method, modified duration method. Now here the revised bond price will be your original price plus 2 into 3.865%. So that comes to 10,160.55. So using modified duration, I expect that the bond price will rise to 10,160. Now intrinsic value method or present value method, which gives me accurate answer. You will find this answer is closer to convexity answer. Let us check. So here the revised bond value will be, what will I simply do? I will take coupon 850 into annuity factor at 8% and 5 year. I will take redemption value into PV factor at 8% and 5 year. Solve. Find out the value. Factors are given in the question. Last line of the question. Take the factors from there. I have taken the factor from there, and then approximately my answer is 10,203.80. 10,203.80. And if you remember, the answer as per convexity was 10,205. These two answers are close. But if you look at the answer by a college duration method, that answer is having more difference compared to the answer we have arrived by convexity method. So I hope you are convinced now that the formula that we have used, the process that we have used is correct. So don't worry, you can follow this and you can solve in this manner in the exam, and here is the proof that the formula is right. Question number 3. Very easy question from portfolio management chapter. Very easy. Question number 3. Ramesh, Suresh has identified stock of two companies A and B having good investment potential. Following data is available. It's just a mechanical calculation. Year is given, market price in rupees in all these years, and security B market price is given. Now in this question, probabilities are not given, rather number of years are given. So be careful with the formula. It is not a probability based question. Be careful with the formula. Calculate risk and return by investing in stock A and stock B. So basically you have to find standard deviation of A and B, and return means you have to find out the average return of A and B. For that purpose, first you will have to calculate individual years return. First you have to find out individual years return. Individual years return will be P1 minus P0 upon P0. To get the return of 2014, you have to take 18.75 minus 19.60 divide by 19.60. To get the return of 2015, you will take 33.42 minus 18.75 divide by 18.75. This way first you will have to find out the return. So please note down this formula in your notebook. Return of each year will be P1 minus P0 upon P0. There is no dividend in the problem. Otherwise I could have added dividend also. Now next question, risk and return of investing in a portfolio. If the investment is in the ratio of 6:4, so portfolio return, portfolio risk, and what is the better opportunity for investment? So whether you will invest in A or B or the portfolio. So we'll solve by first computing risk and return of the two stocks. Students will write step 1, calculation of expected return and risk. Calculation of expected return and risk, and return will be equal to P1 minus P0 upon P0. So start with the format first. Half the battle is won if you draw the format right, because that will help you to do faster, correctly also. First column year, then write stock A. Under stock A, 3 columns: price, return in percentage, RA minus RA bar square, RA minus RA bar square. That is for standard deviation. Any doubt, ask me, and if you have any suggestion, please reply. Stock B, same format: price, return in bracket R, RB minus RB bar square, RB minus RB bar square. So first we'll copy year from the question. First copy year from the question, then copy price also from the question. Year 2013 we cannot calculate because opening price is not available. So we'll start with 2014. Okay, here I will not calculate because opening price is not available. If you want to write, you can write. Okay. Now how do I get this number? Student will have to participate 18.75 minus 19.60 divided by 19.60 into 100, 4.34% negative. Second time 33.42 minus 18.75 divided by 18.75 into 100. So that is a huge 78.24%. In this way, do the calculation for remaining years. 27.59%. Yes, come on, next. 1.43. Very good. Next, 3.12%. Negative 22.09%. Take total of this. Take total of this. This will give you total 83.95%. Because we have to just compute simple average, how many numbers we have taken? 5 numbers. Now divide by 6 numbers, divide by 6. 83.95 divided by 6. So the answer is 13.99%. You can write 14% if you want. Now next is to compute standard deviation, RA minus RA bar square. Type minus 4.34 on your calculator, minus 13.99 and take the square. How do you take the square? Multiply equal to sign. Anybody got the answer? 335.99. Next one, 78.24 minus 13.99 into equal to 4128.06. 27.59 minus 13.99 into equal to 184.96. Now do this calculation yourself and tell me the total. The total comes to 6226.69. I'll come to the standard deviation. Don't take square root directly. That will not give you standard deviation because here number of years are given. It is not based on probability. Okay. Next, go to stock B. Copy the price from question book. Copy the price from question book or RTP SFM May 23. You can download it from our website www.vino.in. Okay, so you can download from there. Immediately go to website, go to resource section, free resource section and download this. You will find question and answer, both are there. That will save time for you. That will help you to understand also. Okay. Now I will tell you one number, how do you get it? First you take 12.80 minus 8.70 divide by 8.70 into 100. So you will get 47.13. Next 16.20 minus 12.80 divide by 12.80, 26.56. Now do this process and you will get these numbers. Check it. Take the total 97.14% divide by 6, 16.19%. 16.19%. Just check this is right. 16.19%. Now what you do? 47.13 minus 16.19 into equal to 957.28. 26.56 minus 16.19 into equal to 107.54. Now repeat this process and tell me the total. The total comes to 3582.17. This way you will write in the exam. Do not take square root of this. That is not the standard deviation. The formula for standard deviation is when number of years are given, when number of observations are given, the standard deviation of A, that is risk of A, is equal to under root summation RA minus RA bar square divided by N, divided by N. So N means 6 observations. So the answer comes to 32.21%. Check. Now students make two mistakes here. First of all, it does not divide by 6. Sometimes it does not write all this formula and directly does calculation on calculator and writes. In both cases you will lose marks. Now repeat this for B. Standard deviation of B. Standard deviation of B. Divide. Again you don't need to write formula, only once is enough. So now the answer this time is 24.43%. So we have got the first answer, risk and return of individual stock. But to get the risk and return of the portfolio, I need to first find out to get the risk of the portfolio, I need to find out the covariance between the two stocks. Portfolio risk is affected by the covariance. Portfolio risk is affected by the covariance or the correlation between the stocks which are included in that portfolio. So this problem will help us to practice covariance also. Write down 4 columns. First column year, second column RA minus RA bar, third column RB minus RB bar, and the last column is RA minus RA bar into RB minus RB bar. Okay. First you write down year. Don't write 2013 because 2013 does not have return, as we have not calculated the return of 2013. Student will keep the previous answer in front of you. What was RA of 2014? RA of 2014 was minus 4.34 and RA bar was 13.99. So for 2014, minus 4.34 minus 13.99, the answer will be approximately 18%. The answer will be approximately 18.33. You are right, 18.33. Come on, next one. Next one, how do you compute 78.24 minus 13.99? So that is 64.25. Next one, 27.59 minus 13.99, 13.60. 1.43 minus 13.99 minus 12.56. Minus 12, approximately check, minus 10.87, and the last one is minus 36.08. RB minus RB bar. Now the student will go to first answer. In 2014, RB is 47.13 and RB bar is 16.19. So please do the calculation. Approximately you will get 30.94. Then in the next year it is 26.56 minus 16.19. Check the answer. 10.37. 10.37 approximately. This way you do the calculation for other 4 years. Minus 3.54 minus 30.71 minus 31.25 and 24.19. Very easy question, mechanical question. Only they are testing your knowledge of the formula and can you apply the formula. In the exam time, when you are under stress, you may not know which formula to apply. So practice, practice and practice is very essential for SFM paper. You may be knowing the answer, but sometimes you are not able to complete or do it correctly. Next column, multiply these two. Use memory plus function so that you can do fast. Minus 567.13 minus 666.27 minus 48.144. Then next is 385.7176, 339.6875 minus 872.7752. Check the total. Take care of positive and negative signs, and the net effect is minus 96.3718. Minus 96.3718. Check the total. Check the total. Then write down the formula of covariance between A and B. Covariance between A and B. Summation RA minus RA bar into RB minus RB bar divided by N. This is your total of the previous answer divided by 6 observation. Covariance is written as minus 16.06 percentage square. This is the symbol for covariance. After that, we'll write down step 3, expected return of the portfolio. Expected return of the portfolio is weighted average return. As per the question, 60% weightage is to A and 40% weightage is to B. These are the weights and these are the returns from your first answer. 13.99, 16.19. Hence, you get 14.87. 14.87 is the portfolio return. Can you tell me the formula of standard deviation of portfolio? Come on, I'll wait for you. Formula for standard deviation of the portfolio. Formula for standard deviation of the portfolio. So the formula is under root WA square into sigma A square, weight of A square into standard deviation of A square, plus WB square into sigma B square, plus WA into WB into covariance between A and B. Into covariance between A and B. I hope you remember the formula. If you remember the formula, you will get full marks in this question. Now put the values 0.6 square into 32.21 plus 0.4 square into 24.43 square plus 2 into 0.6. The formula has 2 also here. 2 into 0.6 into 0.4 into covariance is minus 16.06. Students are requested to solve now. Students are requested to solve and give me the answer. The answer is 21.48%. 21.48%. The answer is 21.48%. Just check the answer. Question was, advise which is the better option. Now the answer depends on whether you are looking at risk or whether you are looking at return. If you are looking at a higher return, stock B will be preferred. But if you are looking at a risk, the option which has lower risk will be preferred. So in that case, the answer is portfolio because the risk is lower. So write down this note. From return point of view, stock B is preferred. From risk point of view, portfolio is preferred because portfolio risk is lower. Question number 4 now. Question number 4 is again from portfolio. Back to back question on portfolio. Oh, and this is a repeat question. They have asked in earlier exams also. So I will just do it little fast because we have done in class also the same question. Following information is available in respect of expected dividend. This time dividend is also there. Market price, and this time you have to apply the concept of probability. Okay. The previous question was without probability, number of years. This time it is with probability. So my formula for standard deviation will be slightly different. Good, normal, bad. These are the probability. These are the market prices depending upon market condition. And these are the dividend company is expected to pay depending on market condition. The existing market price of an equity share is 106, face value 1, which is come 10% bonus debenture of rupees 6 each. So right now the price of the share is 106 plus you are getting a debenture with that price whose face value is 6 rupees. Mr. X Finance Company Limited had offered the buyback of debenture at face value, which means 106 rupees. Understand, 106 rupees is comprising of two financial instruments, a debenture and a share. Debenture can be bought back by the company today at 6 rupees. So if you buy a share at 106 and if you give the debenture back to the company, you will immediately get 6 rupees. So what is the cost of buying share only? The pure cost of buying the share only is 100 rupees. So P0, that is price of the share today, for calculating the risk, return, etc. will be 100 rupees, not 106 rupees. If you write 106 and do the calculation, your entire answer will go wrong because 106 is not the price of the share. It is the price of the share plus a debenture whose value is 6 rupees today. Find out the expected return and variability of return. Variability of return is standard deviation of the equity share if the buyback offer is accepted by the investor. And then they have added one more question, also advise whether to accept buyback offer. Should you go for buyback offer or not? So that we'll discuss later. Should we go for buyback or not? But first answer first, which is very easy. Calculation of expected risk and return. Students are requested to participate and reply. Calculation of expected risk and return. Right now we are discussing RTP May 23 SFM CA Final. You can download this RTP with question and answer from our website vinod.in resource section. Okay, the answers are also I have written and presented there. I have changed the format of the institute answer slightly for better understanding. So write market condition, probability, return. Return formula, write down D plus P1 minus P0 upon P0. Then multiply probability into return, you will get expected return. And this last column is for calculating the standard deviation, R minus R bar square into probability. R minus R bar square into probability. First two columns copy from the question. First two columns copy from the question. Now we'll compute return. How do you compute return? Your price at the end is 115. Price at the beginning I will take 100 plus dividend is 9 and divide by 100. So this is the working note for this 24%. Similarly, for the second situation, 107 minus 100 plus dividend divide by 100. So I will get 12%. And for the third situation, it is 97 minus 100 plus 3 divided by 100. So I'll get 0. This is the working note for that. In case if the student wants to show the working note, he can show it. Now what I'll do, I'll multiply these two columns, add it. That will give me expected return. So 6%, 6%, 0. So my answer is 12. This is R bar, return of the stock, 12%. Now R minus R bar square into probability, 24 minus 12, 24 minus 12 square into 0.25. So that is 36. Next one, 12 minus 12 square into 0.50, 0. Last one, 0 minus 12 square into 0.25. Take the total here. The total is 72. So the standard deviation will be square root of 72 when you are using probability. When you are using probability, sir, you have divided by number of observation in previous. When we are taking number of years, then divide by n. But when we are taking probability, we don't have to divide by number of observation because the sum of the probability itself is 1. So the answer comes to 8.49%. Now write down one note, why we have taken 100 in the calculation of return. If you want to write, please write. Present market price of the share. Present market price of the share is rupees 106. Is rupees 106 come bonus debenture of rupees 6 each. Is rupees 106 come bonus debenture of rupees 6 each. Hence net cost is rupees. Hence net cost is rupees 106 minus 6. 106 minus 6 is equal to rupees 100. Is equal to rupees 100. Now the next question is whether the investor should go for buyback offer. Whether the investor should go for buyback offer. So the answer depends on first what is the opportunity cost and what is your maturity period. The debenture is giving you 10% return. That means if you can invest your money at a higher than 10% return, you can go for buyback. Like in this example, the stock is giving 12% return, whereas the debenture will give you only 10% return. So therefore, one can think of going for buyback, surrender debenture, get cash and you can invest in the share where you can earn a higher return. So the decision regarding buyback will depend on, write down, maturity period and opportunity in the market. So as I told you, if the opportunity cost is high, more than 10%, you can opt for buyback. Again, if the maturity period is low, one can wait. If the maturity period is 6 months, 9 months, 1 year for debenture, then maybe you can wait and you can get 10% return. So if the opportunity rate is very high, go for buyback. If maturity period is very high, go for buyback. But if maturity period is low, you can wait. So that was the answer of this question. Now we'll take a very important question on mutual fund, which requires reverse working. Very important question. If you have not done it before going to the exam, then trust me, you will be taken for a surprise in the exam. Then you will probably find it difficult to solve because it requires reverse working. Normally in the class what they teach straight calculation, but when they ask you to do reverse calculation, many students are not able to solve. So I will sincerely request you that you must solve this question before you go to the exam. One more star. Okay. So we are starting one test series for students appearing in May 2023. Okay, and we are going to conduct test series on FR and SFM. There are 4 test series in each subject. I have designed the paper and I will check the paper. The special thing about our test series will be most of the question would be new type. You can see in the RTP, MTP most questions are repeated, but in the exam you get new type of question. So I have found new type of question. More than 90% question will be new for you, which were not asked in the earlier exams. So therefore, you need to learn the surprise element in the exam, and for that you should join the test series. You can take the admission for test series on our website vino.in. On the home page there is a test series section. You can appear for only 1 or 2 or 3 or all the 4 test series. Is it right? And I will check the paper and return the paper as early as possible, at the max by 6 to 7 days, but that is very high. Maybe I can check it in 2 days also, 3 days also. And another important thing is that I will give you good feedback for improvement. It is better that paper is set and corrected by the faculty who is teaching that subject. That will give you an extra edge over other students. So if you diligently appear for the test series, you can move from 40 to 70 marks also. We have covered all the topics, no repetition of any question, so that you will get all the new questions. Okay, so let us come to this question. Messrs. Corpus and AMC on 1/4/15, underline 1/4/15, this date is required for calculating number of years, has floated 2 schemes, dividend plan and bonus plan. Then Mr. X, an investor, has invested in both the schemes. Following detail except the issue prices are available. In all question you have solved in classroom, probably they have given you issue price here, and you had to compute the yield. This time reverse. Issue price on the first day is missing. Return is given to you. So do reverse working and find out what is the issue price. Then on 31st December you have bonus ratio 1:4 for bonus plan. On 31/3 you have dividend at 12%. On 31st March 10%. Like this they have given. Additional detail. Investment made on 1st April was 9,20,000 and 10 lakh. The average profit over these years means 5 years. When you see 5 years, investment was made on 1/4/15 and the last date given is 31st March 2020. So 5 years. Over a period of 5 years, this is your total profit, average profit. If you multiply by 5, will give you total profit in this period. And then average yield here is given 6.4. If you multiply by 5, this will give you total yield over this period. This is for dividend plan and this is for bonus plan. Okay, they have not written the heading properly. You are required to calculate the issue price on 1st April. Now this question has a small mistake. This dividend plan is actually dividend reinvestment plan. Is actually dividend reinvestment plan. When we looked at the ICI suggested answer, we found that it is a dividend reinvestment plan. Okay, which means that first the dividend will be calculated and units will be issued to you, which will be added to your opening units. So the number of units will keep on increasing. After every dividend payment, the number of units will keep on increasing. So what I will have to do, using this information, I have to first find out how many units were there at the end after 5 years and then do reverse working and find out how many units were there at the beginning. 9,20,000 was your investment. Divide by number of units at the beginning will give you the opening issue price or NAV. So reverse working problem are difficult in the exam. First you write down, one by one we'll solve. Point A, write down. First we'll solve dividend plan. Actually it is a dividend reinvestment plan where the dividend is reinvested and additional units are issued. Dividend reinvestment plan. Under that write down step 1. Step 1. First we'll calculate number of units on 31st March 2020. Number of units on 31st March 2020. Please inform your friends also. They will also enjoy this lecture. Immediately inform your friends also. Now write number of units. So how do we do? First I will find out the total value of investment after 5 years. Opening investment value is given. Average profit is given. So multiply by 5 will give me total profit. Investment plus total profit will give me total investment value at the end, and divide by the NAV on 31st March, which is 49 rupees, will give me closing unit. So easy, right? So first write down average annual profit. Question in front of you. This is, as I am telling you for one more time, a very important question. 27748.60. Point B, write down number of years. Point B, number of years. Number of years 5. Total gain. Total gain over a period of 5 years. Total gain will be 138743. Just multiply by 5. So over a period of 5 years, this is the gain. Add the initial investment amount. Add the initial investment amount, that is 9,20,000, and that will give me the total value of investment. that will give me the total value of investment, which is C plus D. Just take the total 10,58,743. Now NAV on 31st March 2020, look at the dividend plan column. The NAV is 49 in the last line. So that means can I calculate the number of units on 31st March 2020? The answer is yes. The number of units on 31st March 2020 will be E divided by F, 21607, right? Now I will use this number 21607 and find out what was the units on 1/4/2015. So reverse working we have to do. This is after adding the units reinvested. So I am going to tell you something which, if you are interested, can write down, will help you a lot in the exam. This question was for about 10 marks and very few students were able to get it right. Step 2, in a dividend reinvestment plan, when you are doing reverse working, step 2, how to calculate units. How to calculate units before dividend declaration. How to calculate units before dividend declaration. We have to solve an equation. So let units held before dividend declaration be X. Let units held before dividend declaration be X. Therefore, unit held before dividend declaration plus unit reinvested is equal to closing unit. Unit held before dividend declaration, assume X, and the units reinvested will be number of units into dividend per unit divided by NAV. Number of unit X into dividend, total dividend divided by NAV, that is your additional number of units, and that will give you units after dividend declaration. Closing unit means dividend after dividend declaration. So what I'll do, I will just make a small equation. So this is NAV into X plus X into dividend divided by NAV is equal to closing unit. So basically my intention is to find out the value of X. Now simplify. When you simplify, X is common. So it is X into NAV plus dividend is equal to closing unit into NAV. So now the student can guess X will be equal to closing unit into NAV divided by NAV plus dividend, because I have not done anything. Just to make your life easy, I have found an equation to calculate the number of units before dividend declaration. X is equal to closing unit into NAV divided by NAV plus dividend. Now if I write this directly, you will not understand. So what I did, just to convince you, I have derived the value of X, and now for calculation purpose we can just make a table and find out the number of units before dividend declaration on 3 different dates. So are you ready? Yes sir, we are ready. Go ahead. So write down number of units on 1/4/2015. Draw one table. First column write down date. Second column write, this time we have to do reverse working. In the class we are doing straight calculation, but this time reverse gear is always little difficult. Units held after dividend. Third column rate of dividend. third column rate of dividend, fourth column dividend per unit, fourth column dividend per unit, fifth column NAV, fifth column NAV, and the last column unit held before dividend. Units held before dividend will be B into E divided by B into E divided by E plus D divided by E plus D. B into E, unit held after dividend, into NAV divided by NAV plus dividend, divided by NAV plus dividend. In the denominator you have D plus E. Okay, so student will do reverse working. First you go to 31st March 19. Question in front of you. This is RTP May 23 SFM, question number 5. So 31st March 19, this unit we have already calculated in the previous table. Dividend rate is 15%. We have to do reverse working. Take the last date. Dividend is 1.50. So NAV is 45. So student will help me and calculate the last column. Anybody for the last column? Anybody for the last column? Just a second. $20910. Now next is 31st March 18. Rate is 10%. 1 rupee dividend. NAV is given 50 rupees. NAV is given 50 rupees. So apply the formula. Apply the formula. B into E divided by E plus D. So you'll get 20,500. Next is 31st March 17. Do the same calculation and your answer will be 20,000. So 20,000 units were held on 1st April 2015 and you have invested an amount of 9,20,000. So 9,20,000 was invested for acquiring 20,000 units. So my first answer is over. For dividend reinvestment plan, write down calculation of issue price on 1/4/15. Calculation of issue price on 1/4/15. Initial investment 9,20,000 is given. Very good. Then unit purchased we have got just now. How much? 20,000. So who will reply first? Come on, everybody. What is the issue price? What is the issue price? Yes, please reply on your chat box. You can write the answer. 9,20,000 divided by 20,000. Come on, reply. The answer is 46. Very good. The answer is 46. Now we'll come to bonus plan. Part B, which is much easier than dividend reinvestment plan. So here we'll have to compute total number of units held on 31st March 2020. You are given initial investment in the problem. You are given average annual yield 6.4%. Multiplied by 5 if you do, you will get around how much? 32%. So you will get the closing investment value. Divide by closing NAV will give you closing unit on 31st March 2020 and then we'll do reverse working. Okay, very easy. This part is easy. Investment 10 lakh, average yield 6.4%, average yield 6.4%, number of years 5. So investment multiplied by average yield into 5 will give me total gain over a period of 5 years. Total gain over a period of 5 years is how much? Multiply the three numbers. 3,20,000. So you have invested 10 lakh, you have gained 3,20,000. So the value of investment on 31st March 2020 will be, come on student, you will add this 10 lakh plus this 3,20,000, 13,20,000. And what is the closing NAV given in the question book? Closing NAV is given for bonus plan, last line, last column, 44. Therefore, I can compute now number of units. Yes, please reply. Number of units. Number of units. 13,20,000 divided by 44 will give you 30,000 units. These 30,000 units were held on 31st March 2020 after considering the bonus given two times, 1:4 ratio and 1:5 ratio. So now I will do reverse working and find out the units held on 1/4/2015. Write down step 3, units held on 1/4/15. Draw the table, write nicely. Good presentation gives you extra marks. Date, unit held after bonus. Unit held after bonus. Bonus ratio. Bonus ratio. And the last column, unit held before bonus. Unit held before bonus. So if suppose before bonus it is X and the ratio is 1/4 of X, so that is equal to 5x by 4. That is equal to 5x by 4. So if it is X before bonus issue, it is 5x by 4 after bonus issue. So if I multiply this by 4 by 5, I'll get the value of X. So I will have to multiply by 4 by 5. If it is 1:5, I have to multiply by 5 by 6. I have to multiply by 5 by 6 to get the unit before bonus issue. To get the unit before bonus issue. So 30,000 into 5 by 6. 25,000. Now 25,000, 1:4. I will multiply by 4 by 5. 20,000. So the answer is, at the beginning on 1/4/15, 20,000 units were acquired. Now the last answer, what was the issue price? We have invested 10 lakh. We have invested 10 lakh. We got, how many units we got? We got 20,000 units. Okay. So now school level student will answer. What was the issue price? The issue price is A divided by B, 50 rupees. A divided by B, 50 rupees. That was the issue price. So we got the answer. That was quite a lengthy answer. Now we'll come to question number 6. Students are requested to follow me, write in the notebook, download the RTP May 23 from the website vino.in. Okay, we are also going to start test series. You can take admission for test series on our website vino.in. Paper will be checked by me. It is prepared by me also and will be returned to you within 6 to 7 days maximum. Question number 6, write down again. Very important for your upcoming exam. This is also from past exam. Most of these MTP were from past exams, but very good collection. You must practice it. It is like a quick revision of all the topics. Underline a 2 year. This is 1 year. This is second year. 2-year tree for a share of stock in ABC is as follows. This is a multi-period binomial model. Today the price is 100 rupees. 1 year later it can go to 108 or it can go down to 95. After 2 years it can go to 116.64 or fall to 102.60. If it is 95, it can go to 102.60 or it can fall to 90.25. Consider a 2-year, underline American call option. American option can be exercised anytime. American option anytime. European option expiry date. So you can either exercise here or here or here or here or here or even here also. So at each node, these are called node, we are going to check what is better. To exercise now is better, to exercise later is better. Okay. So the question is, consider a 2-year American call option on the stock with a strike price of 98. The current price is 100 rupees. This is 100 rupees. Risk-free rate is 5% per annum, continuous compounding. E to the power 0.005 is 1.05127. So that means this is a future value factor. For it should be e to the power 0.05. There is some typing mistake. Assume 2 time period of 1 year. Underline means each period will comprise of 1 year, because that is usually the query of a student. Why we have taken 1 year? Because total is 2, divide by 2. So each period will comprise of 1 year. Using binomial model, calculate the probability of price moving up or down. Very important. First we have to see what is the probability that the price will go up or the price will come down. So any student of option valuation model will know the formula for this. And then what is the expected payoff at each node. So what is the value of this node, this node, this node? Round off to 2 decimal points. So very easy question on American option. The student will first write down step 1. Calculation of probability of price increase. Calculation of probability of price increase. P is equal to, I hope you remember the formula. We are not doing it for the first time. We have done several times in the class. P is equal to R minus D upon U minus D. R minus D upon U minus D. What is R here? R means what will be the value of 100 rupees after 1 year when compounded at 5% per annum. Value of 100 at 5% per annum compounded continuously after 1 year. D means what will be share price if it goes down. U means what will be share price if it goes up. So 100 into e to the power RT minus 90 is the 95. It should be 95. My mistake in writing here. 95, divide by 108 minus 95, solve it. 100, this factor is given in the problem, minus 95, difference between these two, 13. So I have written 0.78 in 2 digits. You can write in 3, 4, 5 digits, no problem. Then the next is step 2, probability of price moving down. Probability of price moving down, 1 minus P. 1 minus P. Go to the previous step. The probability of price going up P is 0.78. So this is 1 minus 0.78 is 0.22. 0.22. Step 3, write down PV factor. PV factor in case of continuous compounding is 1 upon e to the power RT. 1 upon e to the power RT. 1 upon, the factor is already given, this value is already printed in the question, 1.05127, question in front of you. Without question you will find it difficult to understand. 0.95123. Now go to step number 4. Go to step number 4. Write down payoff on expiry. Payoff on expiry. Payoff on expiry. What is the exercise price in this problem? Exercise price, write down 98. What is the type of option here? Call option. Call option means it will be exercised if the market price is more than 98. If the market price is equal to or below 98, call will lapse, zero value. Okay. So I will request the student to draw this diagram again. And you also write down the probabilities next to that branch. Also write down the probabilities next to the branch. Very important question. Very likelihood of getting asked in your exam. Okay, now I'm going to ask you a question. Exercise price is 98 and market price can be 106.64. So if I wait till 2 years, what will be payoff? 116.64 minus 98, because it is more than 98. So the payoff at this point will be 18.64. What will be payoff at this point? 102.60. Market price is more than 98. So call will be exercised and the payoff will be 4.60. What will be payoff at 90.25? 90.25 is below 98. It will lapse, value is 0. Call option will have 0 value. So now what I have to do in American option, I have to find the value of the option at this point. The value of the option at this point will be, because it is an American option, you can exercise at any point of time. So higher of the two I will take. I will take that value which is more profitable to me. So if I exercise at this point, I'll get 10 rupees. But if I exercise after 2 years, I will get either 18.64 or 4.60 with a probability of 0.78 and 0.22. So if I wait till the end of 2 years, the answer is 18.64 into 0.78 plus 4.60 into 0.22. But this value is after 2 years and we are comparing it with one value of 1 year. So I have to multiply it by PV factor also. because I have to pull it from 2 to 1. I have to pull it from year 2 to year 1. So I have to also multiply it by 1 year PV factor, and then we'll see which value is higher. The one which is higher is the value of this node N2, which is also your question, right? So write down expected payoff at node N2. Question in front of you. Expected payoff at node N2. Expected payoff at node N2 is higher of, why higher? That value which is more profitable will be exercised. So if I exercise at this node, immediate exercise, I will get 10 rupees. If I exercise later, I will get this value, but this value is after 2 years, so I will multiply by 1 year factor, because I am moving from year 2 to year 1. I am moving from year 2 to year 1. So solve it. Let us simplify this. Immediate exercise is 10. Later exercise value is 14.792. Later exercise value is 14.792. So I will take 14.792. So this is the value of N2. In the same way, you write down please expected payoff at node N3. Come on, keep writing. Keep writing. Those who are watching this lecture, also share with your friend. Please subscribe to this YouTube channel, and we will come out with more lectures useful to you. So what is the price at N3 in the diagram? The price at N3 is 95. Exercise price is 98. So immediate exercise means the option is not worth exercising. It is share price is below exercise price. So value is 0 for immediate exercise. If you exercise later, you will get 4.60 or 0 with these probabilities, and this is PV factor 0.95123 PV factor. So I will request the student to solve it themselves. So you will have to choose between 0 and 3.41. 0 and 3.41. So the value of node N3 is 3.41. So now we have got the value of N2, N3. N2 was 14.792, N3 is 3.41, and we have to now go to N1. And these are their probabilities, 0.78 and 0.22. So the value of N1 will be, again, the value at this node or value of 0.78 into this plus 0.22 into this into PV factor, whichever is higher. So write down the last part of this answer. Expected payoff at N1. Expected payoff at N1. Expected payoff at N1. Higher of 0. Why 0? It should not be 0. Just remove this. 100 minus 98. 100 minus 98. 2 rupees, because at 100 rupees the call has a value of 2 rupees. 100 minus 98, 2 rupees. If you exercise later, this will be the value of later exercise. So you have to simplify. You will get higher of 2, 11.69. higher of 2 comma 11.69 to 11.69. This is the answer of this wonderful and very wonderful question number 6. Any query on this? If you have a query, you have to WhatsApp 97669 21860, or you have to email Vinod_PA at yahoo.com. Okay, so doubts can be resolved on this by contacting on WhatsApp or email ID. Now next question number 7. This is also a repeat question. Long back it was asked, and such question they ask again and again on future. Very easy question. Shyam buys 10,000 shares of X Limited at rupees 25 per share and obtains a complete hedge of shorting 400 Nifty at 1100 each. So shares long position and future short position. If the price goes up, profit on share, loss on future. If the price goes down, he will have loss on share, but to some extent it will be compensated by gain on future. It will be hedged by gain on future. He closes out his position at the closing price of the next day when the share of X Limited has fallen by 4%. This has gone down by 4%, so loss on share, and Nifty future has dropped by 2.5%, so there will be a gain. So the student will have to calculate loss on share, gain on future, and what is the overall profit or loss from this set of transaction. Very easy question, bonus mark. Is it right? So who will reply? I'll wait for your answer. What is your net gain or net loss? What is your net gain or net loss? What is the net gain or net loss? Come on, reply fast. So write down like this: calculation of gain or loss. Just 3 lines. First point A, write down loss on cash position. Cash position loss because share price has gone down. You have a long position on share, so you will have a loss equal to, take on your calculator 10,000 into 25, 10,000 shares into 25, and it has gone down by 4% into 4%, so 10,000 loss. In future you have short position. If the future price goes down, you will have gain because you are short position on future. You have a short position on future. A short position holder gains if the price goes down. 400 into 1100 into 2.5%. So there is a gain of 11,000. There is a gain of 11,000. So now the net gain is 1,000 rupees. Net gain is 1,000 rupees. Just 3 lines. Okay, the answer is over. The remaining question we will take in SFM RTP May 23 part 2 coming soon. So I will make an announcement of the second part. So you subscribe to our YouTube channel AS Foundation and you will get a notification. Keep the notification on. We will take part 2 very soon. Okay, so thank you very much for watching this video. I wish you all the best for your exam. Thank you very much. Hello friends. Today we'll take the RTP SFM May 2023 Part 2. In the previous Part 1 we have covered the first 7 questions. So now today we are going to cover the remaining questions. So please keep the RTP in front of you, and you can download the RTP from our website vino.in. In vino.in, please go to website, free resource section. You can download the RTP. Okay. So should we start now? Should we start now? Say yes. So question number 8 should be in front of you. RTP SFM May 2023. Very important question. A new question. Something new. XYZ has taken a 6-month loan. The first thing you underline 6 month. 6-month loan from its foreign collaborator for USD 2 million. This company has taken loan of 2 million US dollar, and the maturity of the loan is after 6 months. Interest is payable on maturity at LIBOR plus 1%. Interest is payable at LIBOR plus 1%. So whatever is the LIBOR rate, 1% premium will be paid. Hello to everybody, those who have joined just now. Mr. Mohammed, hello. Spot rate is given. The following spot rate is given rupee per USD, and the 6-month forward rate is given rupee per USD. What is the interest rate in USA? The 6-month LIBOR for USD is 2%. This is 2% per annum. Even if per annum is not written, all the rates are in per annum term, which means if you borrow for 6 months, the rate of interest is 2% per annum. 6-month interest rate in India is 6%. 6-month LIBOR for INR is 6%. This is also per annum. So this is one mistake where student can make a mistake. They take directly 2 and 6, but please remember all rates given are per annum. All rates given are per annum rates. You are required to calculate rupee requirement if forward cover is taken. So in case if we take forward cover, we will have to pay at this rate after 6 months. So basically you have to find out dollar amount payable multiplied by this forward rate of 68.4575. So this is a very easy question. A similar question was asked many years ago, which had this first part. Now what they have done in this RTP, they have added one more part, advise the company on the forward cover. That is whether the company should take forward cover or not. Then next is, what will be your opinion if the spot rate of INR per USD is 68.4275? The spot rate is 68.4275. Will you go for forward cover or not? Okay. So let us solve this question. First question is, what is the rupee requirement if the forward cover is taken? So write down step 1, applicable interest rate for USD. applicable interest rate for USD. This extra working note I am giving because sometimes the student make a mistake, they directly take 2%. So dear student, write down applicable interest rate for USD, LIBOR plus 1, LIBOR plus 1, that is 3%, LIBOR plus 1, 3%. Now I am going to use this LIBOR plus 1, 3% to solve the question. Step number 2, write down rupee requirement if forward cover is taken. Rupee requirement if the forward cover is taken. How much amount we have to pay in rupee? How much amount we have to pay in rupee if we take forward cover, if we pay as per the forward cover rate? So first write down loan. $20 lakh. Loan is $20 lakh. 2 million is $20 lakh. Second, write down interest. Second, write down interest for 6 months. Second, write down interest for 6 months. Interest for 6 months. 20 lakh into 6 by 12 into 3%. 20 lakh into 6 by 12 into 3%. That is 30,000. Check the answer, 30,000. Next, write down amount payable on maturity. Amount payable on maturity. Amount payable on maturity. A plus B, 20 lakh $30,000. 20 lakh $30,000. Forward rate write down, which is given in the problem. This is the forward rate which the bank has quoted. That means we will have to pay at this rate on maturity, 48.4575. This rate is contractual rate, that is the rate already given by the bank. Next is rupee requirement. What is the rupee requirement? Rupee requirement will be C into D. Rupee requirement is C into D. Rupee requirement is C into D. Multiply C into D. Come on. The answer is 13 crore 89 lakh 68,725. 13 crore 89 lakh 68,725. Check the answer is whether it is right or not. Now there is another part of this question. The other part of the question is, which is the new part they have added. What you have done up to the previous step 2, it was already asked in some earlier exam paper. Now they have added one additional part. Question number 8, second part, advise the company on the forward cover. Advise the company on the forward cover. Should the company take the forward cover? So when you take forward contract with the bank, we have to pay at the rate of 68.4575. We have to pay at the rate of 68.4575. But suppose we don't take forward cover, what would be the exchange rate after 6 months? What would be the exchange rate after 6 months? So we will find out what would be exchange rate after 6 months using interest rate parity theorem. What would be exchange rate after 6 months using interest rate parity theorem? If I find that the interest rate, suppose this is suppose as per IRPT it comes to 68.50, that means it is better to take forward cover because I will have to pay at a lower rate. But suppose it comes to 68.40, then it is better not to take forward cover wait for 6 months, and as per IRPT the rate will be 68.40. So we'll have to check what would be the exchange rate after 6 months as per IRPT, because we are given interest rate in both the countries. So now write down step number 3 just to check what will be IRPT exchange rate. Exchange rate as per IRPT. Calculation of forward rate as per IRPT. Calculation of forward rate as per IRPT. Write down the formula, already you are aware. Forward rate is equal to S into 1 plus RD by 2 upon 1 plus RF by 2. 1 plus RF by 2. So now we'll solve. This is the spot rate in the first 3 lines of the question into 1 plus in interest. In India the interest rate is 6%. In India the interest rate is 6%. 0.06 divided by 2, and in USA the interest rate is 2%. The interest rate is 2%, 1 plus 0.0 by 2. So we are going to take the base rate 6% and 2%. That 1% premium is specific to the firm, which can be different for different firm, but that LIBOR 6% is common for everybody. And why we are dividing by 2? We are dividing by 2 because it is 6 months problem. So now you will solve and give me the answer. The answer comes to, please check, 69.8845. 69.8845. 69.8845 per US dollar. And what is the forward rate bank has quoted? 68.4575. So it is better to take a forward cover, because this is much lower than the exchange rate that you will get as per IRPT. So write down the conclusion for the first part. We should go with forward contract. Please write down, company should take forward cover. Company should take forward cover because IRPT rate is higher than the rate quoted by the bank. IRPT rate is higher than the rate quoted by the bank. IRPT rate is higher than the rate quoted by the bank. This is the answer of part 2. Very good question to test your understanding of IRPT and forward rate. In the third part of the question, what they have done, they said that will your answer be same if the spot rate is 68.4275. So let us check. Same thing. Again I am going to compute the forward rate as per IRPT. Again I am going to check whether it is below or above the rate quoted by the bank, and accordingly we will be able to answer. I am not writing the formula again, so write down forward rate is equal to this is the spot rate into 1.03 divided by 1.01. These two will be same, only this I am changing. So when you solve it, you are getting 69.7825. 69 or 68. Let me just check. Just please wait. 69.7825. 69.7825. And what was the forward rate quoted by the bank? 68.4575. Again the answer is this is much lower. This forward rate quoted by the bank is much lower, so I will better go with forward contract with the bank. Just let me just check the calculation why it is so different. Please, you can also try. Yes, this is right, 69.7825. 69.7825. Same conclusion, write down. In this case also, in this case also, in this case also, the company should not take, company should take, in this case also the company should take forward cover. In this case also the company should take forward cover. So that was question number 8. Very important question. Write down, very important question, 5 star. Second part you may not be able to answer in the exam if you don't go pre-prepared. Is it right? So dear student, come to question number 9. This is a repeat question. Same question they have repeated in the past also. 2-3 times they have asked this question. Question on foreign exchange management, but important. Again, if you don't practice this question before going to the exam, there can be a mistake. So good evening to everybody who has joined just now. Mr. Rishabh, Aisha. Mr. A Limited is planning to import an equipment from Japan at a cost of 3,400 lakhs yen. Same problem they have asked earlier also with the same figures. The company may avail loan at, underline, 18% per annum interest with quarterly rest. 18% per annum interest with quarterly rest. Now what is quarterly rest? Quarterly rest means quarterly compounding. So in India, if you borrow money, the interest is charged every quarter and the interest is compounded quarterly. So the formula would be, for computing future value, 1 plus r divided by 4 to the power n into 4, that is future value. I hope you have studied this in the school level mathematics classes. Now here the student make a mistake, they don't consider the interest on quarterly compounding basis, with which it can import the said equipment. The company has also an offer from Osaka branch. Osaka is in Japan, of an Indian bank extending credit of 180 days at 2% per annum. So there is a big advantage of borrowing from Japan. The interest rate is 2% per annum, whereas in India interest rate is 18% per annum and with compounded quarterly, against an opening an irrevocable letter of credit. Irrevocable letter of credit means it cannot be cancelled. Anyway, it will not affect your answer. The word irrevocable means non-cancellable. Additional information. Present exchange rate is 100 rupees is equal to 340 yen, and 180 days forward rate, 180 days forward rate is 100 rupee equal to 345 yen. Commission charges for letter of credit is 2% per 12 months. So 1% for 6 months. So 1% for 6 months. Advise whether the company should accept the offer. So basically you have to make a choice. Choice is borrow in India or borrow in Japan. If you borrow in India, interest will be 18% per annum. Interest 18% per annum, quarterly compounding. Okay, there is a student who has a question. Can the SFM lectures be applicable for November 24 exam? The answer is yes. You can purchase our SFM lecture applicable for November 24 exam, and whatever MTP, RTP questions will come from this date till November 24, we are going to cover on our YouTube channel. So don't worry, if you follow our YouTube channel, all the questions that will be asked in RTP, MTP and exam, we are going to take a session on that and you will be updated with that. Okay, can you come to the question again? The other option is you can borrow in Japan. There are two costs. One is letter of commission cost, which is 2% per 12 months, and second is interest. But the third factor also we have to consider is exchange rate movement. The third factor that we have to consider is also the exchange rate movement, right? So all this will be covered, calculated, this will be calculated, and because we have to pay after 6 months, the choice will be lower of the two. If I borrow in India and if my cash outflow in rupee is lower, I will go with Indian borrowing. If I borrow in Japan and my cash outflow in rupee is lower, I will go with yen borrowing. So don't be patriotic. No patriotism. You are a businessman. Select the option which will result into lower cash outflow in rupee after 6 months. So first you write down option 1. The same question we had covered in the class also. Option 1 is borrow in India at 18% per annum. Borrow in India at 18% per annum with quarterly rest. Borrow in India at 18% per annum with quarterly rest. Underline quarterly rest means quarterly compounding. The formula for future value when it is a quarterly compounding is PV into 1 plus R to the power 1 plus R by 4 to the power N into 4. So using this formula, we will see how much amount is payable in rupee after 6 months. So in 6 months there are 2 quarters. In 6 months there are 2 quarters, so this will become 2. Okay, let us write. You'll understand better when you write. Follow my instruction, write down along with me, line by line, step by step. Institute answer sometimes is not understandable. Amount to be borrowed in INR. Amount to be borrowed in INR is 3400. 3400 is the yen value into 100 by 340. Into 100 by 340. Into 100 by 340 is 1000. 1000 in rupees in lakhs you have to borrow. Now write down B. Amount payable after 6 months. Amount payable after 6 months. Using this formula we will get 1000 into 1 plus R means rate of interest 18% divided by 4. Number of years will be 2 quarters. N will be 2 quarters. This is power 2. Why power 2? Because 6 months means quarter 1 and quarter 2. Or you can take half year into 4. If I apply the formula strictly, then also it will come to 2. Whichever way you understand. Tell me the answer. The answer is 1092.025. 1092.025. Check the answer. Now write down option 2. Accept offer from foreign branch. Accept offer from foreign branch. Accept offer from foreign branch. Right hand side amount in rupees in lakhs. So we have to make payment of letter of credit commission also. And we have to also pay to the foreign bank principal plus interest. all figures will be converted into one INR, and second, all figures will be considered after 6 months. To make the two answers comparable, the currency should be in rupees and the amount payable should be after 6 months. Who is going to open the letter of credit? The letter of credit will be opened by a bank in India today. It's like a guarantee given by an Indian bank to a foreign party that don't worry, my client is going to make the payment to you, and if my client does not pay, we will pay. So letter of credit commission is 2% for 12 months. So for 6 months, it will be 1000 into 2% into 6 by 12. So that comes to 10. That comes to 10 lakhs. Then write down. Now this amount will be paid today. In year 0, 10 will be paid. But all calculations we are doing after 6 months. You are going to pay this 10 lakh out of your Indian bank account or Indian bank borrowing. So we'll have to calculate the opportunity cost for 2 quarters on this 10 lakh. Otherwise we will not be able to compare a cash flow today with a cash flow at the end of 6 months. So in India, the opportunity cost of fund is 18% per annum quarterly compounding. So my interest for 2 quarters will be 10 into 1.045 to the power 2. This will give me future value minus 10. The difference will give me interest. That means we are considering opportunity cost on 10 lakh for 6 months in India. The opportunity cost of 10 lakh for 6 months in India is 0.92 lakhs. So total letter of credit cost, write down. Total letter of credit cost is 10.92. Now we are also going to repay the loan with interest at the rate of 2% per annum for 180 days. So write down repayment of yen loan at the end of 180 days. Repayment of yen loan at the end of 180 days. So this is the loan amount 3400 plus this is the interest on yen loan 3400 into 2% into 180 by 365. So kindly tell me the final figure here. Interest plus principal. Come on. 3433.53. 3433.53. 3433.53. But that is in yen. But we have to convert into rupees so that I can compare with the first answer. So now I will calculate payment in INR. If you look at the question, the forward rate is 100 rupees is equal to 345 yen. So what is the equivalent amount in rupees? The equivalent amount in rupees, come on, 3433.53 into 100 by 345. So the answer is 995.23. 995.23. Total cost under yen borrowing. So if I borrow in Japan, one cost is letter of credit cost. The other outflow is repayment of loan plus interest. So this number takes care of the exchange effect also, the interest effect also. Now you add these two numbers, C plus F, C plus F, C plus E, should be C plus E. So it comes to 1006.15 yen. this is lower than the previous answer. This is lower than the previous answer. So write down advice. Advice, write down borrow in yen as rupee outflow is lower by, under rupee borrowing my outflow is 1092.03. Under yen borrowing my answer is 1006.15. So by borrowing in yen I will save 85.88 lakhs. By borrowing in yen we will save 85.88 lakhs. So this way the student has to write the conclusion also. Okay, this way the student will have to write the conclusion. That was question number 9. Now we'll come to question number 10. So before question number 10, I am going to tell you something important. We are conducting FR plus SFM test series for students who are appearing in May exam. Now this test series, there are 4 tests in each subject, FR and SFM, which I teach. Question paper is set by me and it will be checked by me only. Checked by me, checked by the faculty, not outsourced to intermediate student. Okay, this question will be mostly new question, not repeated from past exam. Most of the question will be new, so that there won't be you will understand that what happens when you get a new question in the exam. It will boost your confidence, it will prepare for your next exam. If I give you all the past exam question which they have already covered in the class notes, there is no surprise element. Many test series have this wrong notion that let us give them old questions only, past questions only, but that is not good for the student, because exam will have new variety of question, new type of question which are unseen in the past. So we have done that. So you can join the test series on our website www.vino.in. On the home page there is a test series section. You can take the test. You can take 1, 2, 3 or 4 tests according to your convenience. Your answer will be checked by me, and maximum 7 days you will get your answer back with lot of feedback and comments. So we'll come to question number 10 now. Write down repeat question in the exam. This time RTP has certain repeat question also, but can't help it. Let us solve. A US based company is planning to set up a subsidiary company in India, where so far it was exporting. So US company is planning to set up a subsidiary in India. Till now it was exporting to India in view of the growing demand for its product and competition from other US based company. So now it has started facing the competition from other US based company also. So it thought that it is better that we only start manufacturing in India. The initial project cost consisting of plant and machinery including installation is 490 million USD. So this is my cost, capital investment cost. The net working capital requirement are estimated at USD 60 million. Another investment requirement will be working capital of 60 million. The company follows straight line method of depreciation. Very easy. This will help you to save time. SLM. And what is your capital cost? Capital cost is 490. So while calculating depreciation, take 490. Currently the company is exporting 2 million units every year at a unit price of $90. Its variable cost is 50 USD. Underline. At present the sale is 2 million quantity. Selling price is 90, variable cost is 50. The CFO of the company is estimated the following operating cost and other data in respect of the proposed project. Now what is the benefit of this project? If located in India, the variable cost will be 30. So variable cost will be 50 earlier, 30 now. There will be a saving in variable cost. Additional cash fixed cost will be, this is additional cash fixed cost. Cash word underline will be 30 million USD, and project share of allocated fixed cost will be 3 million USD per annum based on principle of ability to share. So this you write down, not relevant. It is allocated cost. Allocated cost is not relevant. So this is given to confuse you, but this 30 million will be useful for our answer. Allocated cost will not be useful. Expected useful life is 5 years. So depreciation will be 490 divided by 5. That is approximately, check, 98. Depreciation will be 98. No salvage value. Salvage value after 5 years is 0. Production capacity of the proposed project in India will be 5 million unit, and earlier it was 2 million only. So the sales will increase by 3 million units. Estimated working capital investment for the production and sale of 2 million units through export was USD 25 million. Again, important point. When the production was in USA, the working capital requirement was 25 million USD, and as we have read above, if you manufacture in India, the working capital requirement is 60 million USD. So there will be additional working capital requirement. There will be additional working capital requirement. Who will answer what is additional working capital requirement? So we require 60 million. Now we already have 25 earlier. So if you start the project in India, you will have to put $35 million more in working capital, not 60, because 25 is already there. So I just have to increase it to 60. So I have to increase by 35. Export of the product in the coming year will decrease to 1.5 million units, provided the company does not set up subsidiary company in India in view of the presence of competing other US based companies that are in the process of setting up of their subsidiaries in India. Very good line. If I set up the plant in India, the output will be 5 million units. But if I don't set up the plant in India, in future, my export to India will be 1.5 million only, because there will be more competition in India. More US companies will set up their operations in India. So by setting up this factory in India, the company is going to benefit in future 3.5 million units. So do not compare with 2 million units because it was in the past. You have to compare with 1.5 million units because that is the future sale projection. Applicable corporate tax is 35. Just repeat, this 2 million not relevant. Required rate of return 12%. Assuming that there will be no variation in the exchange rate of two currencies and all profits will be repatriated, no withholding tax, estimated NPV of the project in India, and give your advice. So this question has no exchange rate conversion. Although it's a problem of international capital budgeting, but the problem says exchange rate will not change at all. So there is no need for conversion at any stage. And in some problem institute used to give withholding tax, no withholding tax also. So very easy question from that angle. NPV you have to find out at 12%, and these are the factors given. So what I'll do, I will divide my answer into two stages. First, I will compute incremental CFAT. First, I will compute incremental CFAT by choosing this project, by what amount my CFAT will increase, and second, I will compute incremental NPV. And if incremental NPV is positive, I will undertake this project. So if I undertake this project, my sales will be 5 million against 1.5 million. So this is the main advantage. My revenue will increase on 3.5 million units. But my variable cost will also change. Earlier my variable cost was $50 per unit. Now it will be $30 per unit. So what variable cost I was supposed to incur versus what I will incur in future, I will consider. Third is cash fixed cost we will incur 30 million, which was not there earlier. Fourth, we will get the benefit of depreciation. We'll get the benefit of depreciation. Depreciation is a tax shield expense. So we'll get the benefit of depreciation. So I will merge all these numbers and calculate the incremental CFAT. So student will write along with me. Come on. Calculation of incremental CFAT. 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 Is my voice audible now clearly? Calculation of incremental CFAT. Right hand side, two columns, dollar million, dollar million. Write down first point A, incremental sales revenue. Incremental sales revenue. So you have to think now, what will be incremental sales revenue? Now you will be selling 5 million units if you undertake this project. If you do not undertake this project, you will be selling in future 1.5 million units. So your quantity sold will increase by 3.5 million units multiplied by the rate. So write down the calculation. Write down the calculation 5 million minus 1.5 million into rate per unit 90. Come on, answer. Come on, answer. How much is that? That comes to 315. That comes to 315. Next point, less incremental cost. Cost will also go up because quantity has gone up. So the cost will go up. First write down variable cost. Now we are going to incur 5 million quantity into $30, and if I don't undertake the project, then I will incur 1.5 million unit into $50. So the difference will be my increase in variable cost. Difference is increase in variable cost 75, increase in fixed cost. Now 30. Earlier it was not there, 0. 30 minus 0. 30 minus 0, 30. Depreciation, 490 divided by 5 years, 98. So these are my incremental cost. Take the total in the outer column. Take the total in the outer column 203. Take the total in the outer column 203. Incremental revenue minus incremental cost is incremental PBT. So that is equal to A minus B, 112. Come on. Please reply now. Incremental PAT. Tax rate is 35%. So PAT will be 65%. Tax rate is 35, PAT will be 65% of 112. So take PBT into 65%. PBT into 65% is how much? 72.8. So PAT plus depreciation. If I add PAT plus depreciation, what do I get? If I add PAT plus depreciation, what do I get? Yes, reply. Mr. Yogesh, what is the answer? PAT plus depreciation. You will get incremental CFAT. You will get incremental CFAT. And that is point number D plus point number B3. Point number D plus point number B3. So how much is the answer now? 170.80. This I will require for NPV calculation. So next step number 2, calculation of incremental NPV. Calculation of incremental NPV. Draw this format: year, particular, cash flow, PV factor at 12% and PV. Usual format. Come on student. First, year 0. Cost of the plant and machinery. Cost of the plant and machinery 490 given in the problem. Year 0, incremental working capital. Important. Chance of mistake here. If you undertake this project, you will require a working capital of 60. If you continue with your existing project, there is already an investment of 25 million in working capital. So to undertake this project, you will have to put 35 million USD more today. So that is 35. That is 35. Year 1-5 write down. Incremental CFAT. Go to previous step 1. Check the answer. How much was that? It was 170.80. It was 170.80. Take the total of the PV factor given in the question, 3.6048. Multiply the two. The PV of CFAT is 615. Year 5 we have to write recovery of working capital. Recovery of working capital. Same what you've written here, 35. You write here in recovery also. Factor is given in the question book. RTP May 2023 SFM. RTP May 2023. Those who have joined late, you can download from our website vino.in this RTP with solution. Multiply NPV. Take the total of this last column. Good student will give me the answer first and fast. What is NPV? Last column total. Come on. 110.5588. 110.5588. Positive or negative? Positive. So the advice write down. Advice write down. The proposal should be accepted as NPV is positive. The proposal should be accepted as NPV is positive. The proposal should be accepted as NPV is positive. This way you will write the answer in the exam. Complete answer in detail, line by line, with all calculations presented, with final conclusion also. Then you will get the full marks. Okay. In this question, one figure which we have not considered is allocated fixed cost. Allocated fixed cost is not relevant. You can mention here allocated fixed cost $3 million is not relevant because it will not affect cash flow. It will not affect cash flow. There is no incremental cash flow involved because of this. Now next, very easy question and repeated in the exam also. Question number 11. P Limited, a dealer, quotes all in cost. All in cost means all charges included. Brokerage, commission, administration, that is called all in cost. All charges included. Nothing will be charged over and above this. All in cost for a generic swap. Generic swap means swap of fixed versus floating rate. One party will pay fixed rate, one party will pay floating rate. That is generic swap at 6% against 6-month LIBOR flat. So what is the deal? That 6% fixed rate sorry, will be swapped against LIBOR for a notional principal amount of 8 lakh. This is the notional principal. This is required for calculating interest. This is required for calculating the interest. Calculate semi-annual fixed payment. Semi-annual fixed payment means how much the fixed rate payer will pay after 6 months. So the answer is 8 lakh into 6% into 180 divided by 360. That we will write the calculation later. Next point, find the first floating rate payment for one above if the 6-month period from the effective date of swap to the settlement date comprises 181 days. So when you are calculating floating rate payment, it is based on actual number of days and that the corresponding LIBOR was 5%. So here we will take 8 lakh into 5% into 181 days and divide by 365. In the question number 2 above, if the settlement is on net basis, we will take 360 here, not 365. Settlement is on net basis means only the difference will be received or paid. Settlement on net basis means the difference will be received or paid. How much the fixed rate payer would pay to the floating rate? This is my fixed rate payment. This is my floating rate payment. Difference between these two answers is your third answer. There is a note. Generic swap is based on 30 divided by 360 means month is equal to 30 days and year is equal to 360 days. When you are calculating fixed rate payment, we follow this convention, 1 month is equal to 30 days. But when we are calculating floating rate payment, we take actual number of days. When we are calculating floating rate payment, we take actual number of days, and that is why the question paper setter has given you actual number of days in case of floating rate. So please note down. First answer part 1. Answer of part 1, semi-annual fixed payment. In the exam, first write formula, then write numbers, then write answer. Write down notional principal amount into all-in cost into period. 8 lakh into 6% into 180 divided by 360 into 180 divided by 360. So that is equal to 24,000 rupees. The fixed rate payer will pay 24,000 rupees. Fixed rate payer will pay 24,000. Now the question is how much the floating rate payer will pay. Write answer part 2. Floating rate payment. Floating rate payment. Notional principal into LIBOR into days divided by 360. Notional principal is 8 lakh into LIBOR is 5% into here will take actual days 181 divided by 360. So please reply. So that comes to 20,111. Answer of part 3. What is the net amount payable by the fixed rate payer? So just take the difference of the two parts. Fixed rate payer has to pay 24,000 and will receive 20,111. Therefore, the fixed rate payer has to pay a net amount of 3889. Net amount of 3889. That was the answer of this highly repeat question. Very easy. Question number 12 now. Question number 12. Again, highly repeated question. Highly repeated question. Excellent Limited reported a profit of rupees 154 lakh after 30% tax. So PAT is 154 for the year 1920. So this is the previous year PAT. An analyst of the accounts revealed that there is an extraordinary loss of 20 lakh and income included extraordinary income of 16 lakh. So first you will convert PAT into PBT. How do you convert PAT into PBT? You will take PAT divided by 1 minus tax rate 30%, means divided by 70%. PAT is 70% of PBT. To get PBT divided by 70%, so that will come to how much? That will come to 220. Now when you are doing business valuation, this is a question on business valuation, we have to consider normal income, normal operating profit. We should not consider abnormal item, extraordinary item. So what will you do? If there is an extraordinary loss, you add back, and if there is any extraordinary income, you deduct. That will give you normal profit before tax earned by this company in the last year. So normal profit will come to 224. So assuming that this 224 will continue, plus what happens next? The existing operation except for extraordinary item are expected to continue in future. This 224 will continue in future. In addition, the result of the launch of a new product are expected to be as follows. So they have added one more project in their business. What will be the effect of that business? Sales will increase by 140, material cost, labor cost, fixed cost. So this will generate an additional profit of 140 minus 40 minus 24 minus 20, 56. So my total profit will become 224 plus 56, which is 280. This will be the profit before tax in future. And then you will convert into profit after tax in future by deducting 30%. So after you deduct 30%, this will be 196. So this is called future maintainable profit after tax. This is called future maintainable profit after tax. From this business, 196 can be earned in future. Calculate the value of the business given that the capitalization rate is 14%. That is the required rate of return. So 196 divided by 14% will give you the value of the business, which comes to 1400 lakh rupees. Okay, so the first answer will be 1400 lakh. Second question, this is first question, this is second question. Determine the market price per equity share. Valuation of share now. With Excellent Limited share capital being comprised of 2 lakh at 13% preference share of 100 each and 100 lakh equity share of 10 each, and the P ratio being 12 times. Ignore corporate dividend tax. So if you look at this question, we have already computed 196 future maintainable profit after tax minus preference dividend will give you earning available to equity shareholder. Divide by number of equity share will give you EPS, and EPS multiplied by P ratio. EPS into P ratio, come on, what is EPS into P ratio known as? Because they have given P ratio, it means the intention of the question is the student should use P multiple to solve the answer. Is it right? So almost answer I have written, but in the exam you need to present it nicely. Presentation is very important. So please write down, those who are writing along with me in the notebook. Reference is RTP May 2023, question number 12, SFM. Calculation of business value. Calculation of business value. Right hand side rupees in lakhs. Right hand side rupees in lakhs. You are given existing PAT. You are given existing PAT of 154. You convert into PBT by dividing by 70%. So 154 divided by 70%. Profit before tax right now. Profit before tax right now. Then write down point number B. You will deduct extraordinary income 16. Deduct extraordinary income 16. Add extraordinary losses 20. Add extraordinary losses 20. So this will give you existing normal PBT. This will give you existing normal PBT. This is coming to how much? calculate and tell me. 224. Then you write down point number E, profit from new product. Profit from new product. Under that write down sales 140. Sales 140. Material 40 in bracket. These are cost. Labor 24 in bracket. Fixed cost 20 in bracket. So existing profit will continue. The new product will generate additional profit. So my profit would increase in future by 56. Valuation is a function of future profit. A person pays for a business today because he will enjoy the future profit. Hence we have to check what will be the profit the company would generate in future. Point number F, write down projected PBT. D plus E, come on, 280. Projected PAT. Projected PBT into 70%. Projected PBT 280 into 70%. 30% deduction of tax 196. So this much profit they will earn in future. And what is the capitalization rate? Means required rate of return from such business. Investors' required rate of return called capitalization rate is 14%. So therefore value of business 196 divided by 14%. So investor will be willing to pay for such business as a whole 1400. Investor will pay for such business 1400. Now there is another question. What is the price of the equity share? So that you write down. And because they have given the P ratio also, one of the methods of valuation is P multiple. That is earnings multiplied by P ratio. So write down. Step 2. We'll use P model, P multiple approach for this answer. So calculation of market value of equity share, right hand side amount. First point A, projected PAT. Projected PAT is 196, already calculated in step 1. Projected PAT step 1 196 less preference dividend rupees in lakh, less preference dividend 2 lakh share in 200 into 13%. So that comes to 26 lakh. So now what I'll get is called earning available to equity shareholder. Earning available to equity shareholder. Earning available to equity shareholder 170 lakhs. Number of equity shares. Number of equity share in lakhs. Number of equity share in lakhs is given in the problem 100 lakhs. Number of equity share is 100 lakh. So EPS would be 170 divided by 100. EPS would be 170 divided by 100. So that is 1.70. In this question, P ratio is given 12 times. P ratio is given 12 times. So if I go by P multiple approach, the market price per share MPS would be P ratio into EPS. So it comes to 20.40, 20.40, 20.40. Please check the answer, 20.40. So this was a very, very simple question on business valuation, which they have asked so many times in the exam. Now we'll come to question number 13. One more question we will take on mergers and acquisition now. This question was also asked in the past exam. But good question. Similar question they have asked in the recent exams also. So let us practice this question number 13. Keep the notebook ready. Keep the RTP May 2023 in front of you. If you don't have RTP, you can download from our website vino.in from the free resource section. Come on. The following information is provided relating to acquiring company Efficient Limited and the target company Healthy Limited. So the acquiring company is Efficient and the target company is called Healthy. Number of share, face value is 10 rupees, 20 lakh share, 15 lakh share. Then they have given market capitalization. Market capitalization means market value of the entire firm. Number of shares into MPS is called market capitalization. So if market capitalization is 800, number of shares are 20, you can find out the MPS from this. So some missing information is there. Good student will be able to read between the lines. So between the lines, MPS is there. P ratio is 10 and 5. So if MPS is known, P ratio is known, the student can find out EPS also. MPS divided by P ratio will give you EPS. EPS multiplied by number of share will give you total earning. So these are some missing figure which you have to find first. Reserve and surplus is given. Promoter holding in number of share is given. Shares held by promoter. Board of directors of both the company have decided to give a fair deal to shareholders and accordingly the swap ratio, for swap ratio means exchange ratio, the weights are decided as 45%, 20% and 35% respectively for earning, book value and market price of share. So this is called weighted average swap ratio. Instead of one factor, they have considered three factors in deciding the swap ratio. One is earning per share, weight will be 45%. Book value per share, weight will be 20%. And market price where the weight is 35%. So we'll have to find out what will be swap ratio according to these three variables and then apply the weights, calculate weighted average swap ratio. That is my first question also. Calculate the swap ratio and after calculating swap ratio, calculate promoter's shareholding percentage after acquisition. If you get this answer right, then you will get other answers right also. What is the EPS after acquisition? What is the expected market price per share and market capitalization after acquisition, assuming P ratio remains unchanged. Assuming P ratio remains unchanged means P ratio will remain 10. For solving third question, P ratio will remain 10. And what is free float market capitalization of the merged firm? Free float market capitalization means market value of shares held by non-promoter. Market value of shares held by non-promoter. Market value of shares held by non-promoter is called free float market capitalization. In India, on the stock exchange, the weightage is given nowadays on the basis of free float market capitalization because that is available for trading purpose. Shares held by promoters are not available for trading purpose. Okay, so now the student will solve very easy question we have done in class also. one more time. This question was there in our class notes also. First step 1, calculation of EPS, BVPS, MPS and total earning. Right hand side 2 columns, healthy limited, efficient limited, healthy limited, efficient limited, healthy limited, efficient limited and healthy limited. First you start with market capitalization. The objective is to find out first MPS. From MPS we'll find EPS. From EPS we'll find total earning. Point number A, market capitalization rupees in lakhs. Question should be in front of you. 800 and 1200. Point number B, number of shares. Question in front of you, 20 and 15. MPS will be A divided by B. MPS will be A divided by B. 40 rupees, 80 rupees. P ratio in times given. P ratio in times given. Which is given to you 10 and 5. So now the student will calculate EPS and tell me. Yes, please reply. What is EPS? 4 and 16. 40 by 10, 80 by 5. This is so basic that I am assuming everybody knows it. Total earning. This is EPS. This is number of share. So I will write down B into E, rupees in lakhs. Multiply 20 into 480, 15 into 16, 15 into 16, 240. Now I have got EPS, I have got MPS, I have got total earning. So my next task is BVPS. For that I will take share capital plus reserve divide by number of share. So share capital is given in rupees in lakhs. 20 lakhs share into 10 rupees, 200. 15 lakhs share into 10 rupees, 150. Reserves given. Reserves in rupees in lakhs given 400 and 273. So shareholder fund G plus H, shareholder fund G plus H, 600, 423, and last point J, write down book value per share in rupees. Book value per share in rupees 600 divide by number of shares. 600 divided by 20. That will give you 30. 423 divided by 15. 423 divided by 15 will give you 28.20. 28.20. Any query on this? So this is basic working note. Now I am going to use this for my next answer. Next answer is calculation of swap ratio. Calculation of swap ratio. Step 2 is calculation of swap ratio. I will give you a format first. Calculation of swap ratio. First column write down basis. Second column write ratio. Under ratio write down base of healthy limited divide by base of efficient limited. Target company upon acquiring company. Target company upon acquiring company. Third column write weight. Fourth column weight into ratio. Fourth column weight into ratio. Fourth column weight into ratio. After that we'll solve one by one. First we'll calculate swap ratio based on EPS. If you look at the step 1, what was the EPS of Healthy Limited? 16, and EPS of Efficient was 4. So going by EPS, the share exchange ratio will be 16 divided by 4. 16 divided by 4. 16 divided by 4 is equal to 4. The weightage to EPS is 45%. So I will write 0.45 and then multiply. It comes to 1.8. Second factor is book value per share. Look at your step 1. Book value per share is in the last line of your previous step 1. Healthy is 28.20. Efficient is 30. 28.20 divided by 30 is 0.94. 0.94. The weightage to BVPS is 0.20. Take your calculator. 0.20 into 0.94. So the weight into ratio will be 0.188. What is the third basis? MPS. Look at your step 1, third line. MPS of healthy is 80. Divide by MPS of efficient, third line of step 1, 40. That is 2. Weightage is 0.35. Multiply 2 into 0.35. Yes, multiply. Come on. 0.70. Total of this last column is your swap ratio. So that comes to 2.688. 2.688. 2.688. So write down note. Swap ratio is 2.688 shares in Efficient Limited for each share in Healthy Limited. 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 Now the next question is, what is promoters holding percentage after acquisition? So write down step 3. Promoters holding percentage after acquisition. So I need to find out two things. Total number of share and shares held by promoters after acquisition. So number of share held by promoter divided by total will give you percentage. Very easy question. Point number A. Existing shares of Efficient. Efficient is acquiring Healthy. So Efficient Limited already has 20 lakh share plus shares issued to Healthy Limited. Shares issued to Healthy Limited. There are 15 lakh shares in Healthy Limited books. This is the swap ratio. So they will get 15 into 2.688, which is 40.32 lakh share. Point C, total number of shares after acquisition, A plus B. Total number of share after acquisition will be 60.32. 60.32. Point D, write down shares held by promoter. Shares held by promoter. So promoter of Efficient Limited are already holding certain shares. Look at the question, fifth line in table. They are already holding 8.65 lakh share, and plus promoters of Healthy Limited will also get shares in Efficient Limited. They are holding in Healthy Limited 9 lakh share, and they will get 9 lakh into 2.688. So promoters of Healthy Limited will be holding now 9 into 2.688. That comes to 24.192 lakhs. If you add these two, this is the share held by the promoters. So total comes to 32.842. 32.842 divided by 60.32 will give you promoters holding in percentage. Very easy. Presentation is very important. This way you have to present in the exam. Everything must be clearly written. Every calculation must be shown. So the answer for this would be D by C, 54.45%. 54.45% means for free float calculation, you will have to take 100 minus 54.45%. That will be my last step, free float. Just keep this number in mind. Now my next question is, what is the post-merger EPS? What is the post-merger market capitalization, post-merger MPS, and free float? So all in one answer only. Write down. All these questions can be answered in one table, so we'll save time. First, write down step number 4, heading post-merger EPS, post-merger MPS, post-merger market capitalization, and post-merger free float market capitalization, and post-merger free float market capitalization. Under that, write down A, total earning after merger. There is no synergy benefit. So total earning will be sum of the earnings of the two companies. Step 1, earnings of one company is 80 lakh, earning of the second company is 240 lakh. So assuming no synergy because nothing is given, we'll take 320. Total number of shares. Go to step 2. Step 3. Previous step. Step 3, total number of shares you have got it. 60.32. Is it there? So now the student will tell me what is post-merger EPS. I am waiting for your answer. Post-merger EPS. A by B. A by B in rupees. A by B in rupees. That comes to 5.305. Post-merger P ratio. The problem says post-merger P ratio will not change. It will be same what it was before. So that is 10 times. Therefore, post-merger MPS. Therefore, post-merger MPS. C into D. Just multiply in rupees 53.05. Rupees 53.05. Rupees 53.05. Now this is post-merger or market price of one share, and this is total number of shares. So if you multiply these two, you will get post-merger market capitalization. So kindly multiply. A very easy question. A very easy question. But you have to practice in advance. This comes to 3199.976. 3199.976. Now the next question is, last part of this answer is free float market capitalization. So for that, this is my total market capitalization. 100 minus 54.45% is non-promoter shareholding. So kindly do this calculation yourself and write here, and that will be your free float market capitalization. Yes, try. Please try. So that comes to rupees in lakhs 1457.589. 1457.589. 1457.589. So this is the answer of this wonderful RTP. Dear students, now the exams are just about 1 month away. How to prepare in the last 25 days to 1 month? That is a very important question which every student of CA course must know. In the last 1 month, do not try anything new. Whatever you have studied till now, just revise that. Do not try new study material of some other class of your friends. So whatever you have studied in the class, if you have joined any class, revise those notes now. Revise your own notes if you have prepared your own notes. Just quickly go through the RTPs of the May 2023 exam, and if you find that there are some new question or some amendments mentioned there, do that. In the last 25 days, it is a time to get yourself stress free. I know it is very easy to say but very difficult to observe. But 1 month, trust me, if you can just keep your head calm, cool, you will surely be able to perform well in the exam. And if you take stress during this period, then it can affect your performance in the exam. This is the time to consolidate whatever you have studied. Trust me, you have prepared well, you are capable of appearing for this exam and get good marks, but the only thing is that you should not get stressed. Stress can harm you. Okay, so sleep nicely in the sense, don't sleep 10 to 12 hours, but 5 to 6 hours of sleep will be good enough. Some students don't sleep only for days, or they just sleep for 2-3 hours. That is not going to help you. You may not be able to recollect what you have studied in the last day of the exam or in the last minute of the exam. So therefore, whatever you have studied, you need to keep it in your mind, and you should be able to extract it in the exam and write your answer. Do not talk too much with your friends, because every student is different. Every student has a different skill set. Everybody has a different intellectual capacity. So some of your friends might confuse you. They might say, oh, have you studied this? Have you studied that? And then you will feel that I have not studied this and that, so I am not going to appear. Have confidence. You have done very good, and you can really do in the exam. So dear student, so my suggestion to you would be, revise only whatever you have studied. Sleep sufficient number of hours to keep yourself healthy. Do not take stress. Do not talk too much. If you want, you can appear in certain test series so that you can check your level of preparation. Do not attend marathon classes in this last minute. It will not help you. What you study yourself is going to help you only. So with these words, I wish you all the best for your exam. Thank you.